all been very tech-like this year. Those have actually started to stall the last 2 weeks. I think we're going to learn about other corners of the world from how those stocks respond going forward.
Bloomberg with a great story today on, is it Louis Vuitton?
About how it's ESG. It's the latest ESG stock, yeah.
As well.
Yeah.
Technical analysis is about looking at the past and learning lessons. We came off the mat 73, 74. We had a nice leg up. And then in December of 1975, we discovered a second leg up in the market. Can people like Chris Verone discover a second leg before it happens?
When I think about markets, I don't really operate in the world of levels. I operate in the world of what is the characteristics of a certain advance. And I think on balance, when you look at this current advance, the leadership is still pretty risk-seeking. We see it with industrials. We see it with discretionary better than staples. So I would use those characteristics to say nothing really meaningful has changed yet. I think a shift there would cause alarm, but I'm not seeing that here yet. And, Tom, you bring up this 1970s period. It's often referred to as this 10-year range. I kind of reject that. It was periods of bull and bear markets.
Yes,
it was 2 years up, 2 years down, 2 years up. It wasn't 2 weeks up, 2 weeks down.
Agree.
So this idea of the 70s being a range, I actually don't think is very accurate. If you want to look for a range, I think there's some parallels to this market. Kind of post-World War II, 45 to 50, I think is very interesting. Also a period where all the economists kept thinking recession was coming, and it never came. Interesting there.
Given that fact check,
yeah.
Do you reject this idea that the past indicators are no longer working, that the models are broken, and the technical analysis doesn't hold the same kind of cloud?
It's funny. I suppose it's your definition of what technicals is. We wake up every morning and we ask ourselves the simple question, does the market agree with the consensus? That's my definition of what technical analysis is. Anytime in my career where I've begun to question whether the indicators are valid anymore in new regimes, they're about to become very valid. So I would just keep that in mind here. Put that in context of some of the tech names. 2, 3, 4 weeks ago, we got what I would only characterize as blow-off-like volume in a lot of these semis. And what do we know historically about blow-off-like volume? It very rarely marks the top, but it can begin the sequence of putting in the top. And you were doing about a month ago, you were doing 4 or 5 times average weekly volume in NVIDIA, AMD, Avago. So some of those makings there are a very blow-off-y type volume.
With all your study of charts and the in and out and being bullish, being bearish, does market timing work? If I'm in cash, can I figure out when to get in efficiently, productively, effectively?
I might replace the phrase market timing with trend following. I think trend following works. I think we can do a pretty good job. I think all of us can do a pretty good job of getting that middle 70 or 75% of a move. I haven't met anyone yet who's particularly good at the turns. That middle chunk, we can, all the money in this business is made in the trend and not at the pulse, right? We can, I think, play trends, and that's what we've tried to do.
I set him up with that question. I knew what the answer would be.
I know, I think the audience did too. I think everyone knew that what the answer was going to be.
This is the gospel of Verone. I mean, there's no other a way to put it. Chris Verone, thank you so much.
Thank you.
I came out of that, you're a bull.
I think it's too early to back away from the trend. You can put your guard on for some things to change, but watch rates here. Rates will decide the second half of the year.
Chris Verone, thank you so much. Greatly appreciate it. Lisa, what do you see in rates this morning before this panel? It's Sintra. I take your point that maybe we'll get the most out of Governor Bailey here. I don't think he's going to declare victory. Remember,
I don't think he
that was a couple weeks ago.
Well, we heard that from Gita Gopinath, that they have the hardest task here, and I think everyone would agree with that. What we have seen is kind of stasis in markets ahead of this panel. We don't know. We don't know how far they're willing to go and what they can say to convince us something different than what we already heard.
Please stay with us. We'll have our coverage here from Central. Francine Lacroix leading our coverage in Portugal. Most interesting central bank. It's like one glorious press conference. Maybe McKee will sit in the back of the room and ask a question here late in the panel. Red and green on the screen. Futures at -7. Stay with us. This is Bloomberg.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. News breaks. No one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
Actual data has been a lot of resilience. We've actually seen that stretch of a strong labor market improve due to the very large increase we've seen in participation of working age Americans. And so there are reasons to think that we are going to continue to see resilience against a backdrop of what we have referred to as more stable economic growth.
I'm not sure I've ever seen that. That is the vice chair speaking differently. To shift from a vice chair of the Fed to National Economic Council Director for the President, Lyle Brainerd, at least in all my years, I believe I've never seen someone try to make that shift.
And then have such an important role at such an interesting time where we're expecting recession and still expecting it. And still expecting it, and it hasn't come, and all of the data seems to point to resilience. Did you see the consumer sentiment yesterday?
Yeah, yeah, actually, it was stunning. But there's Brainerd, and as a vice chair, you're hesitant, and you have to wait for white smoke to come out of the chimney, and you're looking at dots and all this other stuff, and then you go over to the White House, and you have to promote optimistically an optimistic message. What a shift rhetorically.
Although, from Biden's perspective, it would probably be better for there to be a short and shallow recession now than right as we head to the polls.
Yeah,
and
well,
that, I think, is one of the tensions.
Yeah.
So if she's actually trying to, thump the cause, that's really the tension right now.
Lyle Brainerd talking about the good economic data Lisa observed yesterday, and we saw it within a good stock market yesterday. The levels closing right on 34,000 on the Dow, SPX, a little bit under that 4,400 level. NASDAQ really with a life of its own yesterday. We're looking at the currency space. I want to take 2 seconds here, Lisa. I think this is too important before the central bank confab in Portugal. DXY stable, but lots of underpinnings going on. I'm going to go to euro, yen, Lagarde, and who's the new guy at the Bank of Japan? Help me here.
Kazuo Ueda.
Ueda. Lagarde Ueda. The Lagarde Ueda pair is up at a 158. Strong euro, weak yen is one thing I'm watching.
And it has been a weaker yen pretty consistently because they have doubled down on this message. Even as we see inflation expected to surprise to the upside in Japan and creep higher, despite this call that they want that, and the rest of the world is battling the same kind of trend. It's very counterintuitive.
All this wrapped around the elephant in the room, which is Chinese weakness, certainly business and manufacturing weakness, and part of that, the political tensions between the United States and China. Before this panel and the 9 o'clock hour, we're briefed by Wendy Schiller of Brown University, Director at Taubman Center for American Politics. Professor Schiller, thank you so much for joining again. Our Anne-Marie Horton reporting that Janet Yellen will exit to China here early in July. What can be the goal of a Secretary of Treasury to continue to rebuild, if you will, that permanent codependency we have?
Tom and Lisa, good morning. This is a really strategic move, I think, to shore up the economic relationship between the United States and China, but also to continue to send signals about the United States' willingness to engage with major powers that are not Russia. So we've got Modi and the Modi state visit, rolled out the red carpet, ignored some of the human rights issues in India, and now going to China, our top economic person, Secretary of Treasury. You can, fight about the Federal Reserve and Treasury, but she's certainly extraordinarily prominent in our economic infrastructure, and sending her or asking her to go to China reminds China that we are this stable, relatively stable, very strong economic power. And it, again, sends a geopolitical message to Russia that the United States is trying to double down on its relationships with the two other very strong nearby partners to Russia.
Wendy, how much is that message undermined by the news this morning that the U.S. may ban exports by U.S. chip makers of more advanced artificial intelligence-related technology to China at the same time that they're trying to create some sort of stronger relationship?
Well, there has been a theme for quite some time, actually, really very pronounced under the Trump administration, but certainly continued under Biden, that, intellectual property theft or spying or trying to sort of steal U.S. technology, this has been a sort of a mainstay for quite some time in U.S. policy. It's quite consistent. And, the Chinese have not been as responsive to U.S. complaints about this, both from the government's perspective and the private industry perspective in China, or quasi-private industry. And they just want more response. So, like, you can't keep stealing things from us. We're going to crack down on your companies. We're going to launch charges, and we're going to basically ban exports of highly sophisticated technology until we can get a handle on how much you are literally stealing from us. And that has been a consistent message through the Trump and the Biden administrations.
We're seeing NVIDIA lower today. It gets about a fifth of its revenue from China. We'll be talking about that throughout the show. We started talking about this panel coming up of central bankers. And Wendy, we heard from President Biden yesterday as he was talking to donors that he thinks the U.S. is going to avoid a recession. And he was talking about the positive data that we've been seeing across the board. Is this a good thing for him, considering it could push any kind of downturn out to right around the election?
Lisa, yeah, your point is so excellent about the timing of when people perceive a recession versus when we're experiencing a recession. There's a famous political scientist, Edward Tufte, a model from the 1970s, that says, whatever's happening in January or February of the election year really has a strong effect on who wins the election in November. I think that timing has shifted quite a bit, and I think that people's sentiments are also led by elites much more than they were maybe 40 years ago. A broader swath of people pay attention to more popular sort of news about the markets and about the economy. So it's really unclear when the best timing, if there is going to be a soft recession, would be for Biden. But you're right. Before December 23 is certainly much better than June of 24 for President Biden.
Wendy, I thought of you yesterday when I saw a British newspaper leading their website newspaper with a poll on the Vice President of the United States. Give us the historic perspective, the so what, if you will, that a vice president does poorly in the polls. Is there a so what to that?
Yeah, well, it's sort of a new phenomenon, actually, although vice presidents have been traditionally the people that run for president. So why we haven't done more polling historically on the popularity of the vice president is anathema to me, because, with some exceptions, Dick Cheney, for example, and Joe Biden in 2016, usually the VP is the leading candidate and runs for president. So we want to know how popular they are. So this is a new phenomenon. There's not that much history to compare it to, but clearly we have to figure out, if we are political observers, how much voters really care about the vice president of the United States. Will this really turn their decision that Kamala Harris might be president, given Biden's age? But the same thing will be said of Trump's vice president. So I think there will be a far deeper and more sophisticated discussion of the VP role for both. If both of those are lead candidates, then in 24, we're going to see much more scrutiny on whether Americans are willing to accept the VP as a potential president on both sides of the political aisle.
Well, Wendy Schuller, thank you so much. With Brown University this morning, I was thunderstruck by that, Lisa. It's the Telegraph in London. It doesn't matter which paper it is. But in London, they're leading with a poll on the Vice President of the United States. Without question, I've never seen that.
There is this belief that Vice President Kamala Harris will have to take on a much greater role in this election due to the president's age, due to questions about his ability to fill the entire tenure of his term. And we saw that with the White House Correspondents' Dinner, where a vice president, Kamala Harris, was the first to sit on stage with a sitting president for that, going back to 2016.
Was that the first time? I did not know that.
It was going back a number of years. There was a theory that this was to sort of emphasize her position heading into an election where suddenly the succession becomes a much bigger question.
That's going to be interesting to see, to say the least. Can we go back here to this panel? And I'm going to look at foreign exchange, and I'm sorry, I don't know what to do here. There's just massive ambivalence here in the foreign exchange market with dollar unched. Sterling is, I guess, what I'm watching more than anything, Lisa, 127.07. Again, it's a churn waiting for the news. I mean,
it's a churn except for the Chinese yuan, which is weaker decidedly across everything. And that is the one theme as we look to how they can bolster that economy.
We'll have to see red and green on the screen here right now. Futures at -7. The VIX, wow, 13. I'm still not used to this, 13.80 on the VIX. Coming up on the Events and Center, Veronica Clark of Citigroup. This is Bloomberg. Good morning.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Surveillance. Jonathan Farrow on assignment. A lot of mystery about that. It's like a British thing. It's
not a mystery. He's on vacation.
You know, time off. It's like
it's a good thing.
3 or 4 weeks. It's like a sabbatical.
It's a good thing. I think everybody.
Have you ever had a sabbatical?
No, I have not.
I've never had a sabbatical.
No, I've been working since I got out of college.
We should work on that.
Yeah, I think so too. Go on a collective surveillance sabbatical.
Three of us take rolling sabbaticals here into the end of the year. John Farrell returns here at some point. Lisa Bramwitz and Tom Keenigan. Lisa with this important Centric coverage. Look for it at 9:30 a.m. This morning, Lisa. What's that going to be like? I mean, you know, they show up and I guess Miss Eisen's leading the way, and you know they're going to really kill themselves not to say anything, right?
I feel like Jay Powell's going to sit there and be sitting pretty, and he's going to sit there and be like, you know, we've got it kind of under control, and soft landing and disinflation, and we're seeing good things, blah blah blah. And then ECB's Christine Lagarde will say that's not where we're at. We're in a much different position. We're going to stay hard. We're going to keep raising rates and keep doubling down. And then you're going to have Andrew Bailey being like, we're having a really tough situation, and then you're going to have Ueda, who's just going to be very awkwardly sitting there saying, we're very happy with yield curve control. And that's going to be the dynamic of the entire meeting.
We've tried to bring you folks some of the dynamics, as Lisa mentions, of the Bank of Japan. It's distant. It's around the world. What's the so what for American listeners and viewers? And the answer is it really, really matters, according to the pros, and it links directly into the American economy. Yen 144.08 just refuses to go stronger, a lower number. And for that to get out to 146 or 148 would be a challenge for the Bank of Japan.
It's going to be interesting. This particular panel, I feel like Fed Chair Jay Powell is probably going to have the best situation because they are further along in some of the rate hikes, or so people think. Veronica Clark has been pushing back against this idea at Citigroup that the Fed is done, saying the timeline for a potential recession has pushed out further out as activity and jobs data continue to surprise to the upside. A sharp slowdown in growth remains a risk, but stubbornly high underlying inflation is the current reality. We continue to expect the Fed to raise policy rates by 25 basis points at each of the next two meetings. And that is the distinction between the Citigroup view of the world and the rest of Wall Street, Tom, which really has pushed back against the idea that the Fed has to go that much further.
Can we be as bold as to say, like Alarian and Dudley, Citigroup's been out front on this for 18 months, maybe it's 14 months, but I think Citigroup has been way, way out front on this.
And here to take a victory lap is Veronica Clark, economist at Citi, to sort of extrapolate out how far the Fed can raise rates. Is the market accurately pricing just how hawkish the Fed needs to be in light of the recent strength?
Yeah, I mean, it's not over until it's over, of course. But I think the market is more fairly priced at this point. You know, we're expecting a hike in July. We're also expecting a hike in September. The market is pricing that hike in July at, you know, to a pretty, you know, large degree. I think that July hike is a relatively low bar. And then after July, we'll, you know, should see still some strong inflation data. And then that gets us to the hike in September. But for the market, it's just going to take time to see that data to price it.
One of the tensions right now, Veronica, is a lot of people are saying that the tightening in credit conditions has not been nearly as significant as people thought because of how contained the 10-year yield has been, longer-term yields. How much do we need to see those yields creep higher to achieve what the Fed is going after?
Yeah, it is an interesting dynamic where, you know, we have had a tightening in credit. Obviously, yields are higher, but they haven't continued to move higher. And this is actually an interesting dynamic that we're seeing in the housing market now, where, of course, mortgage rates will be more dependent on those longer end yields. And they've been, you know, relatively stable since, you know, the last half of last year. And that means that we're actually seeing a pickup in housing activity again, in housing demand. You can see these dynamics if you're not tightening credit conditions more.
I look, Veronica, at where we are, and I really want to fold it in this panel this morning. This panel, I think, is going to be a snooze fest, and I'm usually wrong, to be honest. I think there's going to be some interesting complexities out of it as well. From where you sit, and with your global mandate at Citigroup, how removed is America's exceptionalism, our monetary exceptionalism, from what everybody else is doing out there?
I don't think too removed, actually. I think, you know, it's a struggle for a lot of these, you know, global central banks, obviously, to get inflation lower. And I think the Fed can maybe learn from some of these other banks. Of course, we had Bank of England hiking by 50 basis points, Bank of Canada that, you know, tried to pause their rate hikes and then also got this rebound in housing activity and inflation that didn't slow enough and had to restart hiking rates again. So the Fed can kind of learn from some of these central banks that it's just a really hard job to get inflation lower, and you might think that you're close to the end, but there are still those upside risks if you're still well above target.
Well, review with us, given the Citigroup call, the trajectory that you see on rates linked to inflation? Is it like 5%, struggle through 4, or do we rapidly come down to 3 and then it's a struggle to 2?
Yeah, we're increasingly thinking about these scenarios where inflation doesn't slow as quickly as in our forecasts or as in the Fed's forecasts. We have penciled in, a mild recession for later this year, early next year. Risk that could be pushed out more, because if you're not slowing activity enough, if you don't get enough of that loosening in the labor market, then it can look like inflation's coming down. That might be what the second half of this year looks like, but then you can get some kind of re-acceleration next year, or it doesn't come down enough. Because for the last 2 years, core PCE inflation that the Fed will target, it's just been very stably 4.5% to 5%.
Veronica, what do you think we're going to learn today from Fed Chair Jay Powell, from some of the other central bankers in Sintra?
Yeah, I don't know if we'll hear a whole lot new from Powell. I think it's a relatively hawkish message still. We heard from him last week, of course, in congressional testimony. This is maybe a bit better of a forum if he wanted to, give any kind of guidance. But there really just hasn't been too much data since we, heard from the Fed a couple weeks ago. So I don't expect that he'll sound too different. Probably just, hammering in again that the median Fed official still sees rates moving higher by 50 basis points this year.
How divergent do you think the messages will be from central bankers that are fighting what a lot of people say is a very different inflation fight depending on the nation?
Yeah. I mean, in terms of messaging, I don't think really any central banker has, the ability to not, really hone in on high inflation. That really does have to be the message, whether inflation is caused by, different factors. It is still too high everywhere. And just on a credibility messaging standpoint, that is the goal of all central banks, is to have lower inflation than we are now.
Veronica, thank you so much. Veronica Clark of Citigroup with us this morning here with a steadfast call. They haven't budged one iota, Lisa, have they?
And that's been a consistent hawkish theme, that the Fed has to do more. And they have been right. They said this even through the banking crisis in March. And right now, the market is joining them. That said, rate cuts have been priced out, the probability. But still, people see the first half of next year being a retreat by central banks, by a retreat by the Federal Reserve in the face of likely weakness.
And some of this is the belief of a labor market that continues. I mean, that we get outlandish 4% unemployment, 4.5% unemployment. I mean, that's the game, right? It hasn't broken.
It hasn't broken, and the other aspect of this is the credit impulse and what happens with the banks, and whether we are seeing more restrictive credit conditions than many people previously thought on the margins that will percolate up in a more material way.
Joining us now for a 2-hour conversation, because there's a lot to talk about in her world, is Bloomberg hypothetical scenario correspondent Sonali Basak here on the stress tests. To me, stress tests are a snooze fest, but I see in February the Fed's model here for stress tests is a 10% unemployment rate. Why are we going through this exercise today at 4:30?
I think the expectation here is to test harder, faster as we get into tougher economic conditions potentially. But to the point that you're making here, a lot of the criticism has been, where has the Fed been in testing some of the scenarios that actually had gotten the banks in trouble? Another part of this test that I think is even more fascinating is the trading scenario here, this exploratory market shock. And the reason it is interesting is because the Federal Reserve is going to be changing its stress testing standards, and the expectation here is that trading desks in particular in the future will be facing tougher capital requirements. What does that mean? It has real business model implications. You're seeing trading desks and investment banks kind of hold up better in the market relative to consumer banks that are worried about this economic environment. But if the Fed is stress testing that more rigorously, it means the returns can't be as exciting in the future.
On radio, we're showing up here. Sonali put together this gorgeous 35 logo chart of banks. Lisa, I don't see SVB's logo up there
right. Well,
on the wall.
This is the biggest banks, and that is one big question mark with the stress tests. How applicable are they to some of the regional banks, especially if they rise to, I don't know about systemic, but something of concern for the Federal Reserve? You talk about the nature of the stress tests, and I agree with that. This idea, are they going to talk about what happens if deposits all go away, right? How do they stress test that? What are the likely implications of the results? Is it going to be that they have to raise more capital? Is it going to be that they have to increase their debt issuance? What are you expecting?
There is an expectation out there that more banks will go to the debt markets, really, to kind of boost their buffers here. But there's also an expectation that buybacks, dividends can be pressured in the future. And not just for the biggest banks. There's an expectation that the big trading desks, as we were talking about, might be more pressured in terms of the rate of change here than perhaps the rest of the consumer banks. Actually, Bank of America is expected to have a little bit of an increase relative to before. But the mid-sized banks here, because the bar today is $250 billion and above, those mid-sized banks are really going to be more pressured when it comes to capital return than the big ones.
To Tom's point, is there any discussion about stress testing some of the smaller banks, particularly in light of what we saw in March?
Well, what we had was Fed Chair Powell confirm that they really want to lower that bar to $100 billion. And that is kind of the political uproar, isn't it? If these smaller banks face tougher stress tests, then those compliance costs go up. And there are ripple effects here in terms of how these banks are spending money. There's another interesting thing that's happening here is a greater scrutiny on bank mergers by the Biden administration from the Department of Justice, from the FTC potentially. And if you have that bar lower to $100 billion, does that incentivize banks to want to merge way above that bar?
The history of this, folks, and I remember the clearest memory is standing next to the Bloomberg terminal the first time we did stress tests with the great Otis Bilodeau. And Otis and I are standing there, and, you know, frankly, we're navel-gazing, folks, because we're like, okay, what's the so what? Because this has nothing to do with the reality of how banks fail. We have just had a 6-month disaster. Did you see PacWest, their chart? We've had a disaster in the banks. That has nothing to do with these stress tests, right?
I will defend the stress tests pretty strongly, however. You know, I think about what Marty Chavez had said, former CFO of Goldman, now at 6th Street. And he has not only said, had the stress tests not happened, you would have a lot of runaway activity by the banking system. It forces both the banks and the regulators to just check in and make sure.
Did we check in with the San Francisco banks that were giving out 1% mortgages to take in gazillions of dollars of money market funds?
It's not a complete system.
Why isn't it? That's the key question.
And I think what's happening now is that kind of struggle here on what is the right scenario. You can slap more rules on the banks, but the supervision is also what failed on the back of this,
That's what I was going to say. It's one thing to game out every situation under the book. It's another thing to actually take action to do anything about it. What are they going to do to shore up some sort of more consistency and supervision? Is that going to be part of the discussion today?
Well, I think yes, but I think part of the problem here is it will take years to get there. And by the way, we're getting to another political cycle very soon where some of these new tighter rules could face a lot of rollbacks in any potential future changes.
Help me here, Lisa. I got the surveillance cork in my mouth.
Why are you grunting? I don't even know. I don't even know why.
Okay. Let me cut to the chase.
Go ahead.
I think Colin and Sparta can say that. I can say this on the radio. This is total hogwash. This is just
what is this?
Cover your ass. Regulatory idiocy.
What would Chair Keene do?
Chair Keene would broaden it out to the keyword Lisa Abramowitz just said, which is supervision. And I adore Mary Daly. She's my favorite Fed official. Where were the San Francisco banks during this charade that we had in banking out on the West Coast?
Well, then what is hogwash? Is it the stress tests?
That it's impartially and conveniently applied to people who can pass the stress test.
I feel like Tom Keene is going to get a call from Jamie Dimon right after the show.
No, but
what does this do to James Dimon? That's a serious
Well, a lot of people think it's going to do absolutely nothing because he's already built up his capital buffers and then some. So really the question has to do with the smaller banks that are less subjected.
Absolutely. And so the mid-sized banks are the really ones. And, you know, there's this worry. Raj Cohen worries about a barbell system in the United States. What happens to lending then if you only have the small and you only have the really big?
Across the Bloomberg terminal, Ken from HR says, Tom, we'll see you at 10:05. Shanali Basak, I learned a lot there. That was great. 4:30 today. Stress tests will be stressful at 4:30. Stay with us. Kathy Jones on bonds. We'll do that at 7:30. Good morning.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Climate is one thing that connects everybody across the globe. And if we don't do something about it, it brings down the value of all companies.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
I think that July is a fait accompli. It has been indicated, and it's quite clear. September will depend. What are the factors that are going to determine what happens in September? I think that some of these downside risks have started to materialize and are becoming much more visible. So, this is something that we'll have to revisit in September.
He speaks sometimes with Madame Lagarde, the Vice President of the European Central Bank, Luis de Guindos, at Sintra, at Portugal. Lisa Bramwitz will have complete coverage of the panel today at 9 o'clock. It is 4 central bankers. I guess it's going to be a snooze fest, but guess what? All my radar's up. I really wonder there'll be 1 nugget or 2 nuggets.
I don't think it'll be a snooze fest.
Really interesting to see.
Honestly, even the dynamic between Ueda and the Uber hawks on the bench, Christine Lagarde in particular, is going to be fascinating. Completely divergent monetary theories, but then also Andrew Bailey on the hot seat at a time when those yields on gilts are just surging.
I'm not going to mince words. You alluded to this yesterday. So different from Jackson Hole. This is the ECB confab, which is much more non-academic, much more visible, I would say, with authorities trying to manage the message forward even more so than the choreography that we see at Jackson Hole.
Well, even the place, it really highlights the differentials here.
Yeah.
One is a holiday spot, beautiful palaces, and the other is the rugged Grand Tetons in Wyoming, where you go and stay in rustic digs and focus on big thoughts.
Let me give you one data check right now, red and green on the screen, and that is the real yield. The 10-year real yield is of major focus. Chris Verone and I were talking off air about it. 1.56% on the real yield. It is really buttressed up against the idea, as Veronica Clark of Citigroup mentioned, a newer, stickier inflation regime. Right now, in a summer of discontent for global Wall Street, we can talk about sundry layoffs, except they're of a magnitude that is extraordinary. No surprise with UBS taking out Credit Suisse. Jan-Patrick Barnett has been wonderful about this in Frankfurt and covering that. Yeah, when you were in the banking business, were you ever laid off? Were you ever fired? Were you ever right-sized?
Luckily, I was not at a bank where this was necessary, though during the financial crisis, nobody was really sure if you're going to lose your jobs, and the banks cut down tremendously, especially in Europe on jobs. But luckily also I'm in Germany, and Germany has very tough labor laws, so it needs a lot to get fired here in Germany.
Let me cut to the chase on thousands at Credit Suisse. They really have to speak to Swiss authorities. Does that mean the layoffs will be much greater in London, in New York, in Hong Kong?
Yeah, absolutely. I guess so, especially as Credit Suisse or UBS is looking to cut the investment banking, and those activities are naturally more in those cities and not so much in Switzerland. But overall, I mean, like, this is not very surprising. Remember, we spoke about when Sergio Motti said, like, he's looking for massive cuts, and we pointed out that this usually means like 50% or more when the CEO says something like that. And now we got kind of confirmation for that. It makes total sense for UBS. They need to present some success in this very difficult merger very fast. They need to get down costs. And what's easier than that than to cut jobs as hard as it is for the people involved?
Let's put some numbers to this, that UBS intends to ultimately reduce the total combined headcount by about 30% or 35,000 people. This is a lot of people, a lot of jobs. Do we have a sense, Jan Patrick, of just where we are in terms of who has stayed, how much of the talent they have lost during a process that has been absolutely scathing in some of the commentary?
Well, it's very hard to get into the details, like about the talent who really like is like on the ground floor, on the working on the front line, who is really like the big talent that they have lost or that they keep. We know of some managers that had left, but that is normal in such a takeover. I think, like, from the perspective of UBS, they look at the whole merger right now and think about, like, okay, what do we want to keep, and then we cut all the rest. And what they want to keep is some key people in the wealth management who have like unique client bases that are adding to the pool of clients at UBS. They want to keep some key talent in deal making where they have maybe gaps and stuff like that. But what they definitely don't want to keep is like everything that is back office, everything that has to do with like stuff that can easily be scaled. You don't need another 100 traders to trade you bonds and stocks. The traders you have already can easily do this, especially with the level of technology today. So all these, like, let's say, easy replaceable double positions will be cut off, and that will go rather fast. That's why we are hearing that a big majority of these job cuts will even happen this year.
When will we get stability in this combined unit? And I say this at a time when not only are there potentially 30,000 planned job cuts, but also we're hearing about ongoing withdrawals from the Credit Suisse unit.
Yeah, absolutely. That's a difficult question to answer, I would say. Like, definitely not this year. I'm very skeptical about it even for next year or even for 2025. Because the thing is, like, we get like probably like more stability, I would say. But the absolute stability is still a long way from here, because we know, like, these big mergers, it takes forever. And then when you have solved one issue, then probably another one comes up. And we don't know what the market will look like. How will client sentiment behave in the next 1 or 2 years? So this is all going to be figured out. The outflows will probably not like happen once, but will be gradual from those clients who feel like that they have to split up their money if they have been a client of UBS and Credit Suisse. So looking for real stability here, that's a very long-term goal. It won't happen fast, but I guess like that we will see much clearer by the end of the year how the bank will look like and how the further steps will look like.
We've been talking all morning about the 9:30 a.m. Eastern panel in Sintra with all the central bankers of the major economies coming together and talking about their plans. We've been hearing about members from the ECB as we came into the segment, potentially raising rates several more times, even after getting rates to the highest levels going back decades. How will that affect a combination, a merger like this? How will this affect just the banking sector in general, that this is actually a positive development for, but it's happening very quickly?
Yeah, absolutely. And we have this like contradicting or in opposite pulling directions factors here for the banking sector. On the one hand, of course, we have like, especially here in Europe, coming out of this very low interest rate regime, which is like increasing net interest margin by a lot for many of those European banks. On the other hand, we still don't know how deep the cracks in the real economy will be in Europe, how badly the refinancing of companies will look like, and how will this affect credit quality going forward. So it's very difficult to say how this is going to play. And I'm not sure if we have seen like the wobbles we have seen in March. I'm not sure that has been the end of the banking story.
All these people laid off, what will they do? Where will they go?
That's another very difficult question, because in Europe, again, we have the theme of like reducing job cuts, reducing headcount for over 10 years now. And of course, there will be some banks who feel like, well, if UBS doesn't like that business, we are keen to take it on board. It fits well to us. And maybe they hire a team here and there, hire individual people here and there. But for the majority, I don't think there's much that other banks are keen to take on board here. And that also means like that for those people who are losing their job, it's not going to be an easy time to find the same job at a different bank.
I mean, very quickly here, we had the CFA results yesterday, people doing better out of the pandemic on the level 1 exam. Are fancy educated people in the global Wall Street business? Are their days numbered? Is it generalization, or is it just tougher?
No, I wouldn't say so. I would say it's tougher. But I guess smart people have a good education and who are willing to switch their career path and say okay, if trading doesn't work anymore for me in whatever shape or form, then I'll do something else with my brain. I guess they will always find a job. It's just going to be different, and you have to adjust your life for it. That's for sure.
Yeah, I'm Patrick Barnett. Thank you for the brief. Just really something. Lisa, it's a frightening thing. I mean, you talk about obsolescence. Are all these fancy jobs obsolete? Because this is not just about Credit Suisse. You mentioned the numbers. It's on, I guess it's what it is. It's a bankruptcy merger, just to make a long story short. But every other bank is doing the same thing on a more smaller basis. I mean, you really wonder here. You say to a kid, go get a CFA, you'll love it. I'm serious. I'm talking my book, but,
At the same time, you have stories like the one that came out yesterday about how interns on Wall Street are making $120 an hour if they work at Citadel. Yeah. So, it's sort of what talent. And this goes to the point that Gina Rometty was making, which is that when we talk about artificial intelligence, when we talk about some of the rapidly changing backdrop for technology, how do you train people to keep up with that in a way where it can augment their abilities, their knowledge, their past, rather than make them obsolete? And I really do think there are still people getting hired. We talk about that all the time. But there are changing roles within Wall Street and more broadly within the labor market.
Pulling out the Bloomberg HP 12C calculator. There it is on TV. You can see it there. It's on my phone. Lisa, intern, 55-hour work week. $6,600. Yeah. So you're popping 14 weeks at the shop? That's $92,000 by Labor Day?
Yeah, I was talking with the offspring last night, and how young is too young to get a job on Wall Street? I was like, please, just, finish your homework.
Jean Patrick Barnett there from Frankfurt. He's really been helpful on the travails of Credit Suisse. Red and green on the screen, Sintra in the 9 o'clock hour. This is Bloomberg. Good morning.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
New York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a six-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So $1 there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
From our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
I think it's just going to take time for people to get used to higher rates.
5.25 is enough. I don't think we need to go much farther than that.
If we're going to have a recession in the second half of the year, it's going to have to come from the consumer side of the market.
Economists have us starting a recession in just a few days in the third quarter. You don't see that in the earnings forecast.
The Federal Reserve has basically told us the only way out of the inflation conundrum is to have a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television, on a most interesting Wednesday that we have. Not much economic data this morning, but maybe economic discussion in central Portugal. We had Francine Lacroix yesterday with Guy de Gopinath, and today we'll have Lisa Abramowitz with the governor of the Bank of England, the governor of this, the governor of that, and the chairman of the Federal Reserve System. It's an annual event. It's going to be interesting what they do say, and also interesting, Lisa, what they don't say.
And how divergent their messages are. It is not going to be me on stage with them, just to make it very clear. I will, however, be watching it. We'll be showing it. To me, the question really is, do we get some greater hawkishness than we've already gotten, which has been pretty uniformly, putting aside the Bank of Japan, hawkish? How do we then translate that into a market that's been already hearing that? Have we already priced it in, or is it going to get repriced, Tom?
And the repricing, well, if the data screen this morning, to cut to the chase, it's pretty quiet out there. There's some little niceties, but it's pretty quiet out there. To me, I'll be fascinated how the three of them talk theory and monetary ecobabble, with the one guy, Bank of Japan over here, it's like Sesame Street, folks. One of these doesn't fit with the others, whatever the phrase is. I mean, the Bank of Japan is the outlier here.
Well, they're going to continue to say that yield curve control is important, even as we see the expected inflation creep up. I believe the expectation is for 3.6% at the latest read. And they're looking at keeping rates near zero at a time when you have the Bank of England really fighting inflation in a very different sense, in a much more significant and painful sense. And the ECB doubling down, possibly 2 more rate hikes. How do we really factor that in at a time when we never thought that they could get beyond zero?
For Global Wall Street, we've got a really important guest coming up, so I'm going to get to the brief. First, the data check. Red and green in the screen. Futures at -5. The yields are in today. I mentioned some interesting data points. I'm going to cut right to it. The 10-year real yield suddenly signals a stickiness to inflation, 1.55%, not through to a breakout to a higher regime of an inflation-adjusted yield, but nevertheless buttressed up at 1.55%. And the other is China, 7.25 print earlier, 7.24. A very weak Chinese yuan, and this is Chair, look at me, Chair Yellen. Maybe she'll be at the panel today as well. The Secretary of Treasury will travel to China here at some point. At least I butchered that data check.
A lot of crosswinds there. As you were mentioning, 9:30 a.m. really is the main event today with the panel in Sintra with the 4 central bankers, the Bank of England, the Federal Reserve, the ECB, as well as the Bank of Japan. We will be seeing if there's anything that comes out of that. 4:30 p.m. We were just talking with Sonali Basak about this. We do get the stress test released by the Federal Reserve. Tom thinks that they're a snooze fest. I personally think that it's going to be fascinating to either put to bed once and for all the concept of a banking crisis or reignite concerns about what the Fed is looking for in terms of a crisis. Tom, we can talk about that and debate it. I think it's important. And after the bell, Micron is reporting earnings, and this comes at a time where, in general, the chip makers are selling off after President Biden indicated that he was going to crack down and harden some of the export restrictions for AI-related chips. This is fascinating to me. I know this doesn't seem like the main event, but to me, given the leadership in the market so far this year, this is a major issue.
It's going to be interesting interesting to see, to say the least. Lisa, on the earnings front here, when we've said it's going to be a very different quarter, and we start early with Walgreen Boots Alliance yesterday and Delta. Generous Mills, GS, out with a dividend lift, a 9% dividend increase, positively European.
Yeah, although interesting to see that we're not necessarily getting the reaction that one would expect. The share's down 3.5%. So even though they beat expectations, this to me is the question.
Yeah.
Well, then why are we not seeing a better response?
Organic net sales, and maybe this is the shift, Lisa, that we're going to be listening for, where a lot of the good news on earnings was from price increase, inflation, the generous lights of inflation helping at the revenue line versus unit dynamics, how many boxes of Post-Toasties or cornflakes for their competition were sold as well. Right now joining us is Wei Li, Global Chief Investment Strategist at BlackRock, and there's always 14 things to talk about. I really want to lead with Secretary Yellen into China and what China means within an investment strategy. But I got to rip up the script here. There's a guy named Fink who's talking about something BlackRock has led on. You've been directly involved with this, which is the value, the efficacy, the usefulness of ESG. Larry's come out as a real proponent of talking about it and said it's been a challenging time out of the pandemic. Color for us how you are reinterpreting ESG right now within your investment strategy.
Well, sustainable investing is investing, right? We're incorporating considerations around the impact of climate in our capital market assumption. We're also thinking about how the transition could look like and really thinking about how that then is reflected in portfolio construction, to what extent it is really in the price. So as we think about transition as one example of mega forces, what we're doing actually in this media outlook that we're releasing today is that we're prominently highlighting a few mega forces, including sustainability and transition to net zero, but also including geopolitical fragmentation, including aging demographics, including AI, to really incorporate those mega forces in portfolio construction.
As you put the review out, 2 days left in the first half of the year, what changes for you in terms of your positioning after 6 months of being really cautious?
Well, I think the biggest change is as we think about kind of the environment where yields have risen, is that we're actually within fixed income excited about opportunities across the spectrum. So we have been talking a lot about front end of the curve, which we still like, but we're actually also putting cash to work across the broader exposures in fixed income, including MBS, mortgage-backed securities, including inflation-linked bonds, especially in the US, and also including high-grade credit and local currency emerging market debt. And more broadly, as we think about what has changed, we're rolling out the new investment playbook where the first layer is around macro-based asset allocation, but macro can only take us this far in this environment of supply constraint. So we're also thinking about having the second layer of very granular, uncorrelated, individual investment opportunities to overlay on top of the first layer. And then the third layer is the mega forces that I just talked about.
Where is the idiosyncrasy of artificial intelligence in the overlay that you talk about?
Well, so far, if you look at markets this year, it's been a very narrow thematic markets, right? So that has taught us that just base asset allocation on macro assessment alone is not enough anymore. So far, we have talked about a bias towards quality, a tilt towards quality in our U.S. equity allocation. But what we're doing differently at this media outlook is to break that out and explicitly call out a conviction in developed market AI, which we have had indirect exposure towards, but now we want to call them out explicitly because the interplay between the cyclical framing and the structural mega forces is so complicated and nuanced that we cannot afford to muddle them and mix them up together.
Your essay and outlook here is a view from 60,000 feet. It is very macro. It is very big picture. And in the middle of it is a massive micro reality. You say that the pandemic supply constraints that have affected the world will have a persistency, that they will be permanent in some way. That's a stunning statement. Why can't we get back to supply-demand normality?
While some of that supply constraint is pandemic-induced, but a lot of that is getting washed out in terms of the cyclical pandemic-induced supply constraint. But what we are putting out, which we have been of the view for a while, is that we're moving away from the last 30, 40 years of great moderation characterized by demand shocks to the current environment characterized by supply constraint coming from structural forces like the net zero transition, like geopolitical fragmentation, and also aging demographics. And what that means in the context of this week being the Sintra week is that when it comes to central bank policy, during the Great Moderation, because of the structural disinflation, they were inclined to keep policy easy and
come on,
come
they
to
had
the
a free
rescue.
lunch for 15 years.
That was easy. And then now they're in an environment where they are actually, they need to keep policy tight in order to lean against this inflationary pressure.
Mathematically, what we've got here is we finally got to return to a risk-free rate. We've got a legitimate Sharpe ratio, without question. Some of the traditional dynamics you and I studied in books. What does that mean for the Sintra panel today? What are you going to listen for from these people about their new reality, which is a reality from 17 years ago?
Their new reality is the reality from maybe even 30, 40 years ago, right? Because the Great Moderation is over, including the period after after the global financial crisis. So what I will be paying attention to is to understand if they acknowledge the trade-offs facing them, which is that the cost of fighting inflation in a supply-constrained environment is a lot higher. So if they acknowledge that, and also number two, what are they going to choose when faced with this stark trade-off, growth or inflation?
There's a real tension when you were speaking. Is there a possibility for markets, for U.S. equities to rally, even if we do get a recession, and even if the Fed does become very hawkish, and we get that? Is that what you're saying, that you could still see the market respond in an untraditional way to a central bank-induced slowdown?
Well, U.S. equity markets currently, the broad market is still pricing in earnings to accelerate in the second half of the year, which in the context of growth slowdown is too optimistic, which is why as we think about asset allocation for the broader market, when it comes to U.S. equities, we have a -1 out of a scale of -3 to +3, and translating that into portfolios, global portfolio, U.S. equities, the benchmark is around 33%. This -1 modest underweight translates to about 31%. So we're invested, but we're modestly underweight. Right. Now, having said that, there are themes that we would like to embrace, such as artificial intelligence. So we kind of add that on top of the broad market underweight, modest underweight, to get to closer to neutral, but not quite there, which is still modest.
Whaley, thank you so much. With BlackRock. Right now, S&P futures down fractionally 0.1%.
That was fascinating, Tom. What Whaley was just saying there really just struck me as highlighting the difficulty in coming up with something completely macro without taking into effect some of these other issues like artificial intelligence, like what companies are going to benefit from deglobalization, reglobalization, whatever you want to talk about. To me, how much is this going to be the new playbook that might harken back 3 or 4 decades earlier than the one that we've gotten used to with such central bank-dominated action?
And not that history will repeat itself, but I would take the macro dynamics that we just heard from Whaley, and I'd overlay it with the micro Chicago dynamics of Jeff Curry that we heard from Goldman Sachs, where he said, look, everything in hydrocarbons now is still based on the new reality, which is a legitimate real yield, a return to a legitimate rate structure of some time. Granted, there's massive curve inversion now, but the macro structure of BlackRock is adapting to the end of the Great Moderation. That's a huge macro theme for us for the next 6 months, if not a year.
And it causes some micro headwinds and tailwinds, and that's sort of the underpinning here. When you also have real invention. You actually do have new realities with relationships geopolitically. How do you interplay the idea of the end of financial repression with some of these new trends that are very real and causing real market reaction?
You're going to buy the virtual reality thing from Apple? Is that going to be the new technology?
At home, there are people in the Brammo house that say this is the future of computing, and if we don't buy it, we are going to be behind. And I say, go get a job, and then you can pay for it yourself.
I just wish we had voice so we could worry about this garbage. They don't care. They don't care. Red and green on the screens. Stay with us. This is Bloomberg Surveillance.
Was going to keep rating World Cup. This is a 3 as the economic picture does.
The OK is getting ready to make a decision.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Moment news breaks. No one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
What we've seen in the actual data has been a lot of resilience. We've actually seen that stretch of a strong labor market improve due to the very large increase we've seen in participation of working age Americans. And so there are reasons to think that we are going to continue to see resilience against a backdrop of what we have referred to as more stable economic growth.
An optimistic tone taken by the National Economic Council Director, Lau Brainerd, formerly of the Federal Reserve System. She's getting a little more visible over there, to say the least. How about on the chances of a U.S. recession? At the White House press briefing, the president echoing Brainerd's comments at a fundraiser saying, quote, "It's been coming for 11 months. Well, guess what? I don't think it's going to come. I watched Bramo, and Biden says it's scheduled. You know, he's going to give another speech today at 1 p.m. after Sintra. I mean, this is good news for the White House, right, Lisa?
It is good news for now, and the tension right now is that if he gets a recession now, he could clear it out by the time he runs for re-election. If it comes around that time, it is more likely that he will be a one-term president. So if we have just simply excised any kind of downturn from the equation, well, that's good news, Tom, unabashedly.
Let's take on this trend now of our economics. We'll try to get to Russia with Anne-Marie Horton, our Bloomberg Moscow correspondent. And joining us from Washington today, as always, of course, the star of Balance of Power as well. Anne-Marie Horton, I look at the good news in the economy and is out in the Washington zeitgeist this morning. Why is this administration having so much trouble selling their success?
Well, the issue is the American people just don't feel it. When you look at poll after poll, Biden continues to get poor remarks in the economy because of high inflation. Remember, Biden said that he thought inflation would be temporary back in 2021, but then, of course, Americans suffered for years higher inflation. And while Americans are having a lot of jobs, we see a very tight labor market, you don't always feel your neighbor getting a job, but what you definitely feel is higher grocery bills, higher hotel bills, higher plane bills, and this is why this has been a struggle for this administration. So what they are trying to do is get back this term Bidenomics, which I think came first from a Wall Street Journal editorial months ago. And what they want to do is frame it in their own terms. And I've asked a number of them, how would you define Bidenomics? What does this actually mean? And what they're trying to sell is all the legislative wins they've had. And really, I think it comes to the core about expanding the productive capacity of the United States. What they want to do is make sure they are investing in hard infrastructure, in chips, hundreds of billions of dollars, and things like clean energy. Their biggest issue is that when all of these projects come to fruition, it is not going to be in time for the presidential election in November of 2024.
Emery, I think of the zeitgeist, besides the return of Aaron Judge helping out the Yankees, in the late June zeitgeist here, there's a clear understanding of the polarities and subsections of the Republican Party and how Mr. Trump is still doing so well in the polls. I hear basically silence on the left. What are the polarities and what is the key constituency right now voicing Democrat politics with their incumbent president?
Well, they're rallying behind Joe Biden. Many Democrats still believe that this is an individual that can, if it was going to be a rematch of Trump versus Biden, that Biden would still win. What is concerning to some, and potentially this concern will grow, is this latest Morning Consult poll yesterday that showed that actually for the first time in a poll, Trump could beat Biden. That is a concern, but at the end of the day, they are all still rallying behind the current president, and they do not have anyone that is out there looking to also get in this race. There are potentially people waiting in the wings, like some certain governors, if the president decides he will not run. But at the moment, he is planning to take on 2024. And that is exactly why they realize their low marks when it comes to the economy, why they're going on this huge effort with this speech today in Chicago, and this will continue to frame and talk about the economy and labeling what they see as Bidenomics.
Meanwhile, when domestic politics get overcome by geopolitics, and that's something that we've been trying to put against each other all morning, talking about Treasury Secretary Janet Yellen heading over to China at a time when the U.S. is coming out potentially with more strict requirements on not exporting high AI-related chips to China. Why now? What is sort of the push-pull right now of greater diplomatic actions paired with potentially more restrictive export bans?
Well, this is going to be the tightrope that Secretary Yellen has to walk. And this is a scoop from myself and Jenny Leonard that she is going in early July. Also, at the same time, the administration is ramping up their work, not just with the Wall Street Journal's reporting about export controls on some of these chips needed for generative AI development, but also on the outbound investment. They have a goal and an aim to try to get that done by the end of the July. Very awkward conversations, I would say, for the Treasury Secretary as she makes this inaugural trip in that position to Beijing to meet for the first time her brand new counterpart, Chinese Vice Premier. This is a new individual, He Lifeng, and he was given this job in March. What we're seeing is the U.S. trying to do both. They want to make sure they have this open dialogue with China, but at the same time, they are looking at this competition and putting restrictive measures on some of these very high advanced applications that are needed for things like AI. Everyone is talking about the fact that AI is going to be a massive race between China and the United States. We have a story out this morning talking about the fact that many in China do see themselves behind. When you look at the money that's used in AI, the United States absolutely dwarfs China. But when you're talking to people in China, what they say is that, yes, they're behind, but they think they have the capacity to catch up.
Just quickly here, Anne-Marie, dovetail this back to the domestic politics of the moment, the idea that, in general, people want to see more hawkish rhetoric around China. That has been what has appealed to voters in the U.S. How much do we expect some of the bans and the hawkish rhetoric to increase heading into the election season?
Oh, it will for sure increase as we head into 2024. Every candidate is going to have to come out when it comes to foreign policy and make remarks regarding Russia and make remarks regarding China. We've seen some of them already stumble when it comes to Russia and have to backtrack. I think it'd be very difficult to see anyone stumble when it comes to taking a harder line or as hard line as they could when it comes to Beijing.
Emery Horton, thank you so much. Greatly appreciated this morning, our Chief Washington correspondent. Look for Balance of Power tonight, including a briefing on the events from Russia as well. Red and green on the screen right now. The 10-year yield, 3.74%. Chris Verone, really shocking there, up 4%. You wonder what that'll do to the economy. Torsten Slok, every day putting out a chart. He puts out like a single chart every day. And I would say they're always brilliant, but about every 1 out of 8 or 9, 10 days, it's like, are you kidding me? He just put out an "Are you kidding me" chart. I've just barely looked at this, Lisa. Weekly bankruptcy filings. There's a 4-week and a 12-week moving average. We're almost back to 07, 08. I had no idea.
What it shows is that the 4-week moving average, when you look at it on a weekly basis, the bankruptcies are ticking up much more quickly than when you look at a longer-term rolling trajectory. What this signals is things can move fast. The economy could roll over in a much more rapid way. And you know, not saying that that's what's happening, but that is the tone underneath some of the pessimists out there, some of the bears saying, just wait. Things can turn very quickly. Whether that's the case or not, whether this is micro data that points to one reality and paint the narrative that you want using data that points to better than expected consumer sentiment or a housing market reviving, either way, this is the nature of how people are parsing the data to try to understand the true story.
And what's interesting is I don't think we'll hear this today at Sintra. I think the fact is we have theory and analysis, like we heard from Wei Li, which is wrapped around one aggregate idea. Well, there's not an aggregate America. To be kind, there's Torsten Slok bankruptcy America, and there's somebody figuring out how to get on a Delta flight to Paris, but it's sold out. I mean, it's like two Americas.
And one inflation number that they are heading after, a very difficult time for them.
Stay with us in the 9 o'clock hour. Sintra, Lisa Bramowitz will have that for you. This is Bloomberg. Good morning.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. You know, I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that, peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Bloomberg surveillance. Oh, you should have the cameras on while we're on break. Lisa Abramowitz discussing with us how benevolent she's been with Mrs. Abramowitz Sr. over the years. You had to be here to see it. We should do that. We should big little, like the sports games do.
Yeah, then I think we'd probably restrain ourselves a little bit more. Maybe not.
Probably we would. Let's do a market check and save ourselves. That's how you save yourself on Bloomberg surveillance. Look at equities, bonds, currencies, commodities. I'll try to be as good as Karen Moscow on Bloomberg Radio. Red and green on the screen. Futures in -4. The yields, 3.74%. Yields are in a little bit, but it's been that range that Christopher Rohn was talking about earlier. He models out a 4% yield. We're distant from that. Oil really has my attention. We are under $68 a barrel, and critically on Brent crude, we're under $73. This is important, 67, 69 on American oil. Brent crude, 72.24. You go down $3, you're under $70 on Brent crude. That would be the shock of the quarter. As well, in the currency space, Lisa, help me here. I got 4 pairs to look at for 4 central bankers on a paddle in Sintra, and I'm getting no love here from the markets. I'm getting no pre-sell here. Maybe sterling a little bit weaker, 126.97. Is that about what I got?
That's about what you got right now. A little bit of euro softness versus the dollar. But what we are seeing, hands down, the clear move is a weaker yuan near the weakest level since November 2022, as that nation tries to have a more controlling role in the economy, in markets, at a time when there are a lot of questions around what's going on there.
Lisa informing me this morning, hey, stupid, NVIDIA's out today. And that's what you're looking at.
Well, NVIDIA is in the news today. It has been in the news because it's up 187% year to date. But other than that, it's also in the news because the Wall Street Journal put out a story overnight saying that the Biden administration is continuing new restrictions on exports of artificial intelligence chips to China. This would very much concern NVIDIA, considering about 1/5 of their business is sales into China. Those shares lower by 3%. But this comes after a rally that has just been astronomical. To give you some perspective, their market cap was $351 billion at the start of the year. It now is over $1 trillion. What could this do to them longer term? Is this going to be a momentary blip or something structural at a time when this is still speculation and could be rolled out coming next month? AMD in that as well. Those shares lower by about 3%. Those are the two main companies that would get affected by some sort of restriction on this front. And I find this fascinating, considering that they are the leaders in this market. They are the drivers of a lot of the gains we've seen.
But to what Christopher Rohn said earlier, they have to, Louis Giamatti great phrase, consolidate. It's nothing wrong with going up like a moonshot and then consolidating for, dare I say, quarters.
Well, consolidate is one thing if there is no change in the news. We saw artificial intelligence change the narrative. Yes. Now, do we see some sort of geopolitical tension change the narrative once again in terms of earnings potential? The other company that I'm watching is Micron, because they're reporting earnings after the bell.
Chip today.
To me, this is going to be a really important earnings report. This is the true test. Are we actually seeing the revenues and the sales to justify some of the gains that we've seen year to date? Micron lagging behind the others because it doesn't have as much of a focus in the AI tech, but those shares still up 34% so far year to date.
Price in unit on revenue, and I'm really looking at unit dynamics as we go into the earnings season of the banks, of technology, and of course of everything else. General Mills out with a dividend increase here earlier this morning. Right now, we increase our knowledge with Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy, I'm just going to cut to the chase as well. Am I clipping a coupon, or can I dream of total return out the next 12 months?
Oh, I think there'll be some total return in addition to the coupon. I think most of what you're going to get is the coupon. But when I look at where we're priced now, I think that there's some room still for yields to fall. Not a huge amount, especially if the Fed continues to hike rates. We'll just seeing more and more curve steep inversion. But I think that there's some room, and especially if you go in the investment grade corporate bond space, there's a pretty good room for some spread tightening there and some appreciation.
Help people that haven't bought a bond since Nixon was president. What's the yield I can capture on a general vanilla IG piece?
So I look at the Bloomberg index, and
for that she can stay.
The corporate index, it's well over 5%. It's probably roughly around 5.3% today. That's not a bad yield to lock in. You probably have a duration of 6 or 7 on that, but that's not a bad yield to lock in on IG.
So that's a money market yield for 6 or 7 years versus 13 months. Or 12 months. That's the shell game, right?
That basically,
I did okay there?
That's fantastic. Basically locking in those coupons that maybe you can get today in cash, but you won't be able to get maybe in 3 years, considering people are expecting rates to come in eventually. Herein then lies the question of the Torsten Slok chart that we were talking about earlier. Bankruptcies ticking up in a more substantial way, especially if you look at a more micro basis, a nearer term type of time horizon. How does that affect the credit proposition at a time when people are not prepared for a wholesale default cycle akin to what we've seen in the past?
Yeah, it's a great question. So it's one reason we've been cautious on high yield, even though high yields performed very, very well because, the coupon and spreads have been pretty tight. But it's reason to be cautious on lower quality credit because we are in a global tightening cycle. We are seeing softness. Corporate earnings have not been all that strong, when you look at the broad economy. And there's certainly going to be, especially the further down you go in credit quality, going to be companies who are refinancing is costing them 2 times, 3 times maybe what they were previously paying in interest, and that's going to trigger some defaults.
Which really raises the issue of how long central banks plan to hold rates high, and how that is so important at a time when a lot of companies have termed out some of their debt structures and won't have to borrow for quite a bit. When is the pain point in terms of a wave of maturities that have to be refinanced that could cause companies actually have to pay the rates that we're talking about?
Well, you're already starting to see it on the edges, but again, lower quality companies that have to refinance frequently in the bank loan space, you're already seeing it there. You would probably have another 6 to 12 month time frame for higher credit quality companies, and we're not really worried about a huge default cycle in IG, but I think eventually it catches up, right? Eventually, especially if the equity market doesn't allow you to refinance by issuing equity to offset some of the increase in leverage that's been taken place over the last couple of years.
I look at the bond market, and Lisa's expert on the distress in the high yield place, and I remember the comfort of just owning corporate bonds. Are we ever going to get back to that where the street wants to own corporate bonds, or are we completely now beholden to a full faith and credit discussion?
Oh, no, I think we've seen a lot of demand, again, in the investment grade space. We've seen a lot of demand from institutional investors, a lot of the mutual funds, a lot of the pension funds, et cetera, looking
Is there a shortage of IG bonds?
I don't think there's a shortage, but the balance is pretty good when you consider the spread is over treasuries is fairly normal in terms of historical averages. I would say we're a pretty good balance right now.
You mentioned a 6-year maturity. Is that sort of the center point tendency on a barbell strategy, or can you nuance that to 5 years or 7 years around the belly of the curve?
Yeah, I'd rather be a little bit longer on a barbell, maybe 7.
Like 20 years out so I can pick up 8%?
Yeah, there you go.
Okay.
Well, look, as we talk
Sir,
to people,
you don't want a 20-year
No.
Sir, if I'm wrong, you're crushed. Thank you, sir.
We're 2 days away from the mid-year point in a year that has been full of dashed expectations in a lot of ways. People came into this year talking about a longer structural shift upward in inflation. Now we talk to an increasing number of people who say we are shifting back to what we knew before. It's just taking a little bit longer. Where do you stand on this at a time when we do see nodes of disinflation in certain areas, but reinflation in others?
Yeah, I would be in the camp that's saying it's just taking more time. It's very difficult to see that we have a global tightening cycle, higher cost of capital, and we have had a slowing economy. We have top line, goods prices falling, and it's hard to see that if the central banks continue to keep real rates high, that we're not going to see that inflation come down. I think it's just a matter of time. It would defy expectations. You'd have to have maybe a massive fiscal policy shift, and right now the fiscal impulse is negative, not positive.
And a lot of people will say, just look at the yield curve. It implies recession. It implies downturn. And then there'll be 10 people who will message me and say, it's broken. It's not actually telling us anything because this is a new regime and a new post-pandemic reality. How do you fight against that, the idea that some of these indicators are broken given a macroeconomic backdrop that's unheard of?
Yeah, I mean, look, it's complicated, right? And we haven't been in a pandemic in 100 years. And so I think, every cycle is very different anyway. But I wouldn't count on the yield curve being broken. I mean, all it really reflects is the market expects growth to slow, inflation to come down, and the Fed to ease down the road. That's really all it's telling you.
I mean, I look at bond allocation. In the heart of all of our conversations at a mid-year review is a reallocation of a 60-40 split. Are you and Liz Ann Saunders on the same page on what that split should be?
Yeah, we don't specify because
it's a very 60-40.
60-40 to us is a good place to start for people, but everybody's allocation is going to be a little bit different. But this year, coming into this year with bond yields up, I think 60-40 is not a bad place for kind of the vast majority of people with a long-term time horizon.
What is the public doing? Are they buying the story or are they all in cash?
We have such a range of investors, but we have a lot of people still very short and in cash who are gradually starting to edge out now that yields have been more stable for a while. On the equity side, we have a lot of people interested in trading, and so there's been a lot of that, but mostly people are holding steady.
Kathy Jones, thank you so much. With Charles Schwab this morning, I think it's fascinating, Lisa, how the media's full faith in credit, or the drama of 8% oil debt that's going under, in something in the middle that's boring that clips a 4.5%, 5%, 6% coupon. Nobody ever talks about it.
Yeah, but everyone's buying it. I mean, if you've seen this flows into some of the investment grade bond funds, people have just been piling in because it's the sweet spot. You get a little bit more, you lock it in for a long time, and who's going to deny the fact that Apple's going to be able to keep paying their bills for a long period of time? So this has been one of the sweet spots, which raises a question: how do we account for this potential wave of insolvencies, the potential credit distress that's implied by the tightening in conditions, as well as what we're seeing in the yield curve?
I get huge use out of the Bloomberg Total Return Indexes, the heritage of the Lehman and the Barclays series that Bloomberg has now. And I just wonder how you get price up, yield down on those indexes, how you break through to some form of real price recovery. We're waiting on that. We haven't seen the disinflation to get there. The VIX 13.80, Standard & Poor's 500, it's down 0.1%.
Yeah, and one of the key questions as you're talking about how do we get there is, well, if we don't get a recession, if we don't get a real wave in bankruptcies, then suddenly you could end up in a better than expected situation. And a lot of that's being driven by AI, but also other stories on the margins.
Right now, this from the Detroit News, serving Michigan since the last time the Tigers won 3 games in a row. Detroit surpassed Chicago, Chengdu, Delhi, and the rest of polluted America. It's back. This is something we haven't talked about. For our international audience, Lisa, we don't want this to move east, do we?
No, we're talking about the fires in Canada that are continuing to rage and continuing to cause bad air to percolate into Detroit, into the Midwest. You saw Chicago, some of those views
Windsor,
along the
Ontario,
river, around the lake.
Toronto,
It's also shifting to Europe. We've also seen some of those maps push the smoke all the way over to Europe. It's frustrating and it's scary because when you have to wear a mask and you can't exercise outside, it does feel something.
My arch question is, okay, so we've got this. We had it 3 weeks ago. It cleared. Now they have it. I guess it's coming this way, is what they're saying. Why wasn't it here last year or the year before? I mean, it seems, do you agree with me that it's sort of something new?
Well, this is the worst fire that they've had in a very long time. So it is burning more acres, and that's part of the reason why.
Really, really something. I just looked at the numbers that I look at on my app on my phone, and Detroit really front and center on this. The Canadian wildfire here, and as we suggest, maybe moving east, and we'll do a redux on this in New York in the coming days. On the American economy, on Chairman Powell, Kathleen Vestjancic, nationwide. This is Bloomberg. Good morning.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Climate is one thing that connects everybody across the globe. And if we don't do something about it, it brings down the value of all companies.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Still stick with tech names. I do think that NASDAQ is getting a little bit overbought. If you look at the CFTC data, we're hitting new highs on NASDAQ mini positioning. That being said, I don't think you have to sort of throw all the growth stocks out at this point. A sector like communication services, where a lot of the internet names are, those earnings revisions are starting to weaken. They're actually staying stronger in tech proper.
Lori Calvasina of RBC Capital Markets there. Really interesting nuance. Her focus is mid-cap, small cap, and sort of, I'll call it value-ness, not growthiness. And it's been a really interesting year reading Calvasina. To me, Lisa, what's so important about someone like Lori Calvasina is the dynamic week to week. Like a John Stolfus is the same way. Ben Laidler over at eToro. The dynamic, the way they change week to week is very cool.
And how much it relates to sentiment. At the beginning of the year, everyone was bearish. The world was going to fall. We were going to get recession. And Lori Calvasina has been looking at data, AAII investor sentiment data, that shows people are getting more bullish in their sectors that even look overbought. So even though she's positive, she's getting a little bit concerned about how heady things have gotten a little bit.
We'll have to see on that. Right now, we're going to dive into a conversation which is really interesting. It can be a nerd fest, and we're going to try to avoid that. Mandeep Singh joining us now with Bloomberg Intelligence. And I want to talk the substrate of it all, Mandeep. I'm old enough to remember, Mandeep, that the way you started a cocktail hour to talk about your world was somebody would walk in with a substrate cylinder that would become silicon wafers. This is an IBM patent from years ago, coming off MEMC son Edison, ancient technology. And am I right in the NVIDIA world, Mandeep, that the wafers have just gotten thinner and thinner and more productive and more efficacious? Is that true?
It is, and right now we are in that sweet spot when it comes to the product cycle for data center chip demand. I mean, really, a 40%, positive revision, what we saw from NVIDIA last earnings, is a reflection of just this profound shift that we are seeing, in terms of the refresh cycle as well as the new demand. But at the same time, you always have these negative news around sanctions and what it could do, because it's not a low probability event anymore in terms of what it could do to both China and market as well as the supply chains that are tied to it.
Mandeep, taking a step back, the Wall Street Journal reporting overnight that the U.S. was thinking about possibly restricting exports of certain AI-related chips to China, that this could come as soon as next month. NVIDIA would be among those most affected. How much would that dampen their market valuation? Let's just say this did go into effect. How much would that strip away from the nearly 200% rally we've seen year to date?
Well, so, I mean, let's maybe focus on the fundamentals right now. Clearly, the data center demand is everywhere, and it's across industries. I think what they did the last time around when sanctions were imposed, for one of their chips, is they came up with a low-performing variant. And the focus of these sanctions so far has been on the leading-edge chips. And so you can work around it. They've been very agile in terms of coming up with ways to, keep selling to that end customer that is in China. And as long as I think you don't see a material decline in their sales, they probably will keep working around it. But look, as I said before, this is not a low probability event anymore. And China risk is huge when you think about, the political cycle and elections coming up in Taiwan, in the U.S. I mean, this could escalate, and I think that's where investors have to be very, given the multiple expansion we have seen this year.
So what are you looking for? How do you play this, Mandeep? You said investors have to be very careful at a time when there is a lot of hope around AI and the promise of it. So how should investors be careful? How should they monitor this? How should they even understand what the tail risk could potentially be?
Yeah, so look at, the sales exposure to China. It's at least, 20 to 25%. And look, not all the chips are used by Chinese end customers, but you can think of, all the different SKUs that NVIDIA makes, especially on the data center side, that are more exposed to the sanctions. And if we have something like what happened to Russia in terms of, broader sanctions, that could be huge, especially for the semiconductor makers. And look, NVIDIA is not the only one. You will have the semi-cap equipments. That's a big focus for, sanctions. So clearly, they have to figure out ways to both diversify their supply chain. Can these chips be, assembled somewhere else outside of China when it comes to the end product and things like that? So the supply chains have to move quickly, and I don't think it's going to be as good for the pricing we've seen so far.
Mandeep, when I look at this industry, can we say that maybe like the airlines years ago, they've learned the value of persistent free cash flow and that they're more financially responsible than they were 10 years ago?
I think in the case of fabless chip makers like NVIDIA and AMD, I mean, they have a very robust free cash flow generation machine in the sense that, they don't have to invest huge amounts of CapEx in terms of the foundry side. But that's where the risk is, because it's so concentrated in Taiwan and Asia. Like, you can't make chips. And look, there are others like Apple who are equally exposed to that sort of scenario. So I think in terms of the fabless design makers, you clearly have a moat in the case of NVIDIA, and others are trying to catch up, but it'll be years before they can make that high-end chip. Yeah.
I don't mean to be rude, but if President Biden wants to build a chip factory in America to beat those dreaded Chinese, are those chips going to be the same quality as the chips in Taiwan?
Well, so you don't have the leading node capability right now, when it comes to 3 nanometer or 5 nanometer. And that's where these companies are somewhat constrained. They have the designs, but they can't manufacture it because we don't have that technology or that factory here. And over time, it will come. But, things change every year, 12 to 18 months when it comes to semiconductor. I mean, that's Moore's law, right? And so you don't want to be in a situation where you don't have the latest leading node chips available, because that is what drives the pricing.
Mandeep, just quickly here, what are you expecting to hear from Micron today? How important are their earnings given what we have seen in the run-up in chip stocks?
Data center exposure. So far, Micron has trailed because they have been less exposed to data centers. So how they are navigating around it, how are they participating in this AI, generative AI wave, that is what you want to hear.
Mandeep Singh, thank you so much. Greatly appreciate it with Bloomberg Intelligence. Lisa, thanks so much for that buy tip. 10 years ago on AMD, up 40% per year, 40% per year. Thank you for that. Really,
anytime. I try to help you out of the triple leverage all cash account. Here's a question a lot of people have, especially as we just heard Wei Li of BlackRock talk about how they're overlaying and embracing the AI theme. Where does the political risk come into play? How do you even measure it at a time when we are heading into an election? And hawkish discussions around China works, right? I mean, that's basically what galvanizes people and wins votes. Even if businesses say pump the brakes, we need to have some sort of other type of relationship.
I totally agree. And to me, the basic idea here, a la Mandeep, is, do you believe in the technological innovation forward wrapped around all this? I have never made money in semis. I've been a loser. There's an index of SOX, S-O-X, that this is not a measurement of the Red Sox mediocrity. And the answer is, I've never been able to make money on an index that's averaged 24% per year for the last 10 years. How can you do that? You can be as inept as I've been in the chip game.
Well, there are winners and there are losers, and the disparity between the two is vast. It's something you can run a truck through. This question around who are going to be the innovators, who are going to be the winners take all in a race that is very specific and that does have the NVIDIAs and the AMDs facing off versus the Micron and getting out way ahead of them. So, you overlay the political risk. How do you get in? A lot of people will shrug it off and just say you just need to own them.
Do you feel that it's sort of like the Apple's going to die discussion? I mean, only for 20 years, every 18 months on Q, Apple, they're done. It's never going to, it's just, they're so done.
I think that if you take a step back, there are the people who say AI is going to save everyone. Other people say it's going to destroy the world and make humans obsolete. And then you have the people in the middle who are saying this is going to change how we do business. I already see it changing the way that my offspring do their homework, do their assignments. Not that they use it as a substitute for them, but that they use it to, figure out what the information is to be looking at, to sort of grade what they're doing. I mean, they're using it as a tool in a way that I'm not, and I probably should be.
Can ChatGPT conjugate irregular French verbs?
Yes, it could do it a lot better than I can. That's all I can say.
That was my downfall, folks. Anyways, that was really interesting. Mandeep Singh there on the wafers. In 1 hour, we will consider Portugal. It'll be interesting to see. Joseph Amato, Neuberger Berman, important conversation. That's coming up. Bloomberg Surveillance on radio and television. Stay with us.
Off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
From the world of politics to the world of business, Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
I think margin pressure is very real, and I think that's where the equity markets are going to begin a correction.
We're watching the margins really closely because inflation has been actually very good for margins.
We're in a nice downward trajectory in inflation. I think it will cool off on its own.
If the Fed has to keep tightening, eventually the economy is likely to crack, but we're not there yet.
Now, we're not expecting a ton more rate hikes from the Fed, but it does seem like one is likely.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Central bankers are back in the center stage, or maybe they just never left. Good morning. Welcome back. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Jonathan Farrow is on vacation. He will be back next week, which is wonderful. This does seem to be the theme of the morning, that we are going to be hearing from central bankers at 9:30 a.m. in Sintra that include ECB President Christine Lagarde, Fed President Jay Powell, as well as the heads of the Bank of England and the Bank of Japan all together on stage.
Kit Jukes nailed it this morning in his two-paragraph research note. He harkened back to 2004, 2005, the idea of the vortex of instability. And at that time, the bankers went this way and Trichet went that way. John's very big on this. My good friend Jean-Claude Trichet got this wrong. And the basic idea here is this a redux of what we saw before the crisis of 07, 08? And will we see someone today get it wrong? What's interesting here is the language issue. I wonder if some of the panel will be lost in translation because we have a new a banker for the Bank of Japan.
It's also coming at a fascinating time where we've had 6 months, people shifting their focus more to the individual companies, the individual micro trends, and less on central bank speak, saying they're following the same things that we're following. And suddenly, what we heard from Chris Verone is the exact opposite, that from here on out, it will once again be central bankers, it will once again be yields that will determine the trajectory of the market value.
Within the central bank space, it sounds like a range-bound discussion. As he mentioned, the 10-year yield being very range-bound, 3.73%. And you wonder, I'm not going to opine which way you break out of that yield, but if you break out of that yield, all of a sudden, that's a central bank issue.
Do you think they get along? Do you think they're friends?
The central bankers? You know, I really do. I've been a central bank watcher for years, and I think there's a huge collegiality to it because they realize, and the media does a terrible job of this, guess what? They put their pants on one leg at a time. Lagarde puts a scarf on. You know, these people are normal people wrapped around insufferable decisions.
News you need to know. They put their pants on one leg at a time. Let's save ourselves and take a look at what's going on in the market. We're looking at a bit of softness, a bit of retracing with it led by the NASDAQ after its reprisal yesterday. A bit of a pop. Right now down 0.4%. Largely on the heels of some of this chip news that we saw overnight, Tom.
Yeah, the chip news, I think, is the kind of thing that gets it going here. And, you know, big day yesterday, a big short squeeze coming up here right till the end. And the levels here, 44.08 on SPX, Dow 34,000, NASDAQ still giving us a lot of love, and the VIX at a 13.80. I guess it's a bull market, but a lot of people don't feel like it's a bull market.
It's a moment of reset, and I think that really is the key. Looking right now at a two-year yield at 4.73%, a bit of dollar strength. This has just been hovering around. You're right, Tom, to say there isn't a lot of direction when it comes to some of the crosses, except for the Chinese yuan, where you're seeing real weakness. And you are seeing just a shift marginally lower in oil, one of the linchpins of just this bet that there will be a slowdown in growth, particularly led by China, which does seem to be
Look at Brent crude under 72.
Yeah, and looking at WTI at $67.31. We are heading toward the mid-year level. We are 2 days away from that reset. And joining us now to help us reset is someone who is resetting in a material way. Joseph Amato, President and Chief Investment Officer for Equities at Neuberger Berman, joining us here on set. How are you, Joe, changing your view heading into the second half of this year?
Well, we've had an intense debate like there's going on in the market. And, you know, our debate within our asset allocation committee probably reflects a lot of the dispersion that exists out there in the marketplace. We've got folks that are quite bullish and we've got folks that are quite bearish. But we went into the year expecting the economy to slow down at a more significant pace and earnings to be more on the disappointing side. And that really hasn't played out necessarily. So we went in underweight equities and risk assets. We moved up in quality. And that's been, you know, so far the wrong call because markets have been pretty good the first half of the year, as you guys have talked about. But as we debated the issues and as it looks like any slowdown is probably extended and pushed out further, the earnings decline pushed out further, we felt neutralize our bet, sort of live to fight another day and see. We always have a chance to make that a change if we see earnings disappoint. But right now, you know, we took that underweight off and still have a bias toward quality for sure.
So there's going to be more of an aggressive shift, albeit on the margins, heading into the second half. We've been debating all morning. What's more important? What happens with the individual corporations, or what happens today at 9:30 a.m. Eastern in Sintra with central bankers taking a hawkish tone? How much are they still in the driver's seat of what happens next?
Central bankers are certainly still very much in the center of debate around what's going to happen in the economy, given the challenges that they have in inflation. And you look at across the range of central banks, you have a pretty wide dispersion there as well. You have the U.S., which was more aggressive earlier on. Inflation's come down at a more rapid pace, although still we think will be a challenge to get down to the Fed's target. On the other extreme, you've got Japan, which maintains a quite permissive, if you will, monetary policy. And then, the UK has got a real inflation problem, so they've got to be more hawkish and these to be somewhere in the middle. So that's going to be an important issue that we continue to watch over the course of the second half of the year. What
matters right now? I mean, Neuberger Berman is priding itself on active management. I want to go into the history of what you accomplished with Lehman Brothers in a bit, but the basic idea here, away from passive active, is factor analysis right now. What factors matter into the end of the year?
Well, I think quality matters for sure, and profitability, because if we're in our broad allocations, think more up in quality, whether you're on the credit side or the equity side. I think you want to certainly be overweight that factor. And beta, you probably, in our view, you want to be underweight beta in that sense. Again, with a bit of a more defensive posture, even though we've neutralized our equity bet, again, we still lean toward lower beta, higher quality.
I look at where we are and a bull market unloved. Can you calibrate and see when a second leg of a bull market clicks in? I mean, there was 76, 77, which no one expected after the moonshot off of 74. Can you find a second leg of a bull market, or do you just have to go back to core fundamental analysis?
I think the level of dispersion that exists within the economy, I think, suggests we still need to do a lot of bottom-up analysis as it relates to a bull market or where we are. It's been, the equity markets have been quite perplexing over the first half of the year because you've had a group of 7 extraordinary stocks that are up 50-60% that dominate the U.S. large cap index, as again you guys talk a lot about, and then you've got everything else, and that everything else has been flattish to up modestly. So that's been a challenge if you're trying to invest and you see the index perform so well. Yet some of these, very few active managers are going to put 40% of their portfolio in 7 stocks, right, to be overweight the mega cap. So it's been, you feel as an active manager, you've been just chasing your tail over the first half of the year.
We're speaking with Joe Amato of Neuberger Berman, CIO for equities, over there at a time we are resetting into the new year and into the new half of the year. It feels like a new year. We've been talking a lot about some of the trends, and you said that there are a number of stocks that have dominated with 40, 50, 60% gains. I think chip makers, and then I think geopolitical risk. And what we see this morning with a proposed plan by the Biden administration. Are you going all in on AI? Are you seeing this as a lasting trend that can withstand any geopolitical tensions? Or are you kind of being more tepid about it?
I think AI is going to be an incredible long-term trend for sure. I mean, that's going to be as profound as some of the things we've seen over the last 20, 25 years, similar to the internet broadly defined. But as we have seen with different technological innovations, you have sort of a boom-bust period, things consolidate, and then you have long-term growth. So I think AI is probably going to go through that, but it's going to be quite profound. I know from our firm standpoint, we're all in, we're diving in deeply in terms of how it can enhance our productivity and our investment insights. So it's quite important. At the same time, you raise the geopolitical issues, which, having just been in China, it's an issue that we're very focused on. It's an issue the Chinese are very focused on. And I think as it relates to AI, that's probably one of the most sensitive issues in the transfer of technology between the U.S. and China. I think it's going to continue to be an issue. You guys talked about it this morning in terms of potential restrictions on selling chips.
And now, folks, the most important conversation for global Wall Street to the end of the year. This is with Joe Amato of Lehman Brothers. I'm going to cut to the chase. There's blood in the street. Credit Suisse is throwing thousands out. Every other firm is throwing those fancy IB bankers out the door that you can't stand. You and Jack Rivkin built Lehman Brothers from 1997 to 2003. I remember looking at the sell-side analyst, the sheets rather. Lisa, this is when we had printed research reports. They got better every year until Lehman dominated the business, and Neuberger Berman involved with that, and all that. Is that a history of the past? Are we at a point now where we're taking the intellectual capital out of the business with all these layoffs, all this uproar that's going on in the street right now?
I don't think so, Tom. I think the fundamental bottom-up analytical work that helped propel us back in the day in terms of our own research rankings, or the work that we do today at Neuberger Berman, is still hugely important. You have different tools that you use, right? The bar is higher for sure. I think the sell side has underinvested in research over the course of the past decade or so.
What do you want to see from the big banks? If we were having a conversation right now with Brian Moynihan on the future of Bank of America securities research, what would be your counsel to Mr. Moynihan?
Well, I think the breadth of global research that these firms are committed to is important to us. We're a global investment manager, so there are a lot of parts of the globe, whether it's the small cap space or large cap for that matter, that have less coverage. Now, in some respects, that's advantageous to active managers because we've invested a huge amount in research. So the more inefficient the sell side is, if you will, the more advantage we have as a buy side firm if we're committed to research. But that said, we value quality research, and if it's provided by whether it's Brian Moynihan's firm or other large firms, that's super valuable to us.
Don't let the dust break with the Credit Suisse resumes coming in. Joseph Amato is at Neuberger Berman, the home of security research. The Dow, a little bit of a deterioration, down 0.9%.
Tom, we're talking, meanwhile, about whether there'll be a downturn. And one thing that we keep hearing, whether it's from Joe Amato or whether it's from Whiteley of BlackRock, there's a shift to a bit more bullish tone, a bit of a feeling that perhaps there is a change in the earnings. Maybe it's late. Maybe it's, you can't necessarily just simply say we're going to stay on our hands. The courage of getting in, that's sort of what you've been talking about, Tom, for quite a while. If the facts change, people's theses change, and the facts, particularly with corporate balance sheets, have been different than what people expected.
What people really have to do is say, okay, Charles Cantor waltzed in here in the vicinity of October, November, and painted an optimistic picture about selected corporations adapting and adjusting. That's been my theme for 18 months. Why does that end now? I agree, it may be different. It may not be the moonshot off the October low, but you wonder how corporations will adapt and adjust. They will at the revenue line, particularly as the inflation drifts away.
Some of them will adapt and adjust, others will go out of business. And this is sort of the tension right now, as we talked about bankruptcies picking up, is things are different when you start holding rates at this level for longer. All of a sudden, certain business models get challenged and others do well, which is the reason why some people are still concerned going forward, Tom, at a time when there still is quite a bit of lag effects that people have been saying are going to come to the fore any day.
It's going to be interesting to see the yield, 3.73%. Least focused on oil, 67.40 on West Texas Intermediate. We're also focused on Portugal and Sintra in the 9 o'clock hour. 4 central bankers lined up in conversation. Stay with us. This is Bloomberg Surveillance.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. News breaks. No one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
Their new reality is the reality from maybe even 30, 40 years ago, right? Because the great moderation is over. What I will be paying attention to is to understand if they acknowledge the trade-offs facing them, which is that the cost of fighting inflation in a supply-constrained environment is a lot higher. So if they acknowledge that, and also number two, what are they going to choose when faced with this stark trade-off, growth or inflation?
On fire today. We're going to stop the show right now. Tom Keene and Lisa Bramowitz, Pharaoh on assignment. But this was really important. Whaley of BlackRock came out with a new macro view. That's what you do as you come to July 1st. And it was really, if we get the scenarios she set up, what happens to our world? it changes.
Well, she was talking about, right, the overlay of some of these big drivers, including AI, including some of the geopolitical tensions and how you play them. And she had been underweight. She had been cautious. She still is. But it's with an asterisk next to it about what to be cautious about and how to be not cautious in certain areas.
It reminded me sort of the Stiglitz globalization is over thing. Okay, well, it's a whole new world after all. 3 years out of the pandemic, 4 years out of the pandemic. Where are we in 2025? I hear sort of a deadline, and I'm glad that BlackRock came out with this study, because we got to be thinking about 2025, 2026 in a whole new world after all.
Did you see the Jonathan Golub?
No, I missed this. Please.
Report of Credit Suisse coming out and saying that futures
Golub?
pricing
Let's get young Golub on.
Indicates that there's no recession until 2026. That's when he sees it
Far
happening.
too optimistic, a toxic brew. John Golub there. Right now, we're Lisa and I are trying to waste time because this is the most painful discussion of the day they're going to have right now. Futures deteriorate, -10. The airlines. What is it about the airlines? Helene Becker joins us now, senior research analyst, most hated person in the world at TD Cowen this morning. Helene, I'm just going to cut to the chase. Who do we blame for this early summer mess?
Well, so it's weather. And then there's the airlines who are prepared, but there's the government who's not prepared. So the airlines are doing less with more. They have more employees now than they did in 2018, but the government has fewer air traffic controllers now than they did 4 years ago. And this mess is going to continue for the next at least 5 or 7 years because the FAA doesn't seem to have a plan to resolve the shortage of air traffic controllers. We're supposed to have 14,000. We only have 11. I think something like 2,500 retired in the last couple of years. And the government was supposed to hire 1,500 this year, could only find something like 960 or 70. We expect about half that many to retire and half that many to wash out. So they're only going to net about 500. And when you're short 3,000, 500 into 3,000 is 6. So yeah, this problem's going to last for a while.
Some of us of a certain vintage can remember staying in any great train station, South Station, Boston, Union Station, in Washington. I spent a whole night once in the Omaha train station. And the trains used to be like people all lined up going in 8 different directions. Are we asking too much of the airlines to be like our train stations of another time and place? Is it too much to ask for Newark to be the old Penn Central?
And it's not. It should be. It should not have these problems. The airlines, the airports, I'll start there, are just bursting at the seams because demand is just so strong. United is forecasting that between June 30th and September 5th or 4th, whenever Labor Day is, they're going to carry 5 million passengers. And if you kind of extrapolate that out to American and Delta, it's probably similar. So that's 15 million right there. And then you add in all the other airlines, you probably have another 9 or 10 million. So we're looking at 24, 25 million people that are going to travel over the next 3 months, rest of June, what's that, 2 months, July and August. And the industry should be able to handle it. They have relatively new aircraft. You look at American, Delta, United, they've all been refleeting. Most of the other airlines, JetBlue, Spirit, Frontier, Southwest, they also have young, fuel-efficient fleets. And so it's not an aircraft maintenance problem. It's just that weather rolls in and the FAA goes on a ground stop, and instead of lifting it in an hour or half an hour, it lasts for 3 or 5 hours, and then crews start to time out. I mean, we still have the safest airline system in the world. So you add all that and you add all these people into the mix, and you wind up with these awful delays and cancellations and unhappy travelers.
Helene, yesterday we did hear from Delta CEO at their annual meeting, and he acknowledged that business travel is still 25% below where it was pre-pandemic. Given all the roadblocks, given the expense, do you expect it to get back to the same levels that it used to be?
So, Lisa, yes and no. The typical analyst answer. So when you think about business travel and GDP, it should get back to, it should be the same percentage of GDP as it was in the past. And I think what you don't see is that people are just traveling differently. And from a corporate, like large corporate tech, for example, tech people from the tech industry haven't really come back. Financial services hasn't really come back. So from that perspective, we're not expecting it to come back, but we are expecting the same number of people to travel for work as we've seen in the past on a relative to GDP basis. But think about it, Lisa. We're seeing 2.5 to 2.7 million people a day travel. That's what we saw in 2019 with 25% more business travelers and 15% more international travelers.
And Helene, to that point, and just quickly here, there has been a shift under the cover of businesses using economy instead of business class because of how much the prices there have risen and companies trying to restrain costs. How much is that part of why the revenues for some of these airlines isn't picking up from business in the same kind of way?
Yeah, exactly. So customers, businesses are trading down from business class to premium economies. And then people are using mileage, their own miles, to upgrade into the front cabin. So we definitely are seeing that. And yes, Lisa, that's a part of it too.
What's your single best buy?
So our top 3 picks are United, Delta, and Copa Airlines in that order.
Interesting. What's a United Delta distinction?
So United's bigger in international markets right now than Delta is. United is about 50% international, 50% domestic, and Delta 60-40 domestic international. And the travel is really international this summer. So that's the difference.
Helene Becker, brilliant. Thank you so much. Greatly appreciate it. I'll be thinking of you when I'm sleeping on the floor at Newark. It's that time of year, folks. It's that time of year where Bramo looks forward to the Hartsfield Atlanta wait.
All right.
I mean, there's a plaque. There's a plaque in Atlanta that says the Bramo family sit here when you get stranded. Everybody's stranded. I sit at home and Mrs. Keene is on the phone to a lot of people, seriously, in airports, domestic and international travel, sitting there.
We were supposed to
It's
go.
ugly.
We were supposed to go to Puerto Rico as a family, and we ended up being delayed by 3 hours, ending up in Atlanta and not getting a flight to Puerto Rico. And so we ended up staying and having a vacation in Atlanta, which for the offspring was not incredibly wonderful.
And to cut to the chase, if you're not traveling rock star, the ramifications of, you and the kids, I don't mean you personally, Lisa, but anybody in the kids, you got to take the plane at 8 a.m. tomorrow, 6 a.m. tomorrow. And there's no like $400 or $800 or $1,000 check coming your way. Those days are over, it seems.
Correct. We're not going to be talking about that coming up on the Open. We're not going to be reprising my days of getting stranded in Atlanta, which will not be happening again.
I was looking forward to the next week.
Lisa Shallett of Morgan Stanley and Jack Manley of JP Morgan are going to be joining me.
Good.
Yeah, it'll be interesting, especially ahead of that Sintra panel, which is going to be the key event of the day, Tom.
It's going to be interesting. Really looking forward to how Christine Lagarde massages the message. This is Bloomberg Surveillance. Good morning.
times in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year, and we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Nerdfest. Good morning, everyone. Bloomberg surveillance on radio and television. Lisa Bramwell is preparing for the 9 o'clock show. Mr. Farrow's on assignment. There have been selected Farrow sightings. He's alive, he's breathing, he's tanned and rested. That's a good thing. On assignment here in a British fashion is, well, futures in -7. Yields have come in nicely. And there really is, I'm not going to call it a recession worry out there, but I am going to point out three ideas very quickly here. The real yield, the 10-year yield of 1.55 gets my attention. That's an elevated inflation statistic over the last 3 days. West Texas Intermediate, Brent crude under 72, shocking. 71.85 on world oil, 67.26 on American oil. That bears careful study into the end of the week. And I'd also note Chinese renminbi gives it up again, rounded up 7.25 is a very weak Chinese yuan. There's economic data today. There's not 14 lines of economic data. There's 3 lines. It's sort of an off day, but we bring in the star. Michael McKee joins us in charge of important day and lesser important day economics. What do we got?
Well, if you're going to be an eco nerd, these are some interesting numbers. They're generally thought of as sort of secondary or tertiary, but they do mean something for GDP, and that is the advanced good trades balance falls to 91.1 billion from 97.1 billion. So a significant decline in the trade balance, which could add to GDP. Wholesale inventories continue their decline, down another 1/10. They were down 3/10 in April. These are May numbers. And the retail inventories are interesting. They come in up 8/10 after a 3/10 gain, which is revised higher from 2/10 for April. So we are looking at some additional strength for the overall economy. And the retail numbers are kind of interesting because they had worked them off over the holiday season into the beginning of this year, and now they're significantly rising again. Is that because consumer demand
let's
is
go
strong,
here.
or people are not buying?
Kathleen Bashantzik with us. We're going to have Mike McKee for the entire half hour to get ready for the Sintra Ballet. We're going to go nerd on you in about 15 minutes. But Mike McKee, this is important. I talked to Jan Hatzius once at Goldman Sachs about this. The media talks about inventories like it's apples in a grocery store or whatever. Let's dig into this right now. Retail inventories are up, but you don't know why they're up?
I haven't looked closely enough at it. I'm not a retail analyst. We should find one to ask.
That means there's stuff out there.
Yes, there's stuff out there. And is it because people have not bought their summer clothes the way they thought, or is this because we're starting to stock up for fall? But remember, we had a big rise in retail inventories during the pandemic because people weren't buying, couldn't get out, and then retailers had to clear them out, and now it's rising again. And all this adds, it gets counted into GDP, that which is at least made in the U.S. So we'll see what this means. But if you're calculating the Atlanta Fed GDP now number, which is at 1.8% right now, could go up a little bit.
Okay, this is important. And again, we're going to get to Bosjancic of Nationwide here in a moment. Tomorrow we get the third look at first quarter GDP. I'm going to editorialize that's a non-event. But the data you're looking at now is for ending June 30, right?
Right.
And you have a pretty good guesstimate of that, whether it's Atlanta GDP now or it's Kathleen Bosjancic at Nationwide?
Well, I'll put my money on Kathleen, of course. But
nice of you.
The GDP now numbers give you a snapshot in time, like a political poll, as of today, sort of. But there's still a lot of data to come. We're still getting this May data, and we're in June now.
Michael McKee with me for the half hour. And again, we'll really focus on some of the theories behind Center here. I think that'll be a huge value add to our global audience, that in the 9 o'clock hour in Portugal. But right now, on this American economy, Kathleen Bosjancic joins us, economist at Nationwide Mutual as well. Kathleen, the data that comes out today, and we're getting near June 30th-ish, do you have a really firm grasp of where the American economy is Q2 ending?
Good morning, Tom. Well, I thought I thought Mike did a great job summarizing the impact of the data. Sorry, what we're seeing is on the trade sector. That's the biggest drag on second quarter GDP. So the fact that trade figures came in a bit better than expected means less of a drag. So overall GDP growth now, I would say, and especially with putting inventories in the mix, probably over 2% annualized.
Interesting.
Q2 over Q1. Now, just to put that in perspective, because you are speaking about the central bankers speaking later today, Chairman Powell has said that we need to see several quarters of growth below potential growth. Potential growth is around 1.8%. So if we're coming in above 2%, it's not quite slowing enough for his liking.
What are domestic final sales? I've always loved this study. Define domestic final sales, and are they a recession statistic?
So domestic final sales is one of those core measures of GDP, and that excludes changes in inventories. And the reason you may want to look at that is just as Mike said, you don't know sometimes why inventories are moving. They could be intended, and that's a good thing. Like they think demand's picking up and they want to replenish their stocks because consumers are going to be strong and purchasing. Or it could be an unintended build, which is bad news, right? And they have to work those down because they have too many goods. So it's unclear at this point, how that works out. But we tend to like to look at final sales that strips out the inventory fluctuations. You could even take it a step further and look at domestic, right? And that takes out the trade sector as well, which could be very volatile.
Well, as long as we're talking GDP, let me ask you what you think so far. Yesterday, we got some news that suggested that businesses are spending money again, at least in terms of durable goods orders. And I'm not sure what you're seeing as far as consumers, whether the retail data suggests consumers are out buying. But what's your feel for domestic spending at this point for the second quarter? Is Atlanta giving us a pretty good idea of where we are, or are you much higher or lower than they are?
No, I think they are giving us a good idea where GDP is, and we're right in line with that. When you exclude the trade sector, you're looking at growth that's probably in the high 2%, right? Because consumer got off to a very strong start at the start of the quarter. Now we'll get the May data on Friday, so that will be important. In fact, saving the best data for the end of the week, right before the holiday weekend, but consumer spending, income, and of course the PCE price index will be very important. But domestically, as you said, we're seeing the consumer still firing. I think that is feeding through to durable goods orders and business investment. Now it's still soft overall, the trend, and when you, especially when you adjust for inflation. But I think the consumer goods portion, that's really what's helping to kind of push a little bit of an uplift in an overall business investment.
Well, are you in the camp of a lot of economists saying that we're going to have a recession in the next quarter and keep pushing that out again? Or are you giving up on the recession idea?
Yeah, unfortunately, the timing is very, very difficult to call on this downturn. We have not thrown in the towel on the recession call. We have, based on the current data, I mean, you have to take that into stride, of course. And the fact that there's still a high propensity for hiring and consumer spending more than we had anticipated. but we still see the leading economic indicators and credit availability diminishing. And we still see that, we've now pushed that out to Q4, so Q4, Q1 of next year. And we'll continue to watch the leading indicators as well as the coincident. But those leading indicators still are pointing to a downturn. So it's hard to just ignore that and say, okay, current data looks better. Let's, you don't want to forecast based on coincident indicators.
Kathy, to me, Nationwide's always had a wonderful clarity, sort of the fabric of the Midwest and Ohio and all that, about jobs in America. It's less 3 zip codes in Manhattan analysis, or maybe 1 zip code in Washington, 1 quadrant in Washington as well. What's your labor call in America with a central bank that's hoping and praying that Columbus, Ohio will have an unemployment rate that surges above 3%?
So, really, employment's been strong across the country. It's really hard to point at any particular states or areas where there is weakness in this labor market. The demand seems to be very broad-based. I think, the challenge for the Federal Reserve is they, of course, don't want to see a surge in unemployment, and they, of course, don't want to engineer a recession at all. But the real question is, if this economy continues above potential, meaning, running a bit hot, can you get inflation to trend lower? And I would say part of what we're looking at is the fact that housing starts, have started to rebound, and home prices have been up the last 2 months in a row. Well, everyone was banking in rental inflation rolling over. That could put a wrinkle in things. It could be that, home prices as part of the inflation measures it rolls over a little bit, but not as much as expected. So therein lies the kind of the rub right there.
Do you buy the rent disinflation story?
So I think that we're seeing some slowing in rental price increases. But what I worry about is that some of that's happening, but then it's going to level off and start to rise again, just like we're seeing in the overall economy. That this is, inflation and rental inflation is a lagging indicator. So if we're seeing the economy sort of, being resilient and even picking up a little bit, I think that spells trouble for the inflation. That means the Federal Reserve only has to do more. And that's why it's really tough to throw in the towel and abandon the recession call, even though we've been saying this for a while. I think the other point, just real quick, Tom, is that it's the inversion of the yield curve, and I think you and Lisa were talking about this earlier. There's very long and variable lags between when it inverts and we get the recession. But I think also what many of us were looking at was the degree of tightening. We went from basically 0 to 5%. That's the fastest tightening we've ever seen, even looking back at Paul Volcker's period. So it's not just the level or the inversion, but the speed by which interest rates rose.
Kathleen, thank you so much. Kathleen Bastiancic, a brief there on the American economy with Nationwide. Mitchell, Mike, we've got a bit of time here, and then I really wanted to fall into a nerd discussion on Sintra, something that you just excel at. But can we predict GDP? I think we all understand we can't predict recession. Maybe we can't predict inflation dynamics. Maybe we can't predict oil. Do we have any confidence we can pick GDP?
Well, it depends on how close you want to get, I guess. Economists are getting better because the data are getting better, and the government is releasing data on a more timely basis, especially things like trade. But these numbers do get revised, and that's where you fall into issues as better numbers come in. But now that we have a better picture of inventories and trade, it is a little bit easier to figure out what GDP is going to be within a couple of tenths. And then the big question is, what are consumers doing? Because there's so much of GDP.
70% of the American economy. Standard & Poor's 500 down 0.2%. And we say good morning to all of you on Bloomberg internationally and domestically as well, on radio and television, with a churning to the market. Futures negative 11, a bit of a deterioration in the tape in the last 30 minutes. 10-year yield 3.74%, gives me nothing this morning. I'm focused on oil. It's just a stunning number, particularly for those modeling out well above $100 barrel oil 12 months ago, 67.43. Down 27 cents on West Texas Intermediate. Brent crude's 72.01. This is going to be a joy. We're going to dive into this right now. and really try to set you up with a value add for global Wall Street. Not so much on Sintra, which is sort of a Jackson Hole of Europe, but on 4 discrete nations with 4 different central bankers with 4 different outcomes, and we all have in our mind what they're framing out as well. And underneath it, there's supposed to be a theory that Bailey, Lagarde, Powell, and Ueda can rest their feet on. Michael McKee joins us now with decades of studying this conundrum. Are these 4 flying blind?
Not flying blind, but try to figure out past relationships and what they mean for current relationships is very difficult right now. And we've seen that over and over again in this pandemic phase. Some central banks have decided they want to hold back, and others want to go forward. And the differences have been kind of vast.
Yeah, well, we'll have to see. We're going to bring up this debate here coming minutes. I really want you to stay with us. It's going to be a real joy with our Michael McKee, head of all of our economic coverage. Futures at -11. This is Bloomberg. Good morning.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
We're expecting a hike in July. We're also expecting a hike in September. The market is pricing that hike in July at to a pretty large degree. I think that July hike is a relatively low bar, and then after July we'll should see still some strong inflation data, and then that gets us to the hike in September.
A minor conversation today, but I'm sorry, a major impact from Veronica Clark of Citigroup is she and Andrew Hollenhorst just absolutely stay where people are heading. They have said that we're going to have higher interest rates, and persistency and resiliency of an economy, as Lael Brainerd said from the White House, seems to be the tone here into the end of the second quarter. We say good morning, Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg surveillance, Farrow on assignment, Lisa getting ready for the 9 o'clock Sintra hour. And I have the privilege of being here with Michael McKee. His formal title is Bloomberg International Economics and Policy Correspondent, but the reality is I go, Mike, remember that paper from 2 years ago on Nash equilibrium? And Michael will have it buried 6 papers down on his desk. He's actually the one that reads the papers in that. How is Sintra different from Jackson Hole?
It's a little different in that it is generally more focused on current economic issues. Not that Jackson Hole isn't, but Jackson Hole is an academic conference that focuses on topics in economics, where in Centra they're often talking more about what's happening right now in markets, which is definitely something that they are doing. Centra is also a little bit more open to the press in terms of having things broadcast, like this panel discussion that is coming up. At Jackson Hole, you get the chairman's speech, which has only been aired now for 2 years, but I expect will continue.
Maybe the panel will be longer than 8 minutes. I'm still got to get over. For Powell's speech, folks, that don't keep score on this at Jackson Hole was an outrage. Farrow, I think, was offset when we had to jump back on.
I think the introductions probably will take more than 8 minutes with 4 people on the stage.
They'll be going, keep it up, please, introduce us longer. I'm going to go right to the type 2 construct. What do they not want to say? Let's go right through them, starting with the Bank of England, ECB, Powell, and the mystery of Japan. What's the number one thing they don't want to say?
Well, you got to take Japan out of the conversation of the other three, in the sense that Japan has its own economy, its own issues, its own inflation rate. Their inflation rate is going up at a time when others are going down, and they want that, and they want to make sure that inflation is going to stay a little bit higher. So their policies are different. Obviously, they're holding way down monetary policy very loose, and so they're having the negative impact on them is that the yen is weakening tremendously against all three of the other currencies. So for Ueda, he would be interested in not encouraging that move and seeing if the others actually can give us some indication that they are almost done, which is what the other three don't want to do. They want the markets to worry that they have more to come, because they don't want markets to start pricing in rate cuts. And you and I were talking offline about the WIRP function on the Bloomberg that shows you what futures trading is predicting. And now we have added out another year, so you get a long look at what's in the markets. And while it's certainly not trustworthy, because markets change their minds all the time, it shows big rate cuts in the U.S. in 2024. Still not in 2023, which is what Jay Powell has wanted and probably will emphasize today. But the markets expect those to come.
Kitchuk's nailed this morning by harkening back to 2004. John Farrow's been very good about this, folks, talking about not so much how Trichet got it wrong, but that the ECB took a turn pre-crisis of staying tight. All these people have a history or have been advised by their PhDs. Let's remember the mistakes that were made. What is the mistake that haunts these four bankers at 9:35 this morning?
Well, it's all kind of about the same time period. Well, it's about the same time period for the U.S. and the U.K. for slightly different reasons. Obviously, the U.S. went through the great inflation in the late 70s and 80s, and it came about because the Fed was too slow to tighten rates, and so Jay Powell doesn't want to make that mistake, wants to keep the pressure on. And the UK obviously had its problems in the 70s with inflation. And then after that, we had the sterling crisis. So they don't want to give up too early and have people start selling their currency. And the ECB's been through it, as you mentioned, with the Trichet tightening that then sent them into a bit of a recession and was a precursor, perhaps, to the great financial crisis at the time. So everybody's looking back, and the lesson they draw is that you have to have a policy and stick to it. And I think that that's the emphasis we'll get from them today.
This is almost like the anchored expectations argument. I'm going to look at one metric, folks, and this is American for our international audience, and this is something unique to America, which is a 30-year mortgage rate. Now, I didn't realize this legged up here in the last couple of days, 7.11%. What's the ramifications for these four bankers if, as Chris Verone said at the top of the show this morning, we do get yields to work higher on a resilient economy, on central bankers that feel like they have to raise rates? What's the ramifications for these central banks politically if we get a new higher rate regime?
Well, at this point, there isn't a huge impact on the Fed, because the Democrats in office, Joe Biden, have a policy against criticizing them, and they actually think the Fed is doing a reasonably good job. Republicans will complain, but it'll really depend on how the economy is performing in 2024, whether they feel any significant political pressure. The British have a much greater problem because they have a much greater inflation rate, and they also have a different kind, as you mentioned, Tom, of mortgage rates. Most of them much lower, and many of them are variable and much shorter maturity, and many of them are variable. So as they raise rates, there becomes the possibility of a mortgage crisis there. There's some feeling that there aren't that many resets coming in the near future, so maybe it's not a today problem, but it is something down the road. And the European Central Bank obviously has to deal with not just core inflation, which is a problem, but with the fact that energy is so important there. And right now, there are questions about what the energy supply is going to be next year, which keeps energy prices elevated a little bit.
I've got 8 ways to go here and not enough time to do it, Mike. I'm sure you'll be with Lisa here through the morning and with analysis of what we see at Sintra is well. But I really have to focus on the elephant in the room, which is under-discussed by me. I'm as guilty of this as anyone, and that is their balance sheets. You and I know there's a chart. Bloomberg has a beautiful chart on this, overlaying the balance sheet of these 4 banks, or critically summing them together into an unimaginable intrusion into the ownership of debt. The Japanese leading the way on this towards literally a liquid market. How critical is that debate right now?
It's becoming more important. It isn't the primary debate at the moment. For Japan,
it's certainly not the debate in the media.
Yeah, for Japan, it's going to be an issue because the government owns so much of the debt. As rates rise, it kind of constrains them. And I've talked to people in Japan who are concerned about what it's going to do to government debt rates. The UK has talked about selling some of its portfolio, and if they want to tighten in a sort of backhanded way, that could be something that they address. It would maybe help out in the mortgage sense because it would affect the longer end of the curve, and as I said, many British mortgages are set closer to the shorter end of the curve. The U.S. Is going to keep going at the pace to change. They are looking for where they hit rock.
But does WIRP say rate cuts to come? I believe it does.
It says rate cuts to come next year, but the Fed said that as well. So you've got a reinforcement. I think the balance sheets, most people think the balance sheet will run up against the demand for reserves sometime in 2024, and we'll see them start to taper or stop running off the balance sheet. But nobody knows really where that is.
I've been remiss on this, folks. I'm really going to lean into this in July. I promise you in July, this will be a study for us. Mike and I have avoided the elephant in the Sintra room, and that is Japan. And what I found over the years is every time you talk about Japan, you have to sell it to the Western media, sell it to the Western audience, and say, this is why Japan matters. Quickly here, why does Japan matter?
Because Japan is one of the biggest holders of U.S. treasuries. It's one of the biggest economies in the world. And so its imports, its exports, and its current account balance have an impact on other nations.
Mike McKee and I used to do this years ago, folks. Bloomberg on the economy, Michael McKee and Tom Keene. This is a good and beautiful thing. Mike McKee, thank you for the briefing on Sintra here. We'll have that for you at 9:30 this morning. Lisa Bramowitz identifying the news flow out of these 4 central bankers. Futures deteriorate, -11. Good morning.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Climate is one thing that connects everybody across the globe. And if we don't do something about it, it brings down the value of all companies.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI,
you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. A bit of a softer tone after yesterday's rebound led by the NASDAQ. The countdown to the open and to Sintra starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Coming up, Fed Chair Jay Powell joining his global counterparts for a panel in Portugal. The U.S. is said to be weighing new curbs on AI chip exports to China, weighing on futures with losses concentrated on the semiconductor stocks. We begin, though, with the big issue, all eyes on Central Portugal.
The big show is going to be on Wednesday.
Central banks have seemingly become more hawkish.
More and more hawkish.
It is starting to bite. I'm looking at Sintra.
I don't know if we'll hear a whole lot new from Powell.
We've got an opportunity for key central bankers to explain themselves.
Core inflation remains quite high.
Inflation continues.
The central bankers are still focused on the inflation picture.
Central banks feel compelled to attack that aggressively.
I think it's a relatively hawkish message still.
There could be a lot more momentum left in the hawkish cycle.
Central banks around the world have to continue to tighten.
They need to keep policy tight.
There's a lot of stuff on the table.
So just how much should we be caring about what we're going to hear in about a half an hour time? Joining us now to discuss is Morgan Stanley's Lisa Shallett and JP Morgan's Jack Manley. Lisa, how focused are you on what they have to say today in about a half hour time?
Look, clearly it's relevant that we're going to continue to hear the litany of central bank, rhetoric really around being tight, around the fact that the economy is not falling apart, that labor markets remain tight, and that the inflation readings are nowhere near their targets. And so I don't expect a lot new, but I do expect a reiteration and a passionate reiteration of the view that, higher for longer is the mantra.
Jack, do markets have any repricing to do with an aggressive and enthusiastic reiteration of a hawkish message?
I think they probably do, Lisa. I mean, we have seen time and time again that central bankers have been very straightforward about what they think is necessary in terms of policy, and they have been thus far true to their word. For whatever reason, though, I think the markets are still having a hard time accepting that reality. And so I think there is a little bit of short-term downside risk, particularly on equity prices, as that reality just gets reconfirmed perhaps today.
Jack, we were just talking on surveillance with a number of different investors who are actually revising upwards some of the projections for the second half of this year, getting more aggressive in equities, seeing more optimism in the balance sheets and the reports that we've seen so far. It sounds like you would push against that. Why?
I think in the short term, if we're thinking high-level index-based investing, we are dealing with multiples that are a little bit stretched, and we're dealing with earnings expectations that are probably a little bit lofty. You know, our bottoms-up estimate right now is looking for about 10% earnings growth this year. I think that probably needs to get cut in half before it starts to look a little bit more realistic. You add on top of that the fact that for the first time in a very long time, the bond market actually looks inexpensive relative to the equity market. I think a short-term kind of tactical overweight into fixed income makes sense at the moment.
Lisa, we've been hearing this from a lot of people. And do you also push back from this optimism that you're hearing increasingly from people revising upward some of their expectations for risk in light maybe of the pricing that we've gotten so far this year, but also some of the fundamental data coming in better than expected?
Yeah, look, I do think that everyone does need to acknowledge that the fundamental data has come in stronger, it does appear that we have some fundamental resilience here, whether it's in the residential housing side of the market, the durable goods orders, very, very decent. The labor market's still very strong, and we know 2/3 of GDP growth is consumption. And as long as people have jobs, they're probably going to continue to spend. So the reality is, if you look at Atlanta GDP now, as of this morning, you're looking at a forecast in the second quarter for real growth of 1.7%. You add that to 5.3% inflation, and you're looking at nominal top-line growth in this economy that's still running hot. It's still running at about 7%, and we have a Fed funds rate that is at 5%. And so, this is a scenario where, yes, certainly might corporate earnings be a little bit better than perhaps, folks like us who've been on the more cautious side have forecast. Yes, certainly that is a possibility in the second and third quarter if this momentum continues. But I think the implication is that then you have to think about multiples. As we move, earnings estimates up, do you really want to continue to put a 20 times forward multiple on those earnings, which increasingly are unsustainable, if in fact the central banks around the world are going to succeed at getting to anywhere close to 2%?
Well, given that, Lisa, are you getting more cautious or less cautious heading into the second half of this year?
So we're very cautious, and I don't know that I want to say we're incrementally more cautious, but I do think that the further this market runs, the wider those price earnings multiples go, the further they're going to have to fall to get back down to earth, to a more realistic view that might suggest that the neutral rate here for the U.S. economy is nowhere near sub 1% or even sub 2%. The neutral rate might, in fact, be closer to 3 or 4. And that really changes asset valuations.
Jack, do you agree? Are you on the same page?
I am on the same page. I think that we are looking at a new interest rate regime moving forward. And when you think about what the Fed is doing, clearly 5.5% is not the terminal Fed funds rate. But at the same time, very clearly, 0% is not a place that we're going back to anytime soon. Even if a recession were to materialize, we don't think it's going to be significant. Even if inflation does continue to cool, we don't think it's getting down to where it was pre-COVID for quite some time. And so in this world where the cost of capital is no longer zero, you have to be very thoughtful about how you are allocating your money. That's going to bring valuations down across the board. And I think it also means that when you are pursuing particularly growthy names, more tech-oriented, tech-focused names, it is a growth at a reasonable price story, not a growth at any price story. That suggests a bias toward quality sort of wherever you're looking in the equity market right now.
Jack, have you gotten more cautious heading into year-end? And I ask this at a time when a lot of people are revising upward their expectations of certain tech-driven sectors in particular. Are you in the same camp that Lisa is, not getting necessarily more cautious, but really sticking to your guns?
I'm sort of sticking to my guns right now. You know, I am starting to see some pockets of opportunity that are looking more interesting. A lot of that has to do with just the extraordinary valuation dispersion that we're seeing within the market. You know, high-level S&P 500 forward price-to-earnings ratio is extraordinarily elevated. But if you open up the hood on that one, those elevated valuations are being driven by a handful of names. Other parts of the market are still looking more attractive, particularly on the value side of things. So short-term, I'm a little bit cautious. I don't think I've gotten more cautious necessarily, but I think there is some room for risk, for irrational exuberance here. But I'm also not throwing in the towel and running for the hills right now. I am still a long-term investor.
One big wild card has been the banking sector, whether we really are out of the woods. The Fed releasing its stress test results today at 4:30 p.m. Eastern, marking the start of 3 regulatory actions that will impact how much capital banks will be required to hold on their balance sheets. Joining us now is Bloomberg's Sonali Basak. Sonali, what are we looking for today?
We're looking for banks to undergo here a scenario in which unemployment peaks at 10%, commercial real estate plunge is 40%, and the dollar surges against most major currencies. But listen, Lisa, there are some scenarios here that are stricter than last year. For example, home prices are going to fall more than last year's tests. You're also going to see peak GDP declines that are almost double what you saw last year. So will banks undergo this stress test as easily, and what does that mean for their capital return plans? Now, remember, the Fed asks banks really to wait a couple days. Investors expect communications to really come back from the banks late Friday potentially after market closes here. But it could take some time here because there's also the Basel III endgame that banks are waiting for as well. The expectation here is that there could be some constraints when it comes to capital return. We saw it even last year. Citigroup and JP Morgan even facing higher stress capital buffers that had tended to limit their capital return to some degree as well. But the question here is not only for the biggest of the big banks, which are also facing exploratory market shocks that will face their trading desks that don't have immediate implications for their capital return plans. And therefore, you look then at the regional and mid-sized banks here that have already guided investors to caution on what they can expect from capital return given the tougher rules ahead.
Sonali, thank you so much. Still with us, Lisa Shallett and Jack Manley. Lisa, how much are you looking to the potential for the banking sector to still face some stresses versus it's all clear, which seems to be the feeling right now in markets?
Yeah, we have not bought into the all clear scenario. Our sense is that these are the kinds of things that are, slow melting icebergs, and that the current situation, the stress in absorbing the rapid rise in interest rates, the way regional banks had financed themselves, had chosen in many cases not to fully mark their treasury books, the fact that they face potential exposure to the commercial real estate market in a big way, and there's pricing vulnerability there. Our best guess is this is far from over. I don't know that I want to go out on a limb and say we're going to witness, 4 more bankruptcies of the size that we've already seen. But I do think we are going to face a period of banking system consolidation over the next 2 years. And I do think that there's still more pain across the sector. Now, that's not to say that there aren't some great opportunities to invest in who we think the winners are going to be. And I do think that some of the largest banks and some of the super regionals are going to be the winners, are going to be the survivors. And given the way they're priced today, probably represent good long-term value for patient investors.
Jack, how are you factoring in potential stress, albeit maybe not another catastrophic blow-up, in the banking sector at a time when people are talking about the boiling of the frog, the sort of tightening in credit conditions around the economy?
I think it is just another net drag on this economy that we will have to sort of trudge through over the next 12 months. We are already dealing with a widened out trade deficit. We're already dealing with the fiscal drag. We're already dealing with a housing market that's come under pressure relative to where it was a couple of years ago on the back of higher mortgage rates, with banks sort of losing confidence and tightening the belts a little bit, being less willing to lend. That is yet another strike against this economy and yet another thing that the labor market has to sort of buoy out. So on the margin, I don't think it's going to have a whole lot of an impact on the bigger picture story, but it is one of the many things that we're looking at when it comes to the health of this economy.
Lisa Shallett, Jack Manley, both of you are sticking with us as we head toward that Sintra conference at 9:35 a.m. Eastern. Joining us now with a look at the stocks moving ahead of the opening bell, here's Abigail Doolittle.
Lisa, we do, of course, have some weakness overall for stocks after yesterday's rally, and a big driver for it is AI and chips. We have a pullback here on a report that the U.S. may seek more curbs in terms of selling AI-related chips to China. This has NVIDIA down 3.3%, 3.4%. Advanced Micro Devices also down 2.7%. Now, those obviously are chip companies and that AI-related business. Tesla, some consider to be an AI-related company, but to the best of my ability to determine, no chips involved. So right now, it's hanging on to a small gain, up 0.3%. Let's see whether or not the AI mood, which today is risk off, takes Tesla down as the day opens up, Lisa.
Abby, thank you so much. Coming up, U.S.-China tensions simmering over that potential for new AI chip curbs.
Intellectual property theft or spying or trying to sort of steal U.S. technology. This has been a sort of a mainstay for quite some time in U.S. policy. It's quite consistent. And, you know, the Chinese have not been as responsive to U.S. complaints about this.
That conversation coming up next. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Intellectual property theft or spying or trying to sort of steal U.S. technology. This has been a sort of a mainstay for quite some time in U.S. policy. It's quite consistent. And, you know, the Chinese have not been as responsive to U.S. complaints about this. They just want more response. It's like, you can't keep stealing things from us. We're going to crack down on your companies. We're going to launch charges. And we're going to basically ban exports of highly sophisticated technology until we can get a handle on how much you are literally stealing from us.
U.S. chip stocks under pressure following a report from the Wall Street Journal saying that the U.S. may tighten curbs on exporting AI semiconductors to China, a move that would weigh on this nation's sales, with NVIDIA getting roughly a fifth of its revenue from China. Let's get to our team coverage. Bloomberg's Anne-Marie Hardern in Washington and Katie Greifeld here in New York. Anne-Marie, I want to start with you. What's the latest that we understand with the timeline and what exactly the U.S. administration may propose?
Well, this is reporting about from the Wall Street Journal about this expansion on these export controls. Remember, in October, we've had these export controls on certain sectors of the Chinese economy, and now they would be looking into the chips that are needed for AI computing. So obviously, that's why you see the likes of NVIDIA down today. It also comes at a time, Lisa, where Jenny Leonard and myself have also reported that the U.S. administration is really starting to ramp up on the outbound investment executive order. And this would go towards things like semiconductors, artificial intelligence, quantum computing. Any U.S. money that potentially is going to China could be stopped or regulated. All of this potentially could be taking place this summer. And we should note it comes at the same time that we're reporting Secretary of the Treasury, Janet Yellen, will be making her trip in early July to Beijing. It's going to be an interesting tightrope for her to walk.
Yeah, the push-pull of either friends or not. Katie Greifeld, from the market perspective, we are seeing the shares of some of these chip makers sell off today. What is the sense on the street about how significantly this could impact revenues and profits in the drivers of this year's rally?
Well, if you look across sell-side research so far this morning, there doesn't seem to be an over sense of concern. If you take a look at Morgan Stanley, for example, they don't view these potential restrictions as a major disruption to NVIDIA in particular, and Citi too, writing that NVIDIA should be able to move its chips around given that AI demand will likely exceed supply. And that might explain why NVIDIA right now, it's off 3.5%, which isn't nothing, but just for some context, that would only be its biggest drop since about Monday. And you're seeing, of course, declines across the broader sector as well. But NVIDIA, it's up 185% year to date, so maybe a 3% drop shouldn't be too unusual. Obviously, though, that has implications for the broader indexes, given that this is, I think, the sixth largest company in the world at this point.
Thank you so much, Anne-Marie Herdern and Katie Greifeld. Their rally so far this year has brought this to a $1 trillion stock. Lisa Shallett and Jack Manley both back with us. Jack, how much are you leaning into the AI trade versus stepping back after how much of a run-up we've gotten and given some of the geopolitical concerns?
You know, Lisa, when I think about AI, I think it's the real deal. I think it has the power to be totally transformational in terms of the way that we live our lives and we run our businesses. But I don't think it's going to do all this tomorrow, and I don't think it's going to do all this next week. This is a long-term story, and we have to realize that we are still in the infancy of this stuff. And I would expect, because of that, there's going to be an enormous amount of creative destruction. You know, the winners that are the winners right now may not be the winners in the next 10 to 15 years. So you have to be very careful about where you're allocating. And I think that there is a possibility that some of these names are probably a little bit overbid at the moment, just based off of this hype and this fear of missing out that I think a lot of investors may have.
Can you give us a sense of who you're talking about, Jack?
Not specifically, no companies that I can mention here, but I just think it is an excellent example of where active management, manager selection, security selection is going to be extremely important. Buying into a chips index, buying into an AI index may not necessarily be the right play if you are looking out over the next 5 to 10 years.
Lisa, how much has your call been influenced by the advent, or at least the increased adoption of artificial intelligence so far this year? Are you leaning into it in the same kind of way?
I really agree with virtually everything that Jack said. You know, I think, you know, our perspective is AI is the real thing. But like so many transformational, particularly enterprise technologies, this is going to be a long story. It's a story about process change. It's a story about capital substituting for labor. And it's a story, quite frankly, where it's not going to ultimately be about the tech makers. It's going to be about the tech takers. And in that way, this is not like the smartphone. It's a lot more like the internet. And the same way that the internet ultimately wasn't about JDS Uniphase and Corning Glassworks and AT&T, it was about Amazon, right? I don't know that generative AI ultimately is going to be about NVIDIA. And, you know, as much as, you know, I think NVIDIA is in a unique position and has generated a huge amount of wealth for folks, it may not be the ultimate winner, to Jack's point. It may be the tech takers. It may be the companies that implement generative AI to truly disrupt and transform and creatively destroy and reinvent their business models.
Given that the rally year to date has been so concentrated, Lisa, on a number of names, including NVIDIA, including a lot of the AI complex, how do you come up with some sort of overarching call without having some sort of AI thesis underpinning it?
Well, look, I think our call is really about, owning some of the things away from the market cap weighted index. Exactly to Jack's point, this is about active management, it's about stock picking, it's looking for value in the market, and where a lot of that value is in companies, and I would suggest in the healthcare sector, in the financial services sector, in the real estate sector, in the utilities sector, in the energy sector, that are going to be transformed because they're going to adopt these technologies. And so play it that way, play it below the surface, and you're, buying companies that may be selling at 14, 15, 16, 17 times forward earnings, not 28.
Jack, just quickly here, how much are you looking at some of the big tech as not necessarily driving forward, but perhaps being more neutral as a weighting or something that you might want to be looking at?
I mean, I would say, right, that the handful of big tech names have driven the rally thus far this year, and because of that, it's easy to forget that there are another 490-plus stocks in this index that haven't done quite as well. That valuation dispersion, the performance dispersion, I think means that you have to start looking outside of those mega-cap technology names for some of that performance that we may be looking for over the next 6 to 12 months.
Jack Manley, Lisa Shallett, both of you, thank you so much for being with us. Coming up, the morning calls, and later, Fed Chair Jay Powell joining the other global central banking heads in Sintra, Portugal. We'll take you live to the ECB forum in Sintra. That's still ahead at the opening bell.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Time now for our morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, Morgan Stanley reinstating Delta as its top pick within the airline sector, noting management's enthusiastic tone at yesterday's Investor Day. Next up, Deutsche Bank downgrading Walgreens to hold, warning of weaker profitability. And finally, Wells Fargo upgrading Pinterest to overweight, pointing to upcoming catalysts and improving engagement trends. Coming up, that big confab in Sintra, Portugal, with global central banking heads. We'll take you there next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading, about 20 seconds to go, and you can see that downward draft driven by the NASDAQ after yesterday's rally, down about 0.5%. You can see the S&P futures down 0.3%. Yields lower as well as we take a look at a potential softening in trend. And as we look forward to what we're expecting to see out of Sintra, Portugal, with all the central bankers, 10-year yields lower by 3 basis points, 3.73%. Crude marginally higher, regaining losses from earlier this morning, but still sub 70 on WTI, $67.96, and a little bit of dollar strength, although not really moving out of this range. 109.34 with the euro dollar cross. We are seeing some significant yuan weakness after China's moves to try to step in and bolster those markets. Let's take a look at some of the stocks moving at the start of the day. Abigail Doolittle here with more.
Well, we are looking at a little bit of weakness for the futures, or actually for the indexes, as you're talking about, Lisa. And one stock that's weighing is General Mills. Shares are heading toward the worst day since January. This after they put up a mixed quarter, but it's more the outlook, the adjusted earnings outlook for the year, not great. And finally, it seems that consumers out there are not willing to pay higher prices for their favorite products. Again, this stock having its worst day since January. But it's not just General Mills that's down. As we talked about before, we have the shares of NVIDIA dropping, the last time I looked, by about 3% or so on the day. This, of course, is the U.S. There's a report saying that the U.S. may potentially put curbs on sales of AI-related chips to China. We also have the shares of Freeport-McMoRan down in sympathy with copper. And then ahead of those stress tests, those Fed stress test bank results later today, Lisa, we do have shares of big banks at this point basically unchanged on the day, maybe a little bit to the downside.
Abigail, thank you so much. Investors, meanwhile, keeping a close watch on the developments out of Sintra. Fed Chair Jay Powell joining the world's top central bankers in Portugal for a panel on monetary policy. Not there quite yet with an empty podium, but joining us now on what to expect when someone does take the helm of that podium is Bloomberg's Michael McKee. Mike, what are we looking for today?
Well, I think what you'll see is the three major Western central bankers reinforcing the message that they've put out over the last couple of weeks, that they're not done raising rates and that when rates go up, they're going to stay there for a while. The interesting wild card, and the thing that I would find most interesting out of this, is what the Japanese say. Kazuo Ueda, new central banker in Japan, with a currency that is just sort of diving off a cliff because of interest rate differentials at this point. And if those three are talking about raising rates and widening that differential, then what's going to happen to the yen? Now, this is not, Lisa, necessarily a forum where anybody's going to go out on a limb. And so I don't expect any major announcements or major moves, but you may see the Japanese try to jawbone a little bit. They've been doing that behind the scenes in Tokyo. And and we may see the others doing their best to indicate that it doesn't matter what happens in other economies. They've got an inflation problem, as you can see, and they're going to take care of that first and foremost.
There's a real distinction being drawn between the different central banks, Mike, and we're expecting to hear that contrast on the stage today. How will the tone of ECB President Christine Lagarde differ from that of Fed President Jay Powell?
Well, it's a matter of degree. The ECB is behind the U.S. in terms of its overall tightening, and they are still looking at an inflation rate that is stronger overall for the Eurozone than in the United States. Powell is in a position where they think they're pretty close to being at a tight enough level that they could sometime soon stop. The problem for all of these people is they don't want markets to start pricing in rate cuts and loosening financial conditions. So the emphasis is going to be on the idea of continually raising rates and leaving open the possibility that getting past July, we could see additional rate increases, because that will keep the markets on their toes. Interesting thing, when you look at the WIRP function on the Bloomberg, and I don't know if you've noticed it today, Lisa, but they have modified it. We now go out another year in terms of futures pricing. But basically what we're looking at is rate increase in July, or for the Bank of England, August 3rd, for those three, and then nothing for the Japanese. There's a 50 basis point move priced in right now for the Bank of England, the U.S. and the Europeans 25 basis points. So they want to keep the market's focus on that.
Yeah, and that's definitely going to be attention on the stage with Kazuo Ueda coming in. If he's talking about monetary theory, Mike, how awkward will it be for him at a time when they're moving in the exact opposite direction of everybody else and trying to juice inflation that's expected to keep increasing in that nation?
Well, everybody knows the situation they're in and what they're trying to accomplish. What'll interest markets more, and I don't know if they'll get into this, is what happens when they decide that the inflation rate is stable enough at a high enough level. How do they get out of the extraordinary policy that they have adopted? I've talked to people in Tokyo and with the Bank of Japan who worry that they're going to have an issue with rates rising very rapidly. Won't necessarily hurt consumers and businesses as much as it could hurt the government, because the government owns so many JGBs that debt service could become a real problem. So that's going to be the question when they start raising rates, or start to even get out of the raising rates or the low rate regime, and markets front run them. What happens to interest rates then? That would be a really good question to ask of him.
One thing that we're looking at when we turn back to the U.S. is that the economic data has been coming in strong, and at the strongest or the most frequent upside surprises versus the downside ones relative to expectations going back to February of 2021. This comes at a time when there are signs that the housing market has stabilized and started to rebound. Does this present a problem for Jay Powell?
Well, it's a problem if it means that companies continue to raise prices because demand is stronger than supply. That's an open question at this point. We did see inventories rise a little bit on the retail side, and the way inventories have been going, that's adding to GDP, but we don't know whether it's because companies think that demand is strong or whether it's an accident. They have overbuilt stocks. So that's going to be an interesting question going forward. The other side of that question is, now that we're building so much capacity in terms of chip plants and things like that, that's all going to feed into GDP and keep the economy strong, but it won't necessarily be inflationary unless we run short of building materials. So for the Fed, it's going to be a supply and demand question going forward, and that'll be kind of the bottom line question for the idea of whether there's a soft landing or not.
Michael McKee, stick by while we wait for this panel to begin. Coming up, that panel with Fed Chair Jay Powell joining the other central bank heads will be coming up shortly in Sintra, Portugal, and we will take you there. That's up next. This is Bloomberg.
covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's always for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg The Open. I'm Lisa Abramowitz. The ECB forum in Sintra now underway. Let's head over where we hear about data dependence and the importance on getting inflation under control. Take a listen.
And on the inflation release we had, which to us showed clear signs of persistence, caused us to conclude that we had to make really quite a strong move at that point. It was justified. My own view on that was, if we were really of the view that we were going to do 25 and then we were really sort of baked in for another 25 based on the evidence we'd seen, it was better to do the 50. And then we will, as Christine said, we will be evidence driven. So we will wait for the next set of evidence for our next meeting, which, to Christine's point again, will also be one where we will have a full forecast.
Have you received a lot of flack for the move?
Well, I think at the moment I can understand why there are critics of us and central banks. We have a job to do. I'm very clear that our job, all of us are very clear, I think our job is to return inflation to target, and we will do what is necessary. I understand the concerns that go with that, but I'm afraid I always have to say that it is a worse outcome if we don't get inflation back to target.
Something I know you've all been saying. Chair Powell, you've said it many times, and yet you paused, but you're not calling it a pause, and you're not calling it a skip. So what are we calling it?
Well, first of all, Sarah, thank you, and Christine, thanks for hosting us here in Sintra. So what we're calling it is maintaining the level of the federal funds rate at its current level for this meeting. Thank you, thank you. And we did that, if you think about it, we've raised the federal funds rate by 500 basis points since a little more than a year ago. And we think, so we've come a long way. We also think that there's more tightening power coming through. Really, policy hasn't been restrictive for very long. We started at negative real interest rates, and we've now moved up to where we actually are in restrictive territory, but we haven't been there very long. So we believe there's more restriction coming. And what's really driving it, to Andrew's point and Christine's as well, is very strong labor market. We've got a labor market that, where jobs are being created, there's strong wage gains, and that's driving spending, driving real incomes and driving spending, which is driving more demand and continuing to drive labor market. So the labor market is really pulling the economy. And my colleagues and I, as you will know, wrote down in our SEP 2 more additional rate hikes. The median was quite a strong majority, actually wanted 2 or more rate hikes. And the reason for that was, if you look at the data over the last quarter, what you see is stronger than expected growth, a tighter than expected labor market, and higher than expected inflation. So that tells us that although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough.
So I don't get why you didn't raise rates at the last meeting, especially I think it was a surprise that it was a unanimous decision to hold rates steady when you said a majority think that they still need to go farther on raising rates.
It's really just as you get closer and closer to the goal. What we're aiming for is a stance of policy that's sufficiently restrictive to bring inflation down to 2% over time. As you get closer to that, you get closer to the place where the risks become more in balance. So, we did 4 75 basis point hikes in a row starting in June of last year. In December, we moved down to 50. Then we did 3 consecutive 25 basis point hikes. So this is really just a continuation. We're going to move the decisions a little bit, make them with a little bit more time in between them, in an effort to get more information from the data to see how much restraint is really coming from these, through the pipeline, from rate hikes that we only made now, in many cases, 6, 8, 9 months ago. So that's why we did it.
So maybe in every other meeting hike.
We've not decided that. So the only thing we decided was not to raise rates at the June meeting. We have not made a decision to go to that. It may work out that way. It may not work out that way, but I wouldn't take, moving at consecutive meetings off the table at all.
I'm trying. Governor Ueda, first of all, it's great to talk to you. We haven't heard much from you outside of your policy meetings in Japan. I think the world wants to know why you're the global outlier here. You have decided to maintain your easier monetary policy in the face of rising inflation. Why?
So a simple answer would be, although the headline rate of inflation is above 3%, which is well above the 2% inflation target, we think underlying inflation is still a bit lower than 2%. That's why we are keeping policy unchanged at the moment.
Even though we've seen measures, including core, right, higher than the 2% level.
Yeah, the usual core is also above 2%. But let's say, let's look at the rate of increase in wages, which is an important determinant of underlying inflation. It has risen, but is now running at around 2%. Now, if you want a 2% inflation rate, wage inflation that's consistent with that would be slightly or well above 2% if you assume productivity growth rate is positive. So there's still some distance to go, we think.
And as a result of your policy being different than all these policies of your colleagues, the yen has gotten very weak and continues to weaken by the minute. Is it too weak?
Well, the yen is being influenced by many factors other than our monetary policy, including the policies of these 3 banks. So we'll see. We monitor the situation very carefully.
Monitoring the situation?
Yes.
For intervention purposes?
No, it's the jurisdiction of the Ministry of Finance. Decisions on intervention.
President Lagarde, how much would you like to see inflation moderate from these levels? Because we've already seen a nice moderation. For you to feel comfortable taking a pause or potentially going the other way?
Well, this is not what we're considering at the moment, okay? But if I look back at what we've covered, inflation was, I think the highest reading we had was 10.3. We are now at 6.1 headline. Core has moved a bit down, but we are really looking at both headlines, which is the measurement that we have agreed in our strategy and that is visible for people, for the consumers of Europe, but we're also looking at underlying inflation. And on that front, we are not seeing enough tangible evidence of the fact that underlying inflation, particularly the domestic prices, are stabilizing and moving down. So we're looking at as many measurements as we can because we want to be in sufficiently restrictive territory for long enough so that we are confident that we reach our 2% medium-term target.
Why is it so sticky, Governor Bailey? And why is your inflation rate higher than that of Europe's?
Well, let me distinguish headline and core for a moment. So with headline inflation, I do expect it to come down markedly this year, as we've been expecting for some time. And a lot of that is to do with the fact that the unwind of energy measures in the UK is on a sort of somewhat longer track, so that we will see some quite sort of discrete sort of jumps down in headline inflation in the UK throughout the rest of this year. And indeed, actually, energy prices are now somewhat weaker anyway than we thought they would be even quite recently. So it's core that's the issue, just as Christine has said. Core is much stickier. I think I come back to the labour market again. We have a very, very robust labour market and strong labour market in the UK. One of the striking things about the UK is that the size of the labour force is smaller than it was at the outbreak of COVID. So we have had a shrinkage of the labour force. We're seeing some reversal of that now, but we're still not back to where we were pre-COVID. So that is causing the position in the labour market to be very tight. And I see this when I go around the country talking to firms, because what they say to me very frequently is that their plan is to retain labour as much as they can, even in the event of a downturn, because they've been concerned and it's been difficult to recruit labour. So that's certainly taking place. So I would say there's a backdrop of a very tight labour market going on.
Is it Brexit related also?
I don't think Brexit is a part of that labour market story. I think a lot more of it is actually to do with, frankly, the response to COVID. I mean, we've seen people. UK is a little unusual in this respect. We saw people come out of the labour force during the COVID period. Other countries have tended to see that position reverse more quickly and more strongly than we've seen in the UK.
Governor Wada, when it comes to the inflation path for you, I mean, I know you'd like to see it continue to rise from here, right? What would it take for you to really strongly consider abandoning the yield curve control and negative rates?
So we have a forecast or a projection of inflation path that looks like it's going to go down for a while toward the end of this year on declines in import prices, and it's spilled over to domestic prices. And from there on, we are forecasting some increase in the rate of inflation into 24. But we are less confident about the second part. If we become reasonably sure that the second part is going to happen, that could be a good reason for a policy change.
If you see a steady increase?
If we are reasonably sure that the second part of the forecast is going to.
But didn't you learn from these three that inflation turned out to be not transitory?
Excuse me?
I mean, wasn't one of the lessons from the last year that inflation wasn't transitory and that there are some elements in it, was not,
yeah.
That there are some elements of it that are sticking and proving difficult to fight?
Right, so the second part is the sticky part, but it's still, as I said, we think less than 2%. We hope to make sure that it's going to go up to 2%.
Chair Powell, we've seen some progress in the U.S. Certainly, if you look at the headline CPI from 9% down to 4%. I know you're focused on core, but what would make you feel better about it, that you could remain on hold?
So the progress on headline inflation coming down is certainly welcome and ought to help keep inflation expectations anchored. But I think it actually helps to think about core inflation broken into three pieces. The first of which is goods inflation. And we've seen goods inflation coming down for 6 months now. And that's because supply chains are improving. The shortages are more because consumption is moving back to services and away from goods. So much progress is in non-housing services, which is a little more than half of our core PCE inflation index, and that's hotel services, travel services, food service, financial services, healthcare, those things. It's a generally very labor intensive. Some of it's quite cyclically sensitive, but some of it's not. The point is, that's where we're not seeing a lot of progress yet, and the reason is that, or one explanation for it is that labor costs are really the biggest factor by far in most parts of that sector, and so what we need to see, we've seen a lot of signs of softening in the labor market, but it's just kind of beginning. We need to see a better alignment of supply and demand in the labor market and see some more softening in labor market conditions so that inflationary pressures in that sector can also begin to subside.
Are you surprised that hasn't happened yet after 500 basis points of tightening already in a little over a year?
Yes, I think widely it's been surprising that inflation has been this persistent, but I think the bottom line is that policy hasn't been restrictive enough for long enough to start to see those effects. And the service sector is not especially interest rate sensitive, by the way, as opposed to, for example, the goods sector. So we wouldn't expect it to be the first to be affected, but we would ultimately expect, as demand softens and as the labor market conditions go more into balance between supply and demand, we would expect to see inflationary pressures subside in that sector as well.
Do you guys coordinate? Do you talk amongst yourselves?
Yeah, of course we do.
I mean, do you call before policy meetings?
Can I just want to follow up on what Jay said, because I think he's completely right. And I think that this is what I call the catch-22 issue, where we have an expected catch down where manufacturing eventually will align, or services will align on manufacturing, and that would be the logical consequence of the lag time that it takes for services to align with manufacturing and to see prices go down in that sector. The catch up is that of labor, because it is, as Jay said, labor intensive. It's generally relatively low productivity and low skilled jobs in those sectors, and also those jobs that are going to seek the catching up with pre-COVID times. And how that catch down, catch up will be resolved is going to be critically important for where inflation is heading. Because if we see inflation going down in that service sector and movement of wages while increasing at a moderate pace, then we would be in a relatively good place. But that is totally question mark for the moment.
Yeah, it sort of raises the question, Chair Powell, about whether we need to see a much higher unemployment rate in the U.S., and you're all dealing with a tight labor market, to finally really break inflation.
So, that the way we think about that is that there seems to be a path still for labor market conditions to soften and for demand and supply to get back into balance without the kind of large job losses that have happened in many prior cycles. And the reason for that is the level of job openings that still exist in the labor market. So it's still set 1.7 job openings for every person who counts as unemployed. That has been coming down. Actually, the number of job openings has come down now by almost 2 million. And what you're seeing is wage pressures are still high, but they're definitely coming down. You're seeing surveys of workers and businesses suggest that the labor market is not as tight as it was a year or two ago. So you're seeing a job creation is beginning to come down. There are a number of indicia that would suggest that we're getting the softening that we need. We're getting it slower than we'd expected, but nonetheless, it's happening. So it's still a possibility there. But it's so uncertain right now. In my view, the least unlikely case is that we do find our way to better balance without a really severe downturn. I think there's a significant probability that there will be a downturn as well, though. But it's not to me the most likely case.
That's the hard landing scenario.
Or I wasn't even thinking of hard landing. I was thinking of even a recession. To me, it's not the most likely case, but it's certainly possible. And of course, many forecasters do predict that.
Is Europe in recession, President Lagarde? I mean, we've seen 2 negative quarters of GDP. I don't know how you define it. But
I think the first quarter of 23 was actually completely flat, wasn't negative. So technically, I think you could argue that we did not see a recession, but it's stagnant, to say the least. And the expectations for Q2, particularly in the industrial sector, if I look at PMI numbers, are not particularly are not giving us great hope that there will be a strong recovery. We see a second half of 23. Up from the first half, certainly, but moderate. We have a 0.9 forecast for the whole year.
Do you agree with Chair Powell? Do you think you can get away with this tightening cycle without dragging Europe into recession?
Our baseline does not include a recession, but it's part of the risk out there.
Are you willing to tolerate a recession?
Well, the interesting thing for us is that if you go back to last autumn, last November, when we did a forecast, we were predicting quite a long but quite shallow recession. And the economy, as I said earlier, has turned out to be much more resilient so far. Now, I think you can sort of point to a number of things that underlie that. One of the things I would point to is the fact that we've had a very sharp fall in energy prices in Europe. And that obviously has helped with the whole question of the terms of trade shock that we've been having. It's done quite a bit to reverse that terms of trade shock, and that feeds through into national income. So I'm not surprised that we've had this reversal in one sense. What was surprising, but actually very helpful, was that, of course, we did have this big fall in energy prices and a much better winter, frankly, than we thought we would have. So, we're going through this year now in a more resilient position than I expected. So we're not currently forecasting it, but obviously we have to watch it very carefully.
How's the Japanese economy faring? I mean, it's very exciting if you look at the Japanese stock market at a 30-decade high. What's happening fundamentally?
It's doing fairly well. I mean, apart from the contribution...
All right, right now you are listening to the European Central Bank panel from Portugal, featuring Fed Chair Jay Powell, Board of England Governor Andrew Bailey, ECB President Christine Lagarde, and Bank of Japan head Kazuo Ueda. They are being moderated, this panel, by Sarah Eisen. And we're going to go back and listen to the central bank policymakers discussing the economy on a global scale and Fed policy. Let's listen in.
There's also green DX related business fixed investment taking place. So investment is fairly strong at the moment. We think the economy is going to expand at slightly above potential for some time. But there's, of course, a lot of uncertainties going forward, including what may happen in Europe and the United States.
I asked if you guys coordinated or talked about monetary policy before. I mean, does that happen? Should it be more coordinated? Because you're all doing different things right now.
Well, I mean, let's start. I mean, obviously what we don't do is say, what should we do, what should you do? Because we're all setting the monetary policy for our areas, and that's the law in all of our areas, actually, so we don't do that. But we do talk a lot, and I think it's important. I mean, it's important at all times, but it's particularly important in recent times at the moment because we're facing such big global shocks. We've got common shocks. They differ a little bit in terms of their impact and their effect, but there's some huge global events going on that are affecting all of us. So, I think we do talk quite a lot and we see each other quite a bit because it's important we do that. And, we share wisdom on how we're sort of interpreting the things that are going on around us.
Yeah. I guess we are in a flexible exchange rate world, so we do policies independently. But of course, we exchange information, which is very, very valuable.
Do you think that, Governor Ueda, do you think that they are over-tightening?
No.
No, you don't. You approve of the policy. You've had a very tight labor market for a long time in Japan, even before COVID.
Yes.
Demographic issues
demographics.
There. Yeah.
It's working in a way to tighten the labor market for quite a long while. And it's going to continue this way for a while.
I mean, the economic conversation, it gets into an interesting question, Chair Powell, where now we're wondering, easier to fight inflation last year when the economy was doing better, but now that we're seeing signs of softness and weakness in manufacturing, and you mentioned the labor market starting to cool off, about overdoing it and the risk of overdoing it. Do you wonder about that, or you're still just focused on inflation?
Let me say the U.S. economy has actually been quite resilient, and the data that we're still seeing, including since the last meeting, still is consistent with with an economy that's resilient and growing, albeit at a modest pace. As I mentioned earlier, though, yes, there was no question. The first question was how fast should we go, and we went pretty fast, and we got to a level that we believe is restrictive. We're in restrictive territory. If you take the federal funds rate and you subtract some forward-looking measure of expected inflation, you'll get a significantly positive real rate, meaning we're probably in restrictive territory. So, and I think we have steadily slowed the pace of our moves, and it's appropriate to do so for one reason, because the more information we get, the better decisions we'll make. The risks of doing too much versus doing too little become more in balance. I wouldn't say they're in balance yet, but they're becoming closer to balance. I still believe and the committee clearly believes that there's more work to do, that there are more rate hikes that are likely to be appropriate, though.
So you think the risk is still of doing too little and not getting control of inflation?
Yes, and of course
But inflation expectations are, I don't have to tell you, very well anchored.
No, but the thing with the risks is that there may be social costs associated with restoring price stability. The social costs of failing to restore price stability will be higher in almost all likely cases. We've seen what that looks like, and it's just something that we have to do. It's one of the principal things that society counts on us to accomplish, and I think we all feel committed to accomplishing it. It is of course a good thing that inflation expectations have remained anchored all this time, but our understanding of inflation expectations is not a precise one, and the longer inflation remains high, the more risk there is that inflation will become entrenched in the economy. So we have to, the passage of time is not our friend here.
What about a higher inflation target? I know none of you want to talk about that, but on Wall Street, there's this idea that a lot of things are changing in our economy structurally. The onshoring of supply chains and chip plants and all of that is going to be expensive and could permanently create higher inflation rates. Couldn't it, President Lagarde?
Well, at this point in time, and given the fight that we lead against inflation, the yardsticks that there is, the strategy that we've agreed, the expectations that we have, and the inflation targeting, as it has been said, there is no way that any of us, I think, would consider changing the gatepost halfway or more than halfway through that journey. I think it's wonderful to have a forum like Sintra, which brings together academics and other than policymakers to actually consider those ideas and to explore them and to weigh the cost and benefit and all the rest of it. But at this point in time, I think we have to be as persistent as inflation is persistent, and we have to be resolute and decided and determined in reaching the target that we have set, and not debate the target as we are running that race.
But it does raise the question, Governor Bailey, about how far inflation will come down to.
It does, but let me reinforce what Christine said. What is the inflation target? It is the definition and practice of price stability. In our legislation, it is what price stability is taken to be. That is the 2% target. And I don't think anything has changed in terms of what we mean by price stability. And I think that's a very important point to start with. It's the anchor that we have to always maintain. Now, in terms of bringing it down, yes, I mean, we're facing, have faced and are facing, the biggest challenge for a very long time. But we have to meet that challenge. I don't think it is the right thing to do to say, well, this is all a bit difficult, let's change the target. I really don't think that is the right thing to do. I think that would be a very bad thing to do. And I think, although I very much agree, as Christine was saying, that there are things we understand about inflation expectations and things we don't understand about inflation expectations. I think taking risks of that nature with inflation expectations, but also, fundamentally changing what we mean by price stability when there's no good reason to do that, I think would just be the wrong thing.
How do you read, Governor Ueda, the inflation expectations? Because they've crept up in Japan as well.
Yes. We've been for a long time trapped in a zero inflation expectations equilibrium. So we've been trying very hard to move this to a 2% inflation, 2% expectations equilibrium. To do so, we had to de-anchor expectations from zero, raise inflation expectations, and in the future, we will have to re-anchor them at 2%. This is a formidable task, and now we are seeing signs that inflation expectations are rising. But as I said, not to the extent that we are fully in the 2% inflation expectations equilibrium.
It also raises the question, you mentioned the labor market and some of the post-COVID changes about just how COVID has distorted the data and has made travel, for instance, so strong for so long. And I wonder, Chair Powell, how you look at the COVID impact on the economy and how it's changed the way you make forecasts and you think about what's happening right now.
Well, I think there are changes, and we don't know how persistent they will be. Certainly work from home, and you can see the effect on commercial real estate, particularly office real estate and the surrounding retail that is suffering in many major cities. We don't know how long that will last. It feels like some part of that will be persistent and will last. You mentioned the data as well. I guess response rates to a lot of the data that we collect and that other organizations collect, the response rates have gone down, and you're seeing a lot of volatility in some of these data series, more so, I would say, more so than we've seen historically. So the data are even a little bit foggier than they usually are. But we'll be, in terms of what the effects of COVID, it's going to have long-term effects on the economy. There may be loss of productivity. There's certainly been, for a generation of kids, some loss of education and training. I think it's hard to say how persistent all this will be.
What is your level of concern of commercial real estate, since you mentioned it in the U.S.?
It's something that we, of course, are watching carefully. The way it lays out is the large banks don't have large concentrations of commercial real estate, so that's a good place to start. A surprisingly large part of exposure to commercial real estate is in the banks that are under $100 billion. But there, the worry is more banks that have a high concentration, and they're relatively few. So it's something that we're carefully monitoring. Bank supervision has a playbook for this. So supervisors are talking to banks about their concentration of real estate and what can they do and how do they manage themselves out of this. It's something that we're well aware of. It's not a surprise, and we're focusing on it.
Is it one of the reasons you were cautious in the last meeting?
Commercial real estate? I wouldn't say so. No, I just, generally speaking, it was at the last meeting, it was about, what's in the pipeline, how far we've come, what's in the pipeline. I will also say that, though, that the bank stress that part of the decision, in my thinking anyway, was the bank stress that we experienced earlier this year. There's a fair amount of research showing that when something like that happens, bank credit availability and credit can move down a little bit with a bit of a lag. So we're watching carefully to see whether that does appear. Of course, tightening in financial conditions is what we're doing intentionally. So we have seen bank credit conditions tighten. The question is, and that's what we're trying to achieve. The question is there another channel of that or a greater amount of that coming from what happened in March? We don't really see any evidence of that, but I think that's certainly in the back of my mind to see whether we do see that.
Yeah, it gets into the question about lags. How long are lags, Governor Bailey? And do you expect to see more?
It's a very interesting question in terms of the transmission of our monetary policy decisions. So if I can just illustrate it with the UK case, and obviously it's not the only part of the transmission mechanism, let me be clear, but it's an important part, and illustrate it with the UK mortgage market. So we've seen a big structural change in the UK mortgage market since the last tightening cycle of monetary policy, which, of course, accepting passage of time, was about 20 years ago, actually. And that change has been a change from a variable rate mortgage market to a fixed rate mortgage market. Now, I must say, obviously with Jay here, it's not a US-style fixed rate mortgage market. It's a much shorter term. So the average term is often around 5 years. But we know, and we think around about 85% of the stock of UK mortgages are now sort of in that part of the market. So we know that the transmission of monetary policy is going to be slower as a result, because obviously it depends upon the sort of the timing and the sequence of those fixed terms coming to an end often. So we have to judge that. I mean, it's another factor and another sort of element of uncertainty that we have to judge when we're taking our decisions, which is how much of the tightening that we've already done has come through and how much is yet to come through. And we know that referring back quite a way into the past isn't going to help us in that respect. So we have to sort of formulate those views afresh. And so it is part of our decision-making calculus is how much more has to come through, when will it come through, and also how powerfully will it come through. And all those things are things we have to take into consideration. And as I said, history isn't going to be a great guide for that, given the change in the market.
So a year? What's a lag?
Well, what you see, and of course you can compute, is the sort of the profile of mortgages coming up for renewal, renewed terms, and we can see that over the next year or so, there's quite a lot of fixed rate mortgages are coming up for renewal. So yeah, we can factor that in. There is another element, I say, of uncertainty as to just how that will work its way through.
President Lagarde, how do you think about the lags?
I think of the lag in three steps, if you will. The first one is transmission in terms of tightening of the financing terms that are made available and how markets absorb the decisions that we make. And on that front, we have a good and reasonably rapid transmission. We see it in rates, we see it in volume of loans, and on both accounts, there is a good absorption and a rapid transmission of our monetary policy decision. But that's only step one. What we need to see is step two and how it materializes on investment by corporate, and for households, it's predominantly mortgages. And for the euro area, there is a lot of heterogeneity, because you have markets where mortgages are at fixed rate, markets where mortgages are at floating rates, some that are readjusted every so many years. So we have to look at all those data very carefully. But it seems that the transmission is likely to be less rapid than it had been in the past, because there are many more fixed-rate mortgages now in the euro area than there was, say, 15 years ago. And that's not it. We need to see it then, channeled to the third step, which is inflation. So we want to see that transmission strength through step one, step two, step three, and make sure that this is really having an impact in terms of the fight we have against inflation.
Governor Ueda, do you worry about the impacts, the lagged impacts of their policies on the global economy and on your economy?
Oh, yes, but for ourselves, we haven't had any serious monetary tightening for 3 decades. I was a board member of the BOJ 25 years ago. Then the policy rate was about 20, 30 basis points. Wow. Now, minus 10 basis points. So,
and it doesn't sound like it's changing anytime soon.
So in terms of that, the lag in the effects of monetary policy could be at least 25 years. We'll see what will happen if we get to normalize policy seriously. But we'll have to be very careful here.
Be careful what you wish for, I guess. So, Chair Powell, are you more worried about the lag impacts than they are because they're still hiking rates?
I don't know. I wouldn't want to compare. I would just say again, so what's different this time is actually, though, that markets move substantially in anticipation of moves. So by the time we lifted off in March of 2022, the 2-year had moved from 20 basis points up to 200 basis points. So financial conditions now move in expectation, and the whole modern communication strategy really helps that along. So that is different. What may or may not be different, and we also haven't had this kind of tightening in 3 decades, really. We've had tightening, but this looks more like tightening cycles from the 70s and 80s. So what we see is a picture of literature that has, the older literature says, a year or two for activity and add a year for inflation. There's new literature that says it's much faster than that, and I think we just have to use our, to watch and see what's happening. There are beginning to be, there are reasons to argue that it would be faster this time or slower this time, but I just don't think we know at this stage.
Well, it kind of gets into the question about the markets, and you're saying that it's a transmission mechanism. You're all talking very hawkishly and saying there's more work to be done and we're still worried about inflation. The markets pretty much think you're almost done, all of you guys. Maybe one more hike in July and then done, and then into cuts next year. Is that wrong, President Lagarde?
I look at the data we have. I look at the mandate we have. I look at the transmission lag, and we've decided for ourselves that we would use 3 criteria. That's what we are focused on. Of course, we are not completely oblivious to what happens in markets, but we have to be guided by what the mandate is, what the data delivers, and what criteria we take into account in order to determine our policy and to establish our stance going forward. That's the only way to go.
But I guess, there's financial conditions, and I don't know, Governor Bailey, are they working against you? You're trying to fight inflation, and MSCI World is up nicely this year.
Well, by the way, the market, I don't think thinks we're nearly done at the moment. They've got a number of further increases priced in for us. My response to that will be, well, we'll see, because we are, as we were saying earlier, we're essentially evidence-driven in that sense. So, we'll make our decisions based on that. I think you're right to point out, as you said earlier, and I would draw this point out, that there are 2 parts to this. There's where the peak is, and then how long it's sustained beyond that. And I think both of those are relevant. Both of those are things that will, sorry to state the bluntly obvious, will emerge with time. But I've always been interested that the market thinks that the peak will be quite short-lived in a world where we're dealing with more persistent inflation.
Right. They did finally price out the cuts in the U.S. a few weeks ago. Market was primed for cuts. I assume you were pleased to see that that's no longer the case.
So if you go back and look at forecasts from the participants on my committee on inflation, you'll see, we've been consistently thinking this is going to take some time. It's going to be a process that will take longer than we would have hoped. And it may well be a bumpy process. But markets have gone back and forth between pricing and what appearing to price in pretty quick declines in inflation to coming back to being more in alignment with the thinking of the committee. And that's where we are right now, is closer to where committee participants are. But as Christine said, we're not focused on what the market's forecast is. We have our forecast. All of us who are on the committee, we work hard to develop an understanding of what's driving inflation and what the path forward for inflation is. We make our best estimates. And that still is that it's going to take some time. It's just going to take some time. Inflation has proven to be more persistent than we expected, not less. And of course, if that day comes when that turns around, that'll be great. But we don't expect that. We don't plan for it.
So is it counterproductive to you that the stock market has rallied, the bond market has rallied? The market is fighting the Fed. The market thinks you're closer to the end, and that does make financial conditions easier.
Wasn't that the?
You can't fight the Fed, but they're fighting the Fed. Is that a problem?
I don't see it that way. I don't look at it that way at all. Honestly, we have different jobs. Our job is to bring inflation down to 2% and sustain maximum employment. That's our job. That's what we think about. We look at the data, and that's what we care about. And markets react. Different parts of the market react in different ways. It's just not something that is a principal focus of our work.
But it did seem last year like you wanted a weaker stock market. You used the word pain at Jackson Hole. It seemed like you were trying to communicate that financial conditions should tighten, and less so this year. Is that right?
Not really, no.
Okay.
Of course, we work through financial conditions. That's what we do. Our rate and our, all the things we do and say work through financial conditions to affect the real economy. That's how it works. But it's broader financial conditions. So we're not focused on any one market. We're never thinking, oh, let's do this to this market. It's just, in general, let's communicate what we want to do and why we want to do it. And financial conditions adjust. And that's really all we can do. We do not target particular parts of the market, although, of course, we do monitor market conditions.
So you don't care what the stock market's doing?
I look at broader financial conditions. It's one of many, many conditions, along with interest rates, credit spreads, everything, all of the conditions and the availability of credit. It's one of many, many things. Again, we don't focus on any one thing as the key thing.
Governor Wada, how important is it to you, the markets, as it relates to financial conditions and the mechanism for monetary policy?
You mean the stock market?
Stocks, bonds, currency.
So stock prices have been rising fairly sharply since spring this year. Stock prices theoretically are affected by interest rates and investors' view of the economy. We haven't changed interest rate, so probably investors have become more optimistic about the future of the economy. Of course, we don't want serious financial imbalances in the economy, so we keep monitoring.
How do you think about, President Lagarde, the risks to the economy, especially geopolitical risks? In Europe now we were all glued last weekend to the news out of Russia and the Wagner rebellion, and we're wondering if now political instability in Russia presents a further geopolitical risk to the global economy.
Well, I think we all look at it, and we are all concerned about geopolitical development by virtue of the profession that we have, because it does have an impact on supply chain, it does have an impact on trade, it does have an impact on the uncertainty, and we can only say that at this point in time, uncertainty is high overall, and a big factor of that uncertainty has to do with the geopolitical difficulties and conflict or quasi-conflicts that abound at the moment. So yes, we are looking at that, but do we have to make a moral judgment on this, that, or the other? This is not the job that we have, but it clearly has an impact on how the economy is going to change and be transformed, and whether it will have an impact that is inflationary or disinflationary, I think is also to be determined. I think there will be various schools of thought along those lines.
Yeah, I wonder how you think about next winter. I mean, Europe got lucky.
We hope it's mild.
What if it's not?
But storage is, 69%? Michael, the expert on Isabel's panel, said that 69%, and we are going to hit 95% by the end of the summer. So that should put us in a good position for the winter. But I'll say one thing, which probably we had not factored in sufficiently, and maybe that applies to all of us. It's the resilience of our economies and the resilience of the entrepreneur, the corporates, the way in which we have sort of, in a matter of a few months, reorganized ourselves. Just think 1 year back, everybody thought that the German model was dead, that Europe was going to be completely on its knees. Well, these things have not happened, and the resilience has been demonstrated at all levels of society.
I totally agree with Christine on this. That resilience, I mean, you see it when you talk to businesses. I spend a lot of time talking to businesses, and I've spent a lot of time in recent months talking to food-producing businesses to try to understand the sort of, the slower than, frankly, we expected decline in the rate of food inflation. And one of the things that I get quite consistently, and this is where sort of the Ukraine-Russia situation comes through for real, is they say, well, last year we brought forward sort of supplies to a much greater extent than we would normally do because we were not confident we could actually get them. Consequences, we've locked in higher prices for, sometimes they say 6 months to me. And that, of course, is affecting the passage of inflation, particularly food prices in this case. So these things do have a very direct effect and are continuing to have a very direct effect, actually.
But there's nothing central bankers can do about that, is there?
Well, I think the first thing we need to do is understand it. That's a good starting point. Well, we have to then design.
You can always just keep crushing demand, but you can't do anything
about
food supply.
We have to design policy. I mean, we have to design policy and take our decisions with the best. We always take policy. We always take policy decisions on a forward-looking basis. So we have to do it with the best information and understanding we can get of these things.
So do you still? So to what extent, I guess, is the war in Ukraine driving supply side inflation for materials around the world.
Well, following on from what I was just saying, I think the conclusion I draw from that is, and this is what the businesses tell me, is yes, we are going to see actually a fall in the rate of food price inflation, for instance, but it is taking longer than we expected. So that's what we have to factor in and decide how best, in a sense, to respond to that with monetary policy.
It's not just Russia. Governor Ueda also, we're following the tensions that have increased between the U.S. and China, between Europe and China. Do you think that's having a material impact on global growth?
Well, at least there's a tendency to relocate production sites out of, say, China into other Asian economies, including, to some extent, Japan. So in the short run, this is having a small positive effect on the Japanese economy through business fixed investment. But in the longer run, there will be inefficiencies all over the place. So we'll see.
So Japan's a beneficiary of the flight out of China?
In one sense and in the short run. But in the long run, I'm not sure.
I mean, Chair Powell, how do you think about, it's obviously a risk and it hurts trade. How do you think about the U.S.-China relationship as it impacts the economy?
So that is the way we think about it. Of course, we don't have any role to play in the relationships between the countries, but China's a very large, important economy. It's a big trading partner, mainly consisted of us buying things that are made in China. I don't think, and of course, the Chinese economy came out of the COVID and looked like it was recovering strongly. Now it doesn't look like that. It looks like it's slowed down, and there's some issues there. From the U.S. standpoint, at the margin, that probably means a little bit less global demand. I wouldn't say it's a first-order consideration for us, though.
How does Chair Powell referenced the disappointing nature of the Chinese economic recovery. How does that play into Europe's recovery or the global growth picture?
Well, first of all, I think we have to be attentive to the emerging market economies at large. At the moment, they are producing about 60% of global growth, some of which is now a bit more focused on domestic development and consumption, and less so on trade. But if you look at the trade volume numbers from China to many other countries, particularly the advanced economies, that has not changed significantly. So the trade volume is still significant. And I'm not breaking any news here. The Chinese authorities themselves say that they're likely to have a 5% growth this year in 23 rather than the 6% that they had initially forecasted. So that will have an impact, given the size of the Chinese economy, on global growth at large. We have to, when we do our projections, when we look at the economy, we look at the global economy, and then we sort of narrow down and zoom on the European economy and the euro area in particular. But everything that happens in China, in the United States, in the UK, in Japan, in emerging market economies actually matter for us because we are strongly interrelated and have been trading with each other for a long time. And if anything we've learned from COVID, in addition to the pain and suffering for many, is the fact that we are vastly dependent for the supply of rare earth and various metals that will be critical for the development of the economy of tomorrow if we decide to firmly go towards the green economy that we should be aiming for.
As an open economy, one of the things is just exactly as Christine says in terms of how we do our process. One of the things that we spend quite a bit of time on is world export prices. Now, actually, in the recovery from COVID, and of course this was the supply chain shock, we saw quite a big contribution to goods price inflation from world export prices. We're now seeing those prices definitely start to weaken. So that will be another determinant going forward of policy.
As central bankers, do you plan for the worst case scenarios on the geopolitical front? I mean, if China invades Taiwan, then what? What does a central banker do? Is there a contingency for that, Chair Powell?
We use our tools to achieve our legal mandates, if that happens.
Got that Fed speak down. You'll hold a special meeting. especially. No, I mean, it's a volatile world we live in, right? And then
so
there's
we do
impacts.
have, in every FOMC cycle, we look at, our staff works up 6 or 7 or 8 alternative simulations, and they simulate, different things. It's not so much geopolitical events, though. It's more different ways the economy could play out. And we all the participants read those and think about them and talk about them, and they come up in our meetings, we talk about them. So it's very helpful because you can't get too focused on the modal path in a world where it's just very hard to predict the economy, even in normal times, it's very hard to predict the economy, let alone times like today.
What sort of simulations do you talk about?
I'm going to leave that to your imagination.
I bet I can think of a few. President Lagarde, Chair Powell did talk about, one of the things that I don't know that there was a simulation of is we had a few bank failures in the U.S. this year. And I know it forced some of you into action to shore up banking systems. Are we in good shape now? Is the global and European financial system in good shape? Have we healed?
Here, I can only speak to the banks over which we have supervision, and those are the euro area, the European banks. But I'm looking at the euro area specifically. We have been, enforcing Basel III to the entire banking sector. The capital ratios are very high, 15.3% if I recall. The leverage coverage, the liquidity coverage ratio, very high as well. So we have not experienced, the turmoil or the difficulties in Europe. And Europe does not include Switzerland. Thank you very much. But we are extremely attentive. We reinforce the stress testing constantly. We are I'm very pleased to see that the Basel III agreement has now been reached, as I understand, between Parliament, the Council, and the Commission, so that we can actually roll out Basel III with as limited exception as possible. And we have to continue doing that job.
Any lessons that you took, Governor Bailey, from what happened earlier this year?
Well, let me start with a sort of bit of backdrop. I think it's important, drawing on what Christine was saying, I think it's important to, in a sense, reflect the fact that the regulatory changes we made after the global financial crisis have paid off, in the sense that we've been through, and we are going through, some huge economic shocks. And the banking system, certainly I can speak again as Christine does, I can speak for the UK banking system, is resilient to them and is doing what we want it to do, which is support the economy, not the other way around, to be honest, going back to the crisis. So that's an important starting point. Now, I think there are important lessons from, important issues that we have to reflect on from what happened. Christine made her subtle reference to Switzerland. Well, there's a huge sense of irony in the British, Christine. Look, I mean, there is obviously a question posed by the Credit Suisse, handling, which is, are the resolution plans for the major banks that we've spent the last 15 years developing fit for purpose, or are they not fit for purpose? And I'll come to that. If they're not fit for purpose, then of course we cannot sit here and say all's fine, because clearly we're going to, regrettable though it would be after 15 years of work, we're going to have to sort of, tear them up and start again. Now, I'll give you my view on it. I'm going to say this. I have not yet heard the case made to me which suggests that they are not fit for purpose. I'm going to state that, but I'm not going to leave it there. We have got to have, we've got to have this out and decide whether, it goes one way or the other. My starting point is I remain to be convinced of that assertion, but we can't let it rest there. I think we've all got the question of, how our banking systems handle, a steep rise in interest rates. We do stress tests to test that. We've got capital provisions for, related to that. And we've all got to think hard. I think the third thing I'd say is we've got to think hard about the speed of run question. But I think we've got to think pretty carefully about that, because if we go to extremes on that argument, we're essentially heading to narrow banking. And speaking myself, I don't think that is a sensible place to head to. So we've got to think quite carefully, but quite, I think, creatively about how we maintain the banking system that does what we want it to do, which is create credit in the economy, create assets that are naturally illiquid, and deal with this speed of run question. And we've got to take that one on.
We're actually going to get stress tests this afternoon in the U.S., which I won't ask you about, Chair Powell, but I will ask if you think that the U.S. regional banks are resilient right now.
I do. So I think, first of all, I think the overall banking system is strong and resilient with very high levels of capital and liquidity, double the levels that they were at, and then some before the crisis. So the innovations that we put in place, the regulatory changes and higher capital, those are all in place in the United States as well. So when it comes to the events we had earlier this year with 3 banks that had pretty idiosyncratic business models and funding models as well, I think we need to learn lessons, and we're not hiding from that at all. We understand there going to need to be regulatory strengthening of both regulatory and supervisory practices as it relates to institutions of that general size, I would say.
You got a lot of questions on that from Congress last week.
That's mostly what they wanted to talk about.
They want to make sure that you aren't, well, in part, not going to increase capital levels and sort of choke off the small and regional banks in this country and make it hard for them to compete.
So the U.S. has something like 4,500 banks. It's the most banks by a pretty big margin, I think, of any major economy. And we think it's a real benefit to have banks of different sizes and business models that serve local communities and offer different products, as well as having the large banks. And the large banks in the United States are very strong, well-capitalized, a lot of liquidity. And they've been a source of strength, I think, through the last couple of events. So I think it's important that whatever changes we do make, keep in mind the need to preserve the business models of these of smaller banks and not just of the largest banks.
Any concerns for you, Governor Ueda, on the strength of the global financial system at this point, as we go through this, I don't know, once in several decades tightening period?
I can only talk about Japanese banks.
Mm-hmm.
I think they are well capitalized. They're capitalized. They have enough liquidity. It's true that some smaller banks, regional banks, are sitting on non-negligible amount of valuation losses on their security holdings. But on average, that's about 1% of their core loan capital. So it would be okay. But if we do get to normalize our monetary policy, because we go into the 2% inflation rate equilibrium in the sense I discussed earlier, then rates may go up by large margins. And we will have to be careful. We'll have to be carrying out all sorts of stress tests, I think.
I also wanted to ask you, if you go into a more normalization stance away from negative rates and the yield curve control, how you'll manage the risk of the government's enormous financing needs, and whether that's a concern that you think about.
Well, we keep saying that it's the business of the government and the Diet to create sustainable government finance.
Fiscal policy in general, I'm curious if you guys will bite on this. Is it helpful right now or hurtful, President Lagarde?
Everybody has to do what everybody has to do. Man's got to do what a man's got to do. Monetary policy makers have to decide on monetary policy, and fiscal policymakers have to do their job. It is true that there are circumstances where working hand in hand and supporting each other has proved helpful. I think we had a very good demonstration this morning in one of the lectures that we had. I think what we have very clearly stated as a governing council of the whole Eurosystem is governments, please, it's time now to roll down the measures that you had decided for COVID and for energy purposes, and that you adopt a path that will take you to better sustainability of your public finance. So we hope to see that, the fiscal space that has been allowed for the various non-conventional fiscal support that were decided back in 22 and 23 very much should be rolled back in the course of 23 and certainly should not be expanded in 24, bearing another major shock. But that's our recommendation, and we make it very clear in our monetary policy statement and have made it very clear in the last statement that we issued.
I mean, we learned in the UK, what was it last year, when monetary and fiscal policy don't work together, it can be a big problem.
Well, because what we had to deal with in the UK last autumn was actually a financial stability issue, and we dealt with it, and it was very clear that that was the issue we dealt with. We didn't deal with anything more than that. It's not our job to get involved in fiscal policy in that sense. And we always, when setting monetary policy, take fiscal policy as announced, as a conditioning sort of assumption for our decisions. So I don't go beyond that in terms of commenting on the stance of fiscal policy. I mean, the one thing I've said in recent times, and I don't mind saying it again, is that I welcome the fact that the Chancellor is very much using fiscal policy to try to address the structural issues in the economy. That's not a comment about the stance of fiscal policy about more or less. It's a comment about the fact that, going back to the point I've made about labour markets, and actually the low potential rate of growth in the UK economy, that the more we can do to tackle that, frankly, the better.
What about you, Chair Powell? I mean, there's been a lot of fiscal largesse in the United States, the COVID stimulus, and now even new policies that are just filtering through, like Inflation Reduction Act, infrastructure, CHIPS. There's still American Rescue Plan Act money getting doled out. Isn't that making your life harder?
Well, so echoing my colleagues, our assignment is to deliver price stability kind of regardless of the stance of fiscal policy. And we don't play a role, formal or informal, in advising the fiscal authorities. There are other agencies in Washington that do that, and that's really not our job. I will add, though, without crossing any lines, that the spending during the pandemic was very high, and it's come down. And so we look at the fiscal impulse from the level of spending, and it's really not material. It may even be slightly contractionary, but let's just say it's flat. You identified those bills, and I think you are seeing some of that money showing up in construction. Construction numbers, it's supporting construction activities, particularly the infrastructure bill. But I wouldn't say that that's if you look at where the inflation is in the economy, I wouldn't say that that's an important driver of inflation or something that we think about or consider.
So you mentioned the consumer, so the excess savings you think have pretty much come down. Where do you think the U.S. consumer is headed?
The consumer had savings from two sources. One was just the fact that people couldn't travel and couldn't kind of spend money on services. That was a lot of it. And there were also the fiscal transfers that happened. And those, there are many different estimates. I would say for people at the lower end of the income spectrum who tend to have a high marginal propensity to consume, most but not all of that money is gone. So there's certainly some residual support for spending in laws that passed at the beginning and during the pandemic. But that's, again, I wouldn't say that's today the main driver. I think if you look at the strength of the labor market, still creating more jobs than there are new entrants to the labor market, and wages are still pretty high. So you're driving up disposable income, and that is driving consumption, and that's driving the economy.
Wanted to also ask you guys about the balance sheet, very hot topic. Governor Wada, how do you think about the expansion of the balance sheet, and how much is too much?
Well, it's a tough question to answer. At the moment, we are using government security purchases to hit the range for the long-term interest rate we have set, which is 0 plus minus 50 basis points. So the size of the balance sheet is an endogenous variable.
The rest of you are kind of in shrink mode in the balance sheet, or roll-off mode. You've been more aggressive, Governor Bailey. Has it gone smoother than you expected?
Well, so far, I don't want to tempt fate, it's gone very smoothly, actually. By the way, the reason that you say more aggressive, just to be clear, is that we've got a longer duration of bonds in our portfolio, government bonds in our portfolio. So leaving it to an organic runoff would mean a lot longer runoff for us, I think.
That's why you're outright selling.
So that's why we're selling. And so the target we set for the year, the 80 billion target, was the sum of the natural runoff plus the difference between the target we set and that. And it's that element that we're doing as active sales. So that's gone, I would say, very smoothly, actually, so far. I'm very happy with the way it's gone. I think the second question that we're certainly looking at actively, of course, is just how far will we go? And I look at it particularly in terms of the stock of reserves now in the system before we hit what I would call the equilibrium level of reserves. Now, we may go on selling the QE stock below that because we would shift our operations around. I would expect to do that. But it's important to focus on where we think that sort of natural level of the balance sheet, which won't be constant over time, by the way, but where we think that natural level of the balance sheet is relative to where we are today.
How do you think about it, President Lagarde? And is there pressure building for you to go faster when it comes to shrinking the balance sheet?
I would say that the interest rate is the primary tool that we're using at the moment. Second, there is almost a contractual reduction of the balance sheet of the ECB because there is a reimbursement of the TLTRO that we had put in place during the pandemic, and that is actually happening now, if not yesterday or the day before. Third, as of the 1st of July, we will stop any reinvestment under the asset purchase program. So there is a natural declining of the balance sheet of the ECB, which is only, a first step. We are discussing our operational framework. Hopefully, we will be able to complete that work in the next 6 to 9 months, and that will really determine the desirable size of our balance sheet, which is always a factor of also the circumstances and the situation we are in. But that is coming.
Is it going smoother than you thought it would as well, Chair Powell, QT?
I'd say it's working as we had hoped and expected it would work. We have a entirely passive program. As treasuries and mortgage-backed securities mature, they roll off subject to a cap, and it's been moving along at a pace. The underlying pace, if you hit the cap, is about $1 trillion a year. And reserves appear to be quite ample, so it has a ways to go.
Is there anything that would make you speed that up or slow that down?
We always say that we're prepared to adjust in light of evolving conditions, but I don't see anything that would cause us to want to do that right now.
Okay, so in the moments that we have left, we've talked about a lot of the risks. We've talked a lot about some of the concerns out there. I want to hear some optimism, maybe, and what makes you feel. None of you are really talking doom and gloom on recession, but what makes you, President Lagarde, optimistic right now?
In my professional field?
However you want to interpret the question. Personally,
otherwise, there are lots of things that make me happy, and I hope for all of you. I'll just mention one success, which I'm really proud of, and I'm very proud that Fabio Panetta was the one who led that exercise on behalf of the entire group. Today, the European Commission has published the legislative draft for the European digital, for the digital euro, for our CBDC. And that gives me hope because I think that it really demonstrates the capacity to innovate, the capacity to work as a team, the capacity to anticipate what digital payments will be tomorrow. Now, some people are very skeptical and they say, well, you're taking risk, financial stability, possible runs that will be accelerated by this. And all I would say is, number one, you have to be ready. You want to keep the sovereignty of your currency. So many years ago, who would have thought about all the users and the applications that you have on your cell phone? None of us. So being prepared, being ready, paying attention to what actually Europeans and particularly young Europeans want in terms of currency and form of currency is something that we have been doing, that we have accelerated, that we have not decided for sure, but at least the legislative piece is on the table. There will be a lot of discussion. And that's, in a way, also the result, one of the good benefits of COVID. We have talked about the downside of COVID and the consequences, but the way in which so many of us have become more digital, better equipped, probably more productive. It will be demonstrated probably with a lag time. But when I look at my member states, the countries that were least digital have really traveled very fast to become much more digital. So that's a good reason to hope. And the resilience demonstrated, but I have mentioned that earlier on, by everybody, from the individuals to the entrepreneur to the corporates to governments. We, in Europe, decided to get together to borrow jointly, despite the fact that it's laborious, that it's painful, that it gives a lot of things to report about to journalists, is also a sign of progress.
And just to be clear, a digital euro will happen when?
That will be decided by the governors in Governing Council. We will decide that at the end of October, and then there will be another phase of piloting, experimenting, fine-tuning, because if and when we go, as will be decided by the Governing Council at large, we want to get it right. So we're not going to do a half start or a fake start. We will move with success.
What makes you optimistic, Governor Bailey?
Well, actually, I'm going to build on Christine's theme, because as well as we're also working on retail digital euro, we're actually also working on wholesale digital money and completely rebuilding our wholesale payment and settlement system in the Bank of England to enable what could be a complete revolution in the infrastructure of financial markets and trade finance. And this is very exciting. So we put the wiring in the weekend before last. The engine should go in next year, and this has enormous potential to change the world at the wholesale level as well.
It's interesting, I feel like the world has moved on to AI beyond digital payments. Are you guys incorporating AI into your thinking about economies and your toolboxes?
I think we're all on a learning curve. I don't know, I feel quite old when it gets to this, but yes, I mean, we're looking at it in two respects, certainly. One is, three respects. One is how it will affect the economy. Two, how we can use it ourselves, both in our sort of, analytical functions, but also actually in our operational functions. We're looking at it, I would say, with very open eyes. You can see the strengths and you can see the current weaknesses of it. And of course, it moves very rapidly. So yes, we're having to, certainly I can speak for ourselves, we're having to devote quite a bit of time now to what the potential is for that.
Chair Powell, is AI one of the things that makes you optimistic?
So on AI, we're just doing what everyone else is doing. We're trying to get smart about it, and it's obviously has huge possibilities. Technologies tend to, propagate through the economy fairly slowly, and this one may be the exception, maybe not, I don't know. But it's something that we're spending a lot of time on, way too early for conclusions. I wouldn't use optimism, but I would say this, in answer to your first question, which is, when inflation first arrives, it's really due to very strong demand for goods and goods pipelines that just aren't working, and shortages. So that's where it comes from. It wasn't about the labor market at all, right? Or very much. As we get to this stage and to looking forward, we think it will be significantly about getting the labor market, supply and demand, back in alignment. I would say it's a positive thing, I'll say it that way. It's a constructive thing that we've been able to raise rates 500 basis points with the expectation of going further, and we still have a very strong labor market, but nonetheless one that is in fact cooling in just the way we would have hoped, which is to say through things like lower job openings. Job openings are coming down. The quits level has returned to its pre-pandemic level. Wages have, if you look at employment compensation index or average hourly earnings, they've moved down about 1% towards more, still very high, but towards more, so a more sustainable level that's consistent with 2% inflation. So I would just say that's the makings of, if that process continues in a gradual way without really any effect on employment, the longer that goes on, the better. And in a way, I take that as a very constructive path. It is not guaranteed, but the fact that this is really there, and that's what's been happening for a year, more than a year into our tightening cycle, I would take as a positive thing and perhaps a hopeful one for the future.
Just be careful not to overdo it, right?
Right.
What about you, Governor Wada?
Let's see. As other central banks are thinking of issuing digital monies, we are taking a different route, and we have decided to issue new currency bills starting next year.
You're going all in paper.
This will cheer up public's confidence in the BOJ. more seriously, as I said, wages have started to rise at 2% or so for the first time in 3 decades. More importantly, we are seeing as a sign of a change in inflation expectations, changes in price wage setting behavior of businesses. So previously, businesses hesitated to increase prices because if they did, others will not follow suit. Now say they are raising wages because if they didn't, they will have trouble recruiting workers because others are raising wages. We think this is a good sign for us.
So the topic of Sintra of this ECB forum is inflation, volatility. So now is prediction time. In 1 year, when hopefully I'll be invited back, President Lagarde, inflation rate in the UK is what?
Well, our last forecast, we expected inflation to come back to target towards the end of next year. We're going to start the next forecast in about 2 weeks' time.
I was trying to
get a jump on that.
Yeah, I was trying to jump on that. Do you get to 2% by this time next year, President Lagarde?
Well, you said a year from now, right?
Yes.
Okay, so the projection we have is 3% for next year. Headline.
Will you be satisfied with that?
I want it to be timely. We all want it to be timely.
Timely, okay. Chair Powell?
I don't see us getting back to 2% this year or next year.
You don't?
No. I see us making progress, steady progress on, this is core inflation.
Yep.
Headline inflation is coming down now, is lower than core. But for core inflation, I don't see us getting to 2% this year or next year. I see us getting there the year after.
2025?
Yeah.
Core inflation 2%. So you're going to be restrictive for a long time.
No, we will be restrictive as long as we need to be. But, you know, if inflation is coming down sharply and we're confident that it's on a path to 2%, you know, that would be a different situation. You would begin to think about loosening policy, but we're a long way from that. That's not something we're thinking about now or in the near future.
Governor Ueda, are you going to get to the 2% by your measure?
So our projection as of April, inflation projection, has for 23 fiscal year, 1.8%, 1.8 headline, 2.0% for 24. Now, this makes my job of justifying underlying inflation rate staying below 2% a bit harder. But we keep saying that we don't have a lot of confidence in this 2024 forecast. This may change depending on the data to come out.
Do you guys feel you've been through a lot of hard moments, you know, COVID and the inflationary challenge, and now we're starting to see economies weaken. Do you feel like it's a particularly difficult point in your central bank journeys, Governor Bailey?
Yeah, until we get inflation back down to target, you know, we've got a very big job to do, and it's a job we have to do. Well, I don't know, it's stressful, but I think, you know, look, we sign up for this job, and you don't get to determine the conditions that you do it in, so we just got to do it. I mean, that's our job.
For you, President Lagarde?
Likewise. Man's got to do what a man's got to do. We signed up for the job, and a woman's got to do what a woman's got to do as well. Thank you.
Chair Powell, haven't seen you stressed.
Sorry?
I haven't seen you stressed.
We have a job to do. We know that. We know that society's counting on us to do this job, and that it really matters. Price stability can matter for decades. It can benefit for people over time. I think we all know that, and we'll do the things that we need to do to restore it.
And Governor Ueda is feeling good.
I didn't know there was going to be so much traveling and so many press conferences.
Welcome to the world of central banking. Thank you all so much for taking the time today and all my questions. It was a pleasure.
All right, that was the ECB panel from Portugal, the central bankers from around the major markets around the world, including Fed Chair Jay Powell, BOE Governor Andrew Bailey, ECB President Christine Lagarde, and Bank of Japan Head Kazuo Ueda speaking there. So I think the takeaway here clearly from these central bankers is that they continue to fight inflation. They continue to be hawkish on rates. Powell said the Fed won't take option of 2 consecutive hikes off the table. Lagarde said the ECB still has ground to cover, while Bailey says the BOE has a job to do. So pretty consistent across the board. All right, let's reset here at near the top of the hour. We'll go to John Tucker and get a Bloomberg Business Flash.
All right, just looking at the major averages in the U.S., mixed right now. The heads of the 4 most important central banks getting together for that panel discussion. And as you mentioned, Paul, Fed Chair Powell telling the Central Bank Forum in Portugal there, he's not going to take consecutive hikes off the table. This is what he said.
If you look at the data over the last quarter, what you see is stronger than expected growth, a tighter than expected labor market, and higher than expected inflation. So that tells us that although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough.
All right, initially that put pressure on stocks. Then he said a recession is not the most likely case as the economy remains fairly resilient, so they got a boost after that. We are seeing a slide in chip makers, NVIDIA leading the losses there. The U.S. reportedly considering new curbs on exports to China. General Mills, that fell, the food producer giving an annual guidance that suggested price hikes are no longer going to make up for slowing sales. And Netflix, higher as Oppenheimer, raising its price target there. Right now, the S&P 500 2 points lower at 43.75 in the index. The NASDAQ 100, 70 points higher. That's up 0.5% right now. And the Dow Jones Industrial Average, 166 points lower. That is down 0.5%. After all that chatter from the central bank heads, 2-year yield right now, 1 basis point lower, 4.73. The 10-year yield, pretty much unchanged, 3.75. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker at your Bloomberg Business Flash. Maddie and Paul.
All right, John Tucker, thank you so much. We appreciate that. Paul Sweeney and my co-host, Madison Mills, joining us here in our Bloomberg Interactive Broker Studio. Madison, the central bankers there, they seem pretty consistent to me in their messaging. To continue to fight inflation, continue to, really focus on that. And, Jay Powell saying, we're not taking that 2 additional rate hikes off the table. They remain.
Yeah, and really interesting to hear from Powell, too, that he doesn't see us hitting that 2% target until 2025. Yes. Yep. So potentially a lot more movement to come from him, at least on the state side here.
Yep, absolutely. As John Tucker was just reporting, kind of got red and green on the tape. Let's go to Bloomberg Markets reporter Jess Menton. She joins us here in our Bloomberg Interactive Broker Studio. Jess, what are you looking at today in these markets?
Well, looking at where, if you're just looking at the broader equity market for the S&P 500 coming off of its lows, but then also the NASDAQ 100 turning positive in the midst of getting these comments from Fed Chair Powell and these other top central bankers around the globe. Something that stood out to me was when Powell was speaking, he did talk about how the Fed has to watch and see the lags because he doesn't know how long that's going to take. And that's something, Paul, you and I have talked about a lot when it comes to these long and variable lags, when it comes to obviously the most aggressive rate hiking cycle the Fed's been on before it paused, obviously, a couple weeks ago at its meeting, 10 consecutive meetings that it did raise borrowing costs at. Right now, looking at where its terminal rate stands at the highest it's been since about 2007. But he did say that he does see significant probability of a recession, but did hedge it, of course, in saying that a recession was not the most worst likely case scenario there. If you're looking at the broader equity market for the S&P 500, communication services and discretionary are leading the way, but then also you have utilities down more than 1%, as well as consumer staples. Obviously, those are more defensive corners in the market, Paul.
What's going on with consumer staples then, Jess? Why are we seeing some of those declines today?
Well, one of the bigger things, and you and I, Maddie, have talked a lot when it comes to packaged food companies, especially in the staples sector. So General Mills did forecast a slowdown in the coming year. And actually earlier this month, General Mills did flag at an investor day that it felt like it was going to be harder for that company in particular, and packaged food goods companies as well, to continue to pass those costs along. And we've continued to see that quarter over quarter where they've been able to do that. But now it's looking like it's not going to be quite as likely. And they did give an annual guidance that did suggest that those price hikes will obviously no longer be able to make up for the slowing sales that we have seen, obviously tied to what's happening with inflation still being a little bit stubbornly high there, and then shoppers cutting back on spending. So taking a look at that stock, obviously that's ticker symbol GIS, that's under pressure this morning. And so that's one thing when you're looking at, in particular, the packaged good companies in the staple sector that's coming under pressure.
You know, that phenomena this is the first time I'm really seeing, you know, a big consumer packaged goods company say, we've kind of reached our limit in pushing
Well,
price
actually,
increases through.
we did hear from Campbell's actually earlier this month, and they were kind of, them along with General Mills at its investor day, they were the first ones to kind of flag, hey, some of these price pressures, we might not be able to continue, and that was coming off, obviously, we had retailers a few weeks before that. You even had like PepsiCo and Coca-Cola talking about they were continuing to be able to do that. But now it's sort of the question of, is this the first indicator when you are, because they are off cycle when you are looking at these reports?
And I'll tell you what, just from a personal level, this inflationary cycle where I've really seen it the most is in the supermarket. I mean, just amazing. And, you know, so we, you know, switching from some name brands down to
going to
store brands.
store brands, right.
And like, you know, and that's what a lot of people I think are doing because it's real. Now, my question is, does it come back down? And I think for a lot of things it will, you know, like for the commodities, eggs and so on. But, you know, but if you've been able to raise prices on a product, like I don't think a New York strip steak in New York City Steakhouse, I don't think that price is coming down. That $48 number, that one, that 58, I think it's sticking at 58.
You don't think the demand is going to buckle for the New York strip?
I mean, if you're not Tom Keene, it's tough to get a reservation at some of these top restaurants in this town. So I don't know.
How do we get invited? How do we get Tom to invite us?
Yeah,
to,
I know.
So, but that's interesting to see that from General Mills. Another thing that caught my eye was this shoplifters and student loans are toxic mix for retail stocks.
Just looking at that.
So expectations for a revival of retail stocks are dimming as Wall Street analysts warn of a trio of challenges. Shoplifters, recession-wary spenders, and students saddled with return of debt payments. So that's an interesting way to think about, you know, retail stocks and retail sales going forward.
Right, and those payments were supposed to resume in October. So there's been a lot of notes from economists at the major banks kind of questioning when we're looking at those, the ECFC function in the terminal is where you can go to gauge what the economic projections are for analysts on average. And you can see a mild quarter-over-quarter contract in the third and the fourth quarters, but that's mostly due to pullback in consumer spending and potentially tied to your point, Paul, when it comes to those student loan repayments coming
and the shoplifter thing, that's a thing.
Right. It is.
I mean, I thought there was just a natural average kind of spillage, but apparently, or you know, whatever they call it, slippage, but apparently it's much higher than the average.
Our friend Matt Miller was talking about this on radio with Carol Masser yesterday afternoon, talking about going to particular stores where everything is now locked up and his frustrations.
Yes, you go to the Walgreens just a block away.
Exactly, that's what he was talking about.
And then you've got to talk to someone. And then I don't want to do that.
I believe he also tweeted out a picture of him in line.
To be clear, Matt is not stealing. That's not the implication.
No, of course not. Oh, absolutely not.
He just wants freedom.
He just wants to be able to pick something off of the shelf and is frustrated that it's locked.
All right, Jess, thank you so much. We appreciate that. Jess Menton covering the markets for us here today. So again, a lot to chew on in terms of, you know, kind of where these central banks are going, where rates are going. We had clearly this ECB panel in Portugal, a lot to chew on here, but I think the consistent message, and again, I think the central banks have been consistent from day one here.
Yeah.
We are fighting inflation. After they, you know, I think the Fed obviously was late to the game, you could argue, that whole transitory talk a couple of years ago.
Yeah.
But since then, I think it's been pretty consistent. Yet, if you look at the WIRP function, the markets are kind of suggesting that there may be some changes to that. So we'll have to see about it. Our next guest actually has an informed opinion, which is great because we're just kind of, you know, we're amateurs here. But Tim Dewey, he's the chief U.S. economist at SGH Macro Advisors, and he's a professor at the University of Oregon, the Ducks. Joins us here in our Bloomberg Interactive Broker studio. So, Tim, we heard from the central bankers today in Portugal. You know, it seems like they're pretty consistent with our job's not done yet.
Right. And that was the message from the dots for the Fed 2 weeks ago, that they were looking at another 50 basis points of rate hikes this year. And Powell actually, I think, sort of opened up the chance for even more than that when he sort of said, well, maybe we'll have to move in September too, or, you know, we want to rule out moving every other meeting again. And that's something that I don't think has really been on the radar yet, the possibility that, you know, 6% is still out there as an outcome.
And you think next meeting is a definite hike?
Yeah, I think we're. I mean, I'd almost say 100%, just because I don't know everything will happen between now and then. But I think that decision was made. In fact, if Powell is saying, well, we might have to go again in September, that would tell me that July is for sure.
Yeah.
So where does that take us into our discussion about a recession? Where do you think that kind of shakes out here? Because, boy, the economic data is still pretty solid.
Yeah, well, the economy is always more resilient than people give it credit for. The focus right now is on recession because you can really chase those rate cuts down from a market perspective, right? That there's a potential for some big gains on that. But it's hard to knock the U.S. economy down. Is what we're learning here, especially now when we're still on the side effect of an enormous amount of fiscal stimulus and easy monetary conditions that I think are still, propelling underlying activity. So is a recession going to happen eventually? Can I tell you that it's going to happen in the third quarter? It won't. Could I tell you it'll happen, second quarter of next year? Maybe. I think that from my perspective, the interesting thing here is that if you don't get that recession anytime soon, there's really room for central banks to keep hiking here in the second half, and it'll go on beyond July.
Well, you mentioned stimulus, but Powell said that excess savings is not the main driver of inflation. He's more concerned about the labor market driving up income and consumption. How would you rate that comment?
No, I think that's a real issue. Is if you don't cool down the labor market, eventually, we've got some benefit right now. We've certainly got lower energy prices. We're seeing headline inflation come down. We'll probably see used car prices come down, shelter prices. So we've got some benefits there that are really, I think, going to likely hold down inflation here in the second half of the year. We'll see. Any of those forecasts have actually turned out badly in the past. But if that's almost like the pause that refreshes, though, right? Is that's kind of bringing up real incomes and spending capacity that then would come to bear in the first half of the next year. So if you don't, I think that if you don't, I think the Fed's right. If you don't start getting a little bit more even softer activity in labor markets, you are risking a repeat of inflation.
Well, are you surprised that the labor market's been as resilient as it has been? We still have a JOLTS number that's near 10 million job openings. I don't know what to make of that.
I think that people, again, underestimate the resilience of the economy. Is that what it's really about? Is that we really stoked the fire pretty hot. And so, no, I haven't been surprised. I'm not surprised by the rebound in the housing market at all. I think that, the Fed has more work to do here.
Well, can we talk about housing numbers as well, because housing starts leaping in May. I wonder if you think that the Fed failed to anticipate how higher rates would sort of convince people to not put their homes on the market, and if that's something that you are weighing in your consideration.
It certainly seems to be the case that the Fed missed this, and we know this because last week during Paul's testimony, in the first day, in his written testimony, he says the housing market's weak, and the second day he says, well, we met with some builders yesterday, and it turns out the housing market's not that weak, right? Actually, it's rebounding, and then we see the numbers start to come out. Now, I think that we've been writing about this forever because it seemed obvious to us that you really did break the housing market in some respects by holding interest rates near zero at the policy level for so long. You have so many people locked into these 3% or less rates. There's no selling pressure. It's not like 2005, 2006, 2007. And even if some people start losing their job, you're not going to have mass selling pressure. At the same time, you have the demographics of more and more millennials wanting to buy homes. And so the only game in that town then becomes new construction. So we've thought that the housing market was going to be more durable than people anticipated for what's really a substantial increase in mortgage rates.
Yep. Tell me about it.
So if anybody's tried to move lately, it's kind of a shocker. But these are things that once you sort of wrap your mind around and you need a house, you say, okay, well, 7%, eventually I'll be able to refinance it in 5% or 4%, and I got to just pull the trigger.
So, Tim, what's the biggest risk to this economic outlook for the next 12 months, do you think? Is it something exogenous, or is there, because we had the bank issue a few months ago, people thought that might be a real challenge for the economy, but that's kind of abated a little bit. What's the biggest risk out there?
Yeah, so it's it's always the exogenous shocks that get you at the end, right? I mean, so one risk is the Fed. I mean, it's sort of a conventional story, is that the Fed has, that the Fed's already over-tightened or will over-tighten, and eventually that will crash investment activity, and eventually firms will have to lay off workers, right? That's kind of the standard recession story. But what seems to be emerging is right now the Fed is slowing the economy, and maybe it's not until we get a real good shock. Like last year, that Ukraine shock, or the energy shock from Russia's invasion of Ukraine, that could have been the sort of recessionary shock had not the economy been flying so high at that time. So, again, will a recession happen? No, but recessions are fairly rare.
Right.
I mean, and they're all idiosyncratic. There's a lot of, we tell different stories about every recession, and we'll tell a different story about the next one than we have in any of the rest.
Tim, for better or worse, you are one of our go-to people for the Pacific Northwest. You're a professor at University of Oregon. That's where you got your PhD, undergraduate at the University of Puget Sound. Most of us don't get to go to that part of the world maybe as much as we would like, kind of remote. Talk to us about the economy out there, housing market, just job market. What's the feeling of the person on the street in University of Oregon?
Well, the job, I mean, during the pandemic, you had a lot of people move into these, Western towns to be able to gain advantage of that. I think some of that has faded in the Northwest, and the Northwest has, more recently, I think, struggled with some of the things you see in a lot of the Western cities, the higher rates of homelessness. And I think the economy is solid out there, but maybe not as solid as we would have expected coming out of this pandemic relative to where other places have been.
So did you guys get that influx of, just California, for example? Did they come up to that part of the world?
The Northwest has regularly been a receiver of immigrants from California, just like a lot of other places. And so, that's certainly been a long time trend that's supported Oregon's growth in particular. One interesting thing is Oregon's internal natural rate of growth has really slowed to basically zero.
Is that right?
So
what are some of the core industries out there that still?
Well, the big ones that people talk about, everybody knows, are Nike. Obviously, Nike's got a big production there, and you have Intel has a large manufacturing facility, and of course you have in Seattle, the Amazon, Microsoft, that sort of
tech is
around.
big.
Tech is big in the Northwest. We have still forest products, certainly also another historical element of the Northwest economy.
All right. Good stuff. These are one of our go-to people there.
This is great.
You don't see too many. Not many people come through our offices from
Well, I'll try to do it more often.
Yeah, exactly. All right, Tim Dewey. He's the chief U.S. economist, SGH Macro Advisor. He's also a professor at the University of Oregon, the Ducks, right there. Appreciate him coming into our Bloomberg Interactive Brokers studio. Right now, let's get a little bit of a reset here. We'll go to get a business class with Mr. John Tucker.
All right, as far as stocks go right now, the major averages, they are mixed to little change. Now, the message that investors for now seem to be latched onto from Fed Chair Jerome Powell, a recession, he said, is not the most likely scenario as the economy remains fairly resilient at that central bank confab taking place in Portugal. So we're seeing a rally in mega cap stocks like Tesla and Amazon.com. The chip makers also trimming some of the earlier sell-off. That was driven by a report that the U.S. is considering new curbs. Shares of NVIDIA right now, that's one of the laggards in the NASDAQ 100. It is down just about 1% right now. Overall, S&P 500, 1 point lower. The NASDAQ 100 up 47 points. That's up 0.3%. Now the Dow Jones Industrial Average 120 points lower right now. I'm going to see if Madison knows this one.
Okay.
I know that you're going to get this.
No.
The guy, the man who brought you chia and clap on, clap off, has died.
Really?
Advertising executive Joseph Pettit turned the Chia Pet and Clapper light switch into retail sensations.
I didn't know it was going to be a sad
91.
story. You had me clapping into the microphone.
He was 91.
Is this,
he had
so
a pretty
this
good
is
life.
the clap on?
Now I seem
Clap
so
on,
insensitive
clap
to the
off.
founder of the Clapper.
So yeah, he's gone.
Sean.
Okay, that's a giant in the business. All right, John Tucker, thank you so much. We appreciate it. Looking at the markets here, I'm just kind of seeing a mix here. The S&P, really just unchanged on the day here. WTI crude oil, it's kind of bouncing around again. It's up about 2.5%, but we're still below 70. So, just not seeing a lot of movement here. Even the yields kind of just hanging in there. So we had a lot of central bank talk today, but nothing that really moved the market here.
Yeah, I guess everyone had already kind of priced in these. This is the thing with Powell, right? Like he says something new, but is it new every time? He says the same, we're keeping our options open, 2 more hikes by the end of the year or whatever.
Yep. All right. Well, I think, one of the bigger stories today is in the tech space, is in the chips. And again, the story in the chips has been AI. And of course, you pile into NVIDIA and maybe some of the other names, and we're seeing that broaden out a little bit more as people try to get exposure to what AI means and how you play it. But I don't know. But now we've got the U.S. government saying, hey, let's think about what chips we're exporting to China, and that's an issue for NVIDIA and some of the other names. So let's bring in somebody who kind of is smart on this stuff. We pay him to be smart on this stuff. That's Mandeep Singh. He's head of our tech research at Bloomberg Intelligence, along with some other guy out in Chicago. Mandeep, talk to us about kind of just the news today about the government and it's wanting to maybe put a curb on the export of some of our best chip technology to China.
Well, so I think so far this was probably a low, probability event when you think about the odds of, government going full into, imposing a ban, which happened in Russia, by the way, last year when the war broke. And I think right now what investors are grappling with is what happens if that does occur? Like, how does NVIDIA get hit? And the answer to that is probably they have 15-20% revenue exposure. Now, what they did the last time around such a ban was imposed was they offered a lower performance variant, which didn't fall in the restrictive category, and they were still able to sell to China. So you could expect something similar from the chip makers. They'll try to skirt around those restrictions by offering some other variant. I still think, relocating the supply chains is going to be much harder, and that is the biggest risk for all these chip makers is you're still going to Taiwan. Taiwan has elections next year. There's a lot that could happen, in terms of low probability events actually happening, or there is that risk that they could occur. So that's where we are at,
In terms of the risk of bringing things stateside, I'm curious about the CHIPS Act, because Anna Wan had an amazing piece about this, looking at how the CHIPS Act could be adding to the U.S. GDP and having a negative effect on those inflation pressures because we're seeing so much investment and construction regarding chip making here in the States. Are you hearing about that from your sources, kind of a flood of money into that stateside?
I mean, there is, and every government right now wants that, manufacturing to come back when it comes to semiconductors. The problem is these are multi-year investments. So you start building a fab now, it's not going to be productive for a couple of years, and that also is a phased approach when it comes to, the 3 nanometer or the 5 nanometer. We're talking about leading node chips here. Those are the ones that are being restricted in terms of sales. And I would argue it's not going to be at least 3-4 years before you're going to see leading node manufacturing here in the developed countries.
So where are we now, a week later, since maybe the last time we talked to you about AI? What are you hearing from investors here? How are they going about trying to play this theme? I know you guys have a big research report on, which I highly recommend to folks that are on the Bloomberg terminal, kind of laying out the market and the opportunities and so on. But when you talk to institutional investors, how are they playing it right now?
Well, so clearly everyone wants exposure, and hardware and semiconductors is still the most tangible thing. On the software side, you have Snowflake and other database companies that are trying to leverage the capabilities that NVIDIA or some of these new types of chips offer. But at the end of the day, everyone is trying to build the compute capacity to, ingest their proprietary data, build a large language model. And over time, you're going to find new use cases emerge, which are more domain specific. But right now, everyone wants to build on top of ChatGPT or, the large language models that are out there and see what they can get in terms of new output. And I think that's the phase where you're in. But everyone feels this is a strategic imperative right now from an IT spending perspective, and this is as non-discretionary as it can get.
Does it seem to you that the C3 AIs, those kind of, they're not meme stocks, but meme stocks in air quotes there, are falling to the wayside now, or are we still seeing more euphoria around some of those smaller names?
I think the way you have to think about it, and we lay this out in a report, there is an infrastructure layer for generative AI, which is dominated by the hyperscalers along with NVIDIA. And then you have the platform layer where every company is offering, a platform or something, a workbench where you can build your applications on top of. And so the compute capacity will continue to come from the hyperscalers. But when it comes to the platform layer, it's very fragmented, and it's going to be very domain specific. Every industry, whether it's healthcare, industrials, they'll have their own player in terms of offering a platform where you're going to build an application. So C3.ai would fall in that platform layer.
Yeah.
How big that opportunity is going to be, no one can tell right now, because ultimately it comes down to ROI, right? Can you generate ROI?
I guess I'm curious then what you think about a company like a Kroger mentioning AI 8 times in their earnings. Do you think that there are some companies that you don't need to be mentioning this?
Any company that has large amounts of data and they have digitized their systems feels they have proprietary data to feed this to this large language model.
Yeah.
What kind of output or productivity they can generate, I don't think they have a clue. But at least they are investing with the hope that they can leverage their proprietary data.
Okay.
What's the number one topic with your clients these days? Is it AI?
I think everyone is focused on generative AI, but they want to go to the medium to long-term outlook in terms of who has a real moat versus what is near term and it will phase out because right now, as Madison said, every company is talking about it in their earnings call. Obviously, some of it is hype, and I think you will see some real winners and losers emerge.
All right, Madison just sent me this really cool tweet about Airbnb, and I know it's from this guy, Nick Gurley, I don't know who it is, talking about Airbnb revenue, top 10 cities, it's dropping like crazy, 40, 50%. Why is that?
Well, so travel, I think, is in that phase where consumer travel was very strong, very resilient, and right now you could argue the comps are getting tougher for these companies, and if there is any type of slowdown, the one area where you think it's going to hit is, I think, consumer travel. Business travel continues to be strong, but it was slow to come back. And that's where there is that risk that, growth can decelerate sharply. Airbnb, we know it's still alternative accommodations. And I think a lot of people are thinking about the addressable market. Is it really that big to justify a premium that Airbnb had?
I mean, it's interesting. Again, Maddie, thanks for forwarding this tweet here. But like Phoenix, year over year for the month of May, Airbnb revenue. Phoenix, off 47%. Austin, Texas, off 46%. Myrtle Beach, 45%. These are, Asheville, North Carolina, off 42%. So these are towns that just were COVID towns, if you will. COVID cities, people bailing out of the coast, going to the Austin, Texas is the Phoenixes of the world. And I guess that was a huge benefit for Airbnb at the time. Now you're just saying maybe some comps issues.
Absolutely. And we've seen that time and again. I mean, look at Zoom. Great COVID pull forward, but after that, the comps got so much tougher that, they struggled for a while in terms of the top line. And so I'm not saying this is going to be another Zoom, but there is clearly a parallel to be drawn.
And Airbnb stock is still at 50% year to date. So,
so sorry, Paul, to step on you, but it's interesting to look at just the read through to the stock. Does this have that impact?
Yeah. Interesting. All right. Mandeep Singh, thanks so much for joining us. Mandeep Singh is one of our leading technology analysts at Bloomberg Intelligence, along with Anurag Rana and the whole tech team globally. And what's interesting is, there's Mandeep and the team came out with this really big report on artificial intelligence, one of the most read research reports from BI. So you can check that out on BI Go, but it's also just kind of investors are really clamoring to kind of figure out what is AI, what is the market, what is the potential for this market, and what are the applications, how do I play it, how do I invest in it, and we're super early, it feels like to me, in this thing, top of the first inning kind of thing. Maybe, and as Dan Ives from Wedbush Securities said yesterday when he was in studio, you know, AI is kind of like the internet, you know, just when it was kicking off. So it's really interesting to think about that.
Yeah, and Dan was actually explaining this to me really well the other week when he was here. He said that, you know, when something like AI booms like this, you want to look for the third or fourth tier company that's going to get some benefit from that. So then, you know, I immediately go to SPLC, go on the terminal to get some supply chain analysis from some of these Gen AI companies, and a lot of them are too new to have anything big there. So it's interesting.
Right, interesting. And again, just quoting Dan Ives from his research, looking for potentially over the next couple of years, $800 billion of incremental tech spending associated with AI. So just an extraordinary start to that business. And the next driver, you know, we had the cloud. Maybe this is kind of something as big or bigger, actually, going forward for the tech names. Again, NVIDIA really kicked it off when it raised its guidance a couple of months ago, just dramatically above where consensus was. And you just don't see that very often. And that caught everybody's attention there. So we'll pay attention to that. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Morris.
All right, thank you, Paul. Coast-to-coast chaos, severe weather, and an FAA staffing shortage disrupting air travel for millions of people ahead of what is expected to be the busiest 4th of July weekend travel on record. The ripple effect felt as far as Denver. Passenger Jessica Hurst has been stranded since yesterday.
It looks like an apocalypse. It really does. Everybody, you know, is just sprawled out on the floor.
Ground stops imposed across the Northeast, causing more than 2,000 cancellations, 7,000 delays yesterday. That was just yesterday alone. Frustrated passengers were told they cannot get to their destinations until maybe next week. High-speed rail in California and electric bike charging stations in New York City, just two projects that are about to get huge infusions of federal funds. $25 million will help fund 173 electric charging stations for e-bikes and scooters in New York City. Another $25 million will go toward building 2 inner-city passenger rail stations on the high-speed rail corridor connecting Las Vegas and Southern California. It's part of $2.26 billion for 162 road, aviation, transit, and rail projects in all 50 states and 2 territories. That funding to be split between rural and urban areas. About 70% of the projects are aimed toward low-income communities. And we're learning more about the armed mutiny attempt by the Wagner mercenary group led by Yevgeny Prigozhin. The Wall Street Journal reports Prigozhin had planned to capture Russia's military leadership. As part of the plot, he had to accelerate his plans after they were leaked to Moscow. The rebellion has since triggered large-scale purges within the Russian armed forces. Former Defense Ministry official Mikhail Zavinchuk says that commanders and officials are being purged because of what officials saw as their indecisiveness in suppressing that uprising. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Right now, the major stock averages, they are mixed. Fed Chair Jerome Powell telling a central bank forum in Portugal, you heard it here live on Bloomberg Radio, he won't take consecutive interest rate hikes off the table.
If you look at the data over the last quarter, what you see is stronger than expected growth, a tighter than expected labor market, and higher than expected inflation. So that tells us that although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough.
Now, that's the rates front. Powell also said a recession, not the most likely scenario, as the economy remains fairly resilient, and that's the part that investors seem to be focused on right now. You had a slide in chip makers with NVIDIA leading the losses there. However, NVIDIA has pared some of those earlier losses. Right now, it is down just 0.6%. General Mills falling after the food producer delivered an annual guidance that suggested price hikes will no longer make up for slowing sales. Netflix also higher. Oppenheimer raising its price target there. Right now, the S&P 500, 3 points higher, up about 0.1%, 4381 on the index. The Dow Jones Industrial Average, 72 points lower. That is down 0.2%, 33,857. And the NASDAQ 100 up 66 points. That is a 0.5%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Madison and Paul.
All right, Madison Mills and Paul Sweeney here in the Bloomberg Interactive Brokers studio. John Tucker, thank you so much for that business flash. All right, we've had some funky C-suite conversations in this studio, and this one I think might top the list. Get this, deep sea mining for like metals that they use in batteries. I don't know what's going on here, but we have the CEO here, Gerard Barron, Chairman and CEO of The Metals Company. The symbol is, it trades on the NASDAQ. The symbol is TMC. That's what you enter into your Bloomberg terminal, and check that out. Gerard, thanks so much for joining us here in our Bloomberg Interactive Broker studio. What does your company do? Talk to me like me and Maddie like we're 5-year-olds.
Well, great to be here. So the Metals Company are focused on developing a very large, abundant resource of polymetallic nodules that lie on the seafloor, lie unattached. It's on the Pacific Ocean, about 1,000 miles off the coast of Mexico. And they were discovered way back in the 1870s, so almost more than 150 years ago. And what they found is that they're very abundant in nickel and copper and cobalt and manganese. And it's a really interesting project because when we think about the transition away from fossil fuels, people have realized that we're going to need a lot more metals. And we're pushing into frontiers that are very biodiverse and having to dislodge indigenous communities, having tremendous environmental impacts, as opposed to what we're doing is we're collecting these nodules from an area known as the abyssal zone. It's the most common area on our planet. About 40% of the entire planet is classified abyssal zone. We're 4,000 meters below sea level. There are no plants, so zero flora, and most of the fauna is bacteria living in the sediment. So it makes sense that we're increasing extractive industries in parts of our planet where there is the least life, not the most life.
So, again, like I'm a 5-year-old, what can this do for us on the planet Earth? Yeah, above the ocean.
Well, two things. The International Energy Agency predicts that we'll need to increase extractive industries between 500% and 600% per annum by 2040. So the question is, where are those metals going to come from with the lightest planetary and human impact? So we have to look at a full life cycle analysis at, well, what's it going to mean for indigenous communities? What will it mean to carbon sinks and CO2 emissions and impacts on biodiversity? And so what this resource can do is supply a supply of these important battery metals at the bottom end of the impact curve. And it can also address the issue of geopolitics, because what the world has woken up to is that when it comes to battery metals, China is OPEC. They dominate it. They've invested ahead of the curve. And there are no real resources other than this one that could provide mineral independence to the USA. And we saw in the recent 100-day review that the #1 strategic priority was to build nickel processing capability in the USA. But the problem is, of course, a lot of land-based ore bodies are very low in grade, and you have to build the processing where the deposit is. And no one wants a mine in their backyard. Even if you found one in America, getting it permitted is almost impossible. Whereas we have an ocean-based resource. By the way, we've identified 1.6 billion tons of these nodules, and that's enough to electrify at least 280 million mid-sized EV batteries using a nickel-rich cathode chemistry. So that's enough to electrify the entire USA passenger fleet. So we can do two things: supply low-impact battery metals and address the security of supply issues that are now top of everyone's mind.
All right, I understand that. Now, explain to me how you actually, what are you mining and how do you get it?
Well, so these nodules literally lie on the ocean floor. Think of a golf driving range. So we're literally picking up golf balls. And so that means we send down a robot. We're 4,200 meters below sea level. We have a production vessel that sits on top. We've already secured our first one. In fact, last year, for 6 months, we ran our first trials, end-to-end trials, and that was done for two things. One was to test our system to make sure it's production ready, and secondly, to understand the environmental impacts. So we had another boat out there for 6 months, with 80 people on it, many of them scientists, observing the impacts of the area before we harvested, during harvesting, and after we'd collected all the nodules. And so our robot crawls along the seafloor, lifting these nodules, putting them into an air riser, which vertically transports the nodules to the production vessel. And then that production vessel will stay in production constantly. So it offloads the nodules to a transport vessel, which then carries them to shore. Now, the opportunity, of course, for North America or the West is for us to process those nodules in their backyard. But what we've announced is that we're quite advanced with a company in Japan, because we're also able to utilize existing onshore processing facilities. And that makes it a very attractive economic proposition, because, of course, normally you have to build your processing where the mine is. But in our case, we're in the middle of the ocean. And the other great thing about this resource is that if I was to show you one, it's about the size of a potato, and we turn 100% of the mass of this nodule into saleable, usable material. So we generate no waste and no tailings. But the first plant is likely to be in Japan, and that means we'll produce the battery intermediate products of nickel and copper and cobalt and manganese in that market.
All right, let me talk about the economics of this. You guys are pre-revenue right now, is that correct?
That's right.
Do you have the capital you need to kind of get to that revenue stage?
We will require some more capital.
Okay.
We've raised money in the last year from existing shareholders. We have some very successful large shareholders, including Allseas, which is our partner on the offshore side. We count Glencore as a shareholder. They also have an offtake. And we are talking, as we've told the market, to some strategic partners about earning into the asset, because the net present value for our first area that we're developing, we know it as Nori Area D, is around $13 billion today. Now, so it's a very valuable asset. And so we're talking to strategics about earning into that asset. And they tend to like that. That's what smaller resource companies, whether it's in mining or oil and gas, tend to do. They invite the big guys to come and take an economic interest. In our case, though, we have such a broad array of strategics. We have people from the oil and gas, the mining world, the battery precursor world, actual customers. We're seeing EV companies now start to invest in these supply lines because they're worried about where are the raw materials going to come from. And so we're talking to many.
Fascinating story. I want you to come back when you kind of get closer, get further along here, give us an update, because this is really interesting. Gerard Barron, he's a chairman and CEO of the Metals Company, traded on the NASDAQ TMC. Fascinating story about something I didn't even know existed.
I know.
That these things are on, and it literally looks like just a little rock, and you bring it up, and you can make that into the stuff we need for these batteries. So fascinating story. C-suite conversations here in Bloomberg Markets. You never know who Eric Malo is going to book for us next. All right, we're going to have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, it's the moment Credit Suisse employees have dreaded since the takeover by UBS. Sources tell us the firm plans to cut more than half of Credit Suisse's workforce. Let's get the latest from Bloomberg's Miriam Bellagio in Zurich.
We're expecting the first wave to hit in July, followed by another wave in September, and then later in the autumn. So bankers and staff at Credit Suisse should just brace themselves for more to come. There had already been 10% of Credit Suisse's staff that had left since the turmoil started, so it's not new, but these new kind of waves of job cuts are not voluntary this time.
Thanks, Miriam. Shares of UBS are down less than 0.25%. General Mills stock is down 5% after the food producer reported weaker than expected quarterly sales growth in its last quarter, but has said an annual forecast for sales growth topped Wall Street expectations. General Mills says its fiscal year results included a voluntary recall on certain international Haagen-Dazs ice cream products. And Amazon's robo-taxis are rolling in Las Vegas. The company says its autonomous vehicle business Zoox began shuttling employees on a 1-mile stretch of public road around the company's office in Nevada. The vehicle has no steering wheel, inward-facing seats, and no pedals. It can carry 4 people and travel up to 35 miles per hour. Zoox also plans to expand hiring in the city and roles focused on charging and maintaining the robo-taxis, with the goal to eventually shuttle passengers around for a fee. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Madison Mills and Paul Sweeney here in our Bloomberg Interactive Brokers studio, looking at the markets here. Just kind of a lot of red and green, not a lot of direction here. The S&P is effectively unchanged. A little bit of a lift there to NASDAQ, up about 0.5%. Bitcoin a little bit lower here today, but still holding above that 30,000 level, 30,400. So we'll keep an eye on that. WTI crude oil, it's a little bit higher here, so that also gets our attention. But still, WTI crude oil below $70 per barrel. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Morris.
All right, thank you, Paul. President Biden believes the economy can avoid a recession, telling donors at a fundraiser in Maryland yesterday that after economists predicted a recession for the past 11 months, he just doesn't think it's going to happen, citing a strong labor market and his efforts to tamp down inflation. National Economic Council Director and former Vice Chair of the Federal Reserve, Lyle Brainerd, agrees.
There are reasons to think that we are going to continue to see resilience against a backdrop of what we have referred to as more stable economic growth.
Economic Council Chair Brainerd made those comments as President Biden is now on his way to Chicago. He'll deliver what the White House is calling a cornerstone address on his economic policy, Bidenomics. NATO's presence is expanding. NATO Secretary General Jens Stoltenberg says that NATO is closely monitoring developments in Russia and has already increased its readiness and military presence in the eastern part of that alliance.
We will make further decisions to further strengthen our collective defense with more high readiness forces and with more capabilities to ensure credible deterrence and defense for the whole alliance.
Stoltenberg says support for Ukraine is even more important after the mutiny in Russia. Simone Biles plans to return to elite gymnastics competition after 2 years after her career seemed likely over after the Tokyo Olympics. Remember, she withdrew mid-event so she could focus on her mental health, and then she came back a couple days later and won a medal. Well, Biles is now signed up for the U.S. Classic, and from there she could qualify for a national championship. And while there aren't any real specifics or details about this, the move could also open the door for her to compete in the 2024 Paris Olympics. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Paul and Madison.
All right, Amy Morris, thank you so much. We appreciate it. Looking at the markets again, not much going on there in the marketplace. But again, we heard from the central bankers earlier this morning from, again, the Bank of England, the ECB, the Bank of Japan, and of course the U.S. Federal Reserve. And they are consistent in terms of their messaging, which is our inflation fight, it ain't over. And we're going to stay, we're going to stay at it. We have more work to do, as the Bank of England's head said. So it's consistent. So that's kind of goes, and Fed Chairman Jay Powell says 2 rate hikes are still on the table, and that seems to be the story for maybe the remainder of this year.
Yeah, I loved when Sarah started by asking him if he could describe the Fed's latest moves as a pause or a skip, and he said, we're maintaining, but we're open to further decision making. Classic Powell, just leaving all of his options open. I felt like the use of the word maintain reminded me of how I would describe like my health and wellness routine, and just totally leaving his options open so that he doesn't feel like he's made the right or wrong choice moving forward. But also, we were talking with some of our guests earlier, Paul, as you know, about what he is viewing as the primary driver of inflationary pressures stateside, and he's definitely sticking to the idea that it's the labor market, not necessarily excess savings.
Right, and as we saw from some of the packaged goods companies reporting today, that they're kind of saying our ability to push through more price increases is pretty much limited here. We've done pretty much all we can do, so that's good for those of us walking down the shopping aisle at the local supermarket. Maybe that inflation has seen its peak, and like we have seen in some other areas. But again, Fed Chairman Jay Powell is saying we're looking at the labor market, we're looking at wage inflation, and that, among other things, is giving us reason to kind of remain a little bit hawkish here as it remains to inflation. So again, most people are looking for at least one more rate hike, very likely maybe 2. But you look at the WIRP function and you get out to late this year, more into 2024, the market once again is kind of pricing in rate cuts in 2024 going into 2025. So we'll see how that plays out. A lot more coming up. This is Bloomberg.
Nice.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to start off with a very smart conversation on the markets. We're going to roundtable with Vince Signorello, macro strategist and work from home king, but we got him in the studio. He's going to join us here and talk about the markets, along with Callie Cox, U.S. equity analyst with eToro. They're going to join us here in studio and talk about what's happening in these markets. We had the central bankers talking this morning, so we'll kind of wrap that up. Selma Hepp, chief economist at CoreLogic, is also going to join us. We're going to talk to her about the housing markets, a big rebound in new housing starts, get her sense of this housing market in this market these days. But we're going to kick it all off this hour with Charlie Pella with the Bloomberg Business Week.
Hi, thank you very much, Paul Sweeney. We've got the Dow lower, the S&P little change, NASDAQ 100 index, and the Russell 2000 all advancing. Stock market, though, looking at some choppy action after Fed Chair Jay Powell downplayed the odds of a recession while signaling that the Federal Reserve could potentially hike for 2 straight meetings if needed. His remarks, of course, carried live on Bloomberg Radio. So here's where we stand. We have the S&P right now at 4380. It is higher now by just about 2.5 points, up by less than 0.1%. Dow Industrials in the red, down 77, decline there of 0.2%. NASDAQ Composite Index up 61, a gain there of almost 0.5%. NASDAQ 100 Index up 60 points. That is a gain of 0.4%, while the Russell 2000 also higher, up by 0.3%. 10-year yield now 3.73%, with the 2-year yielding 4.72%. Spot gold lower, little changed, down $2.50 the ounce to $19.10, down by about 0.1%. West Texas Intermediate crude, though, still below $70 a barrel, but advancing 2.3% right now, $69.25 a barrel on WTI. Doug Cass is the president and CEO of Seabreeze Partners, and on Bloomberg Surveillance this morning, he told us the stock market is flashing a red light.
At the core of my concern is the level and path of interest rates. And if we solely look at interest rates versus stock prices and valuations,
sure,
equities really are more overvalued against rates today than they were at the end of 2021, which is saying something. And the divergences between valuations and real rates is as wide as I've seen in more than a decade.
You can hear more of that conversation on the Bloomberg Surveillance Podcast. You can download it wherever you get your podcasts. NVIDIA leading declines in tech stocks today on a report that the U.S. may further tighten chip export restrictions. NVIDIA shares down now by 0.4%. Again, recapping here, we are looking at a mixed market midday. S&P up 4, a gain there of just about 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pella, thank you so much. We appreciate that. Madison Mills and Paul Sweeney here in our Bloomberg Interactive Broker Studio. Let's get right to our markets roundtable. We got some players in here. Vince Signorello, macro strategist for Bloomberg News, and Callie Cox. She is the eToro strategist. Callie, let's start with you. In that clip that Charlie just played, Doug Cass, we had on this morning, he was just saying basically he thinks this market's super expensive. He's very nervous about the market, and he goes net short, net long. He's net short right here. What do you think about this market? Is it overextended? Are we too far over our skis here?
Yeah, so I think this comes down to if you think the bull market can continue, and that seems pretty obvious, but if this is a bull market, you have to remember that bull markets can be fierce, even though we have an uncertain future ahead of us. Since 1950, the first year of every bull market, or in the first year of every bull market, the S&P has risen an average of 43%. So we're a little cautious here. We wouldn't say that we're so pessimistic that we would think prices could go down, but we do think that investors need to tread with caution and really think about quality.
Well, what about you, Vince? What are you thinking in terms of whether or not this is a real bull market or if the Wilsons of the world are going to be correct?
I think it's a real bull market, and I think Mr. Wilson's going to have
have a nice, interesting conversation with the world come the end of the year. I think
No
short term.
3900s in your predictions.
No, I
here.
think we could backtrack, 100, 150 points in the S&P. I mean, we've come a long way. But the longer term outlook, the markets do not believe what the Fed is saying. I do not believe what the Fed is saying. It's a credibility issue for the Fed to keep pushing this higher rate scenario. I don't think it's real. I don't think it's justified. And when the Fed does pause, this market's going to rock. And I think you could easily see it up around 4,800 in the next 12 to 18 months.
So, but Vince, for better or worse, we just listened this morning from, the ECB had their panel in Portugal, and leading banker after another, including Jay Powell and Christine Lagarde, talking tough.
They're talking tough because, again, I think they're so trying to recover from the errors they made by calling inflation transitory, and they need to put a face on it. And I think they're going to keep talking that tough to a point where we're going to see real yields rise because inflation is going to come down below levels until they're ready to cut. And what that's going to do is going to drive a rally in the bond market, and then it's going to drive that rally in the stock market. And all the time they were talking this morning, yields went down in the U.S., stocks went up in Europe.
Well, Kelly, talk to me about that global picture, because you mentioned in your notes that 6 out of the last 7 bull markets started as the Fed lowered rates. So if they cut, does that ruin their end goal here?
So I don't think they're cutting anytime soon unless we see a recession. And I think, obviously, that's the wild card that everybody's grappling with. And, lower Fed rates have come with recessions or have come with crises. So the Fed right now doesn't have a good reason to cut rates. And they see inflation, quite high, persistently high, so they have a good argument for keeping rates higher. I think that's a good story. It shows that the economy is rocking and rolling, especially when a recession is at the top of investors' minds. Mm-hmm. But at the same time, a lot of the rate-sensitive sectors have rallied on the back of some hope for lower rates. So I think that it's an awkward truth to grapple with, the fact that most bull markets start in the depths of a recession, but I'm not sure that has to be the same case here. And we've seen a lot of things change over the past 3 years or so. And quite frankly, we could be having a rotating recession at the moment.
Hey, Vince, what do you look at all over the markets, commodities, rates, currencies, all that kind of good stuff. What are you seeing other parts? What are you hearing from some of the traders that you talk to, just in terms of, I guess, their willingness to take on incremental risk here?
I think they like the risk scenario in general. They think for the most part, the dollar has run its course. That equities are for real. With there are obviously exceptions out there. To the point Callie just made about interest rates and potential Fed rate pause. I don't think I agree. They don't have a scenario right now where they're going to be cutting rates anytime soon. But if you look at all the data for June, it points to them holding in July as well. CPI was lower, PPI lower, export-import prices lower, prices paid lower in all the scenarios, sentiment better in terms of expectation.
So you don't think they're going to raise in July?
I'm not saying they won't. I'm saying they don't have a reason to.
Okay.
The data suggests that they should hold one more time. Now, if the data from June matches the data going into the middle of July, then I think they should hold. Whether or not they do, again, I still think it's a credibility issue, not a data issue.
Kelly, talk to me then about how retail investors should be looking at Fed moves in the market more broadly. You have a great tweet about how at least one stock from each S&P 500 sector, except for energy, has hit a 52-week high in the past month. How should retail investors be looking at and digesting that?
Yeah, so I want to remind everybody that retail investors are mainly longer-term investors. They get a really bad knock in the market as being these short-term day trading type speculators. But a lot of retail investors are just investing for retirement or that nest egg, that long-term security. So if you're a retail investor, you're looking long-term, you're just taking some money from your paycheck, chucking it into an index fund, review the headlines, be aware of what's going on, but at the same time, remember that 90% of these headlines don't matter to you, and that, even if we do plunge into another bear markets, every bear market that we've hit, we've recovered from. It's all about emotion management. If you are a little bit shorter term, I would be a little more cautious. I would definitely, consider the headlines more. This is an interest rate sensitive market at the moment. We've been talking about the Fed for this entire conversation. And the Fed has a really good argument to keep rates high, no matter if they hike or pause in July. So if you're looking over the next 3 to 6 months or so, I would really focus on the companies that have those quality balance sheets that can operate in a slowing growth, high rate environment. And that's what we've been telling our customers. I mean, really pay attention to what you're investing in and what can survive these grinding conditions.
Well, Kelly, I want to ask you a follow-up on that, because Goldman had a note recently about how when retail investors start to take a little bit of cash, they start to get out. That's an indicator that they're about to miss out on a rally. Talk to me about your view on that. Why do you think the retail investor just gets such a bad rap?
Well, it's a mystery to me, and I mean, you know that I work for a retail brokerage, so obviously I'm biased here. But individual investors have been stronger than most have thought in this cycle. I mean, we take a quarterly survey, it's called the Retail Investor Beat Survey, and we flat out ask investors, what are you investing in? What are you thinking about? What are you worried about? Where do you see your money going in the next 3 months? And their allocations have held pretty steady, even though they've diversified a little bit, they've become a little bit more tactical, and they, like every kind of investor, are worried about the future. They're watching their risks. So I'm not quite sure. I think that there's been a change in psychology and sophistication of the retail investor, since the global financial crisis. And consumers, let's be honest, are in a really good position right now, and most people invest when they have money. So I have no doubt that people are taking chips off the table, let's be real, but en masse, I think investors are still in it.
Hey, Vince, we had a company that people kind of come in contact with every day, General Mills, make consumer product stuff. They basically said they can no longer pass price increases through to me and you and Callie walking down the supermarket aisle. That, to me, if I'm the Federal Reserve, that's real inflation peaking, if not completely, coming down, which, it just confirms what we've seen from the government data. But there's a real company touching real people every day. Does the market, do Fed officials look at that kind of stuff?
They do. I interviewed Charles Plosser once when I was with Wall Street Journal, and I started the conversation. He cut me off and said, yes, I do go to the supermarket, and I do look at the cereal prices. So I'm gonna hope that the rest of them follow his lead and still do that. And I think it speaks volumes that when you have a large a company that touches retail and basically says, we're at a wall, people are just not gonna buy if we keep raising prices, that suggests something that's rolling over. That's a consumer that's starting to change their buying habits. And consumers do. It's the old story, if steak gets too expensive, if beef's too expensive, you buy more chicken. And it happens, and people will move to alternatives if they have to. When egg prices were through the roof, people went to alternatives for breakfast. And I think they'll do the same. And considering how much sugar is in cereal, it's probably a good idea.
Okay, fair enough. But I do want to get your FX expertise while we have you here. You're an FX guy, obviously. How badly does a company like a General Mills, or more broadly other consumer packaged goods companies that have strong international exposure, how badly do they need some more downside for the dollar to be successful in the second half of the year?
Big time, because they don't hedge. And I've marketed to them forever, and they don't hedge. They somehow think the dollar is always going to be strong, they're going to have, or the dollar's going to be weak rather, and they're going to have this great situation. The dollar is going to come down. It's overdone, and the large corporations, the large cap companies, literally don't hedge, and you'll always see. You watch the earnings numbers, and the earnings numbers that came out last year in particular were gruesome. With the strength of the dollar, as they were reporting some huge FX losses.
Yeah.
So
why don't they hedge?
It's a CYA story. I remember speaking to a guy a company buying a railroad in Australia, and I put a pitch together for them to save them potentially $30 million, 10%. And the treasurer said to me flat out, he said, if I do this trade and you're wrong, I'll lose my job. I said, but what about if I'm right and you save $30 million? He said, no one will notice. He said,
so every job is the same, basically.
He said, there's no reason for me to take this kind of risk. I don't get paid to save the company money on this scenario.
Yeah, interesting. Callie, for your clients, your customers, what are you suggesting sector-wise they allocate? Where do they go in the market here? Do you have some sectors that screen well for you guys?
Yeah, so when I think about sector allocations, first I think about the economic trend, and I think that's pretty clear at the moment. The Fed has the economy and a vice. They're not letting up anytime soon. If we hit a recession, then you have to rethink the sector allocations, of course. But for now, in a slowing growth, high rate environment, I think it makes sense to look a little bit at defensives while keeping your toes in some quality risk as well. When I say quality risk, I mean looking at those rate sensitive sectors, looking at those sectors that do well in an early bull market, but focusing on the bigger companies that you think can make it through a recession.
So where does tech fall out in there for you? Because tech's been, the Miracle 7 stocks that have been just kind of the stalwarts so far this year, making up a lot of what they lost last year, granted, but where's tech fit in for you guys?
Well, we all know that there are a lot of flavors of tech.
Yep.
So there's big tech, there are the AI, rising stars that people have been looking at. I like to tell people this, if you're looking at the speculative, smaller tech companies that you maybe believe in their story, then sure, stay invested in that. But at the same time, remember that this is a very tough operating environment for them. Investment is going down, especially in the early stage companies. And these are the types of businesses that get squeezed by the higher costs and, higher financing rates generally. So, big tech, obviously, they operate in the same environment. I have some thoughts on if they'll lead the next bull market. They're looking a little big and bloated to me, but big and bloated could work here. They have really big cash moats and they have strong, healthy profit margins. So investors looking at big tech, that doesn't surprise me. I think that that's a smart idea, especially if you're thinking bigger and durable. Smaller tech, I would say probably think twice about that.
A lot of people looking into AI as well?
Yes, yeah. So we've seen that on our platform. We see it in the surveys that we watch. And does that surprise you? It doesn't surprise me. I mean, there's a lot of hype out there around AI, and I think, you have a good argument for saying that AI will probably change the world in some form or fashion. I'm a little cautious about how much we attribute to AI at the moment. I think it's a groundbreaking technology, but we need to see it flow into economic productivity. We need companies to spend on it. We need real utility from it. We don't just need to talk about it. And I think we can get there, but it's too early to tell.
Hey, Vince, real quick, just about 30 seconds. I'm looking at WTI crude oil, $69 a barrel. I mean, where does it go from here? Do I just have to be right on demand?
I think it's actually going to be more of a supply issue. I think for it to go up, I think the Saudis are going to have to engineer another cut. OPEC engineer another cut. We're not yet, as Kelly said, we're in a slower growth environment. This isn't an explosive growth environment. I don't think it's going to come from the demand side as much as it needs to be reduced from the supply side. I mean, we keep hearing about, they just cut recently, and oil went down. So it clearly isn't a demand issue. There's just too much supply out there.
All right, Vince, thanks so much for joining us. Vince Signorella, macro strategist for Bloomberg News, and Callie Cox, U.S. equity analyst with eToro, joining us here in our Bloomberg Interactive Broker Studio. We appreciate getting both of them together, talking about these markets. S&P 500 now up about 0.25%. This is Bloomberg. All right, let's get some company news with Steve Rappaport.
Paul, NVIDIA's stock is less than a quarter point away from offsetting today's drop earlier. The shares took a hit as there were reports that Washington is preparing to tighten exports controls to restrict sales of some AI chips to China. More on that from Bloomberg's intelligence correspondent Mandeep Singh.
Look at, the sales exposure to China. It's at least, 20 to 25%. And look, not all the chips are used by Chinese end customers, but you can think of, all the different SKUs that NVIDIA makes, especially on the data center side, that are more exposed to the sanctions. And if we have something like what happened to Russia in terms of, broader sanctions, that could be huge, especially for the semiconductor makers.
Thanks, Mandeep. Walgreens stock is down following big losses in yesterday's session, shares falling more than 9% after the chain cut its profit forecast for the year. Bloomberg's Jeff Bellinger reports store closings are now in the works.
Steve, Walgreens plans to close 150 stores in the U.S. and 300 of its boot stores in the U.K. Chief Financial Officer James Kehoe told investors the chain will focus more of its investment in its best-performing outlets. The pandemic boosted business for Walgreens and other pharmacy chains, but COVID-related store traffic has faded. The end of the emergency has also prompted states to pare their Medicaid rolls, and that has had an impact on drugstores. Steve?
Thanks, Jeff. Renault is closing in on a deal with Nissan to invest in the French automaker's electric vehicle division. Sources tell us talks accelerated after changes in Nissan's top management removed some obstacles to the deal. I'm Steve Rappaport, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long at Bloomberg. Tech mega caps fueling a rebound in stocks, with Fed Chair Jay Powell saying a recession is not the most likely scenario as the economy remains fairly resilient. S&P right now, though, higher by 7 points, up less than 0.2%. The Dow negative on the day, down 44 points, paring its losses, but still down 0.1%. We've got NASDAQ up 80. That is a gain of 0.6%. NASDAQ 100 index up by almost 0.6% right now. 10 years yielding 3.71% with a 2-year 4.70%. Spot gold lower a little change, down 0.1% right now at $19.11 the ounce. It is down by $2 the ounce. Bitcoin today, right now we've got Bitcoin down by 0.8%, 30,409 on Bitcoin. Crude up 2.25% right now, up $1.54 a barrel to $69.24. Bottom line here, we are looking at a mixed market. We've got the Dow lower, the S&P, NASDAQ both higher. As for the overall equity backdrop, Callie Cox is an investment analyst with eToro Securities, and she spoke with us moments ago right here on Bloomberg Markets.
Since 1950, the first year of every bull market, or in the first year of every bull market, the S&P has risen an average of 43%. So we're a little cautious here. We wouldn't say that we're so pessimistic that we would think prices could go down, but we do think that investors need to tread with caution and really think about quality.
And you can hear more of that conversation on the tape podcast. You can download it wherever you get your podcasts. Spirit Aerosystems Holdings and leaders of its largest union have reached a tentative deal on a second new contract proposal, aiming to end a strike that has halted production of key parts used in Boeing and Airbus jets. Right now, Boeing is up 0.7%. We've got shares of Spirit Aerosystems Holdings down by 0.9%. Again, recapping here, S&P up 9, up 0.2%, 2-year 4.70%, with the 10-year 3.71%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate it. Madison Mills and Paul Sweeney here in our Bloomberg Interactive Brokers studio. Let's talk real estate. Let's talk residential real estate. And we can do that with our next guest, Selma Heppen. She's a chief economist at CoreLogic. Selma, thanks so much for joining us here. I guess my understanding is if you want to buy a new home, you really only have one choice because people aren't selling their existing homes. So you got to buy a new home, new construction, and that had a huge number, the fastest pace in more than a year just recently. Give us a lay of the land of how the residential real estate market is right now.
First, thanks for having me on the show. So home sales activity are sort of a tale of two different markets. In terms of new home sales, they're doing really, really well. As you mentioned, they're increased to a 15-month high as builders have been able to provide more incentives and on one hand, and on the other hand, as existing home sale inventory is almost non-existent in many markets.
So what needs to happen to change that? I know that's kind of the million-dollar question here, but is there anything that that can be done to kind of shift that dynamic?
Well, I think, the further we move away from those 3% mortgages, and as people, and there's always a natural transition that people go through and sell their homes, and, they get a divorce, they have to move for schools, they have to move closer to families. So there's always that natural process of home sales activity that happens. And so one combined with the other, I think down the road, we are likely to see more new home sales on the market. The other thing is, baby boomers are the largest cohort that with the highest home ownership rate. And some 50% of baby boomers have owned their homes free and clear. And so for them, low mortgage rates, are not making any difference right now. It's more about making that decision to leave their home, and in light of the fact that home prices have gone up so much, so that may be a difficult decision for them. But the mortgage rates themselves are not a constraining factor. So I think, again, as we move away from those really, really favorable mortgage rates, we're likely to see more turnover in terms of existing home sales.
Selma, what are the builders actually building these days? Because it seems like what I hear from pros like you, we really need kind of first-time home buyer kind of homes, entry-level homes, and that's not the stuff that's getting built. Because when I talk to home builders, they say I can make a much better profit margin on some of these McMansions than I can on an entry-level house. What are they actually building these days?
Well, I mean, so, it differs regionally very much. And I think in markets where you don't have a lot of regulatory constraints, which increase the cost of construction, those are the areas where you're likely to see more affordable or smaller homes. And then on the flip side, the markets that are more expensive, such as the West Coast markets and Mountain West markets, with a lot of regulatory constraints, a lot of costs coming into the construction, just to start building a home, that's where we are not likely to see a lot of affordable housing. So, it plays out very interestingly in where people are moving. So people are moving to those more affordable parts of the country and to more, where there is more new construction, because that's where they can afford.
Have we seen a reversal or at least declines, though, in people moving to those areas that are a little bit more affordable, as we've seen, employers pushing people to get back into the office, for example? Have we seen that decline in, people moving from New York City to Austin, for example?
Right. I mean, I think we do. But again, there's two different types of buyers. There is the retired buyer, and there is the buyer that is still working. And for the buyer that's still working, they are likely to be going back to larger cities. And in our CoreLogic Home Price Index, and actually Case-Shiller Index that came out yesterday, showed a stronger home price appreciation, or at least less of a deceleration in home price appreciation in markets that are more larger employment markets, such as Boston and Chicago, for example. And then you still have the markets in Southeast and South in Texas and Florida and Carolinas, for example, where you do have retirees going, and where you do have those folks that are not necessarily tied to a desk in an office. So, I would say that the rate of migration has slowed in some ways, but it has not completely stalled. I think what we're seeing is we're seeing trends going back to pre-pandemic levels, and even at those times, we did see a lot of migration to those more affordable markets.
Selma, talk to us about just kind of this new construction market, new home sales market. We've heard that some builders are actually offering to buy down a buyer's mortgage, so the 6 or 7% maybe is more like a 3 or 4%. Are you seeing, is that pervasive out there? Is that a good business practice? Is that what's needed to get people into these homes?
Well, I think in terms of affordability, it does seem like it was needed. It wasn't until, in new home sales inventory climbed to some 10 months supply at the end of last year, when mortgage rates peaked at 7%. And that's when home builders started providing mortgage rate buy downs. And we did see home buyers coming back sort of in hordes in some way. I mean, we can see that by the numbers that were just released yesterday. So people are sensitive to mortgage expenses, and typical mortgage payment rose to all-time high at the end of last year. So a lot of people are pushed out of the market. So I think it is helping. It is helping bring folks back. And but on the other side, I think one thing we have to keep in mind is that if people, there is no inventory in a lot of markets out there. There's just simply nothing to buy. So people are turning towards areas where there is something to buy, because we do have, millennial population, largest cohort in the U.S. that is coming off first-time home buying age, and there's some 15 million of them. And so they have good jobs. They went through school. They have good incomes. And so they are, likely to want to buy a home, irrespective of where mortgage rates are right now. Looking at the overall share of mortgages that were originated with mortgage rate buy downs, it has increased from zero, when we were at record low mortgage rates, to some 3% at its highest points in November of last year. So it does seem, it's not a huge increase, but it has helped spur market activity again.
Selma, really quickly, final 30 seconds here. To what extent are some of the headwinds you're talking about forcing millennials to kind of just say, all right, I'm never going to own a home, I'm just going to keep renting? Are you seeing that?
Yeah, I mean, I think that's always sort of been the case for younger people when they're in their early 20s and up to, maybe 25, and they, get out of school and they get that first job, and maybe it's not paying what they were hoping to. So they're very pessimistic about their homeownership opportunities. I mean, when you think back about a decade ago when we were talking about millennials, eventually becoming that largest population, and we surveyed them, and they said, no, I will never buy because what's the point? It's so expensive. And they eventually did. So I think, if we give people enough time to, understand housing market conditions, to save some down payment, and their wages go up, and they couple with another person to have more down payment and more income for that home, I think they will come into the market.
Selma, thank you so much for joining us. Always appreciate getting your thoughts and analysis. Selma Hepp, chief economist at CoreLogic, talking about the residential real estate market. Again, we got that new home sales number was just really gangbusters and the fastest pace in more than a year. Right now, let's head down to Washington, D.C. We'll get rolling national news with Nancy Lyons.
Thanks, Paul. President Biden will be touting his handling of the economy during a speech today in Chicago, using a new term to describe it, Bidenomics. Bloomberg congressional reporter Zach Cohen says it's a high-risk strategy.
Not only is he touting the strengths of the economy, which any president would be happy to do, but he's actually taking credit for it at a time when voters are kind of skeptical about not just his handling of the economy, but the underlying economy itself, just given the fact that there's been 2 years of record inflation, still coming down and coming down to the more normal levels, but still certainly above where folks would like to see it.
Again, Bloomberg's Zach Cohen. From smoke to excessive heat, a large swath of the country is facing dangerous conditions today. Chicago and Detroit had the worst air quality in the nation yesterday, thanks to smoke from Canadian wildfires. That smoke is expected to move east, creating unhealthy conditions in parts of western and central New York. Down in Texas and the south central U.S., it's the heat that's the problem. A persistent heat dome has sent temperatures soaring into the triple digits. Well, it's been an air travel nightmare for those traveling for the long 4th of July weekend. The system is still trying to recover from more than 2,000 cancellations and 7,000 delays due to extreme weather conditions. Mike Sanfrantello has been trying to get home to Orlando from Newark since early yesterday.
We're just stuck here trying to figure out a way to get home, basically with no way of sleeping, no way of showering. We've just been sleeping on these chairs for a day and a half. That's basically it. And there's hundreds, if not thousands, of other people doing the same thing as we are.
The AAA is predicting over 51 million people will be in the air and on the roads for the long holiday weekend. Well, salvage teams have returned to land much of the debris from the lost submersible Titan. It'll help investigators determine what caused the vessel to have a massive implosion. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
analysis, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. S&P 500 index briefly dipping back into the red. Choppy action right now, little changed. The S&P is up by 1 point. Right now, we have got the Dow Jones Industrial Average down 35, a decline of 0.1%. NASDAQ holding on to a 29-point gain, up by 0.2%. Bottom line, though, we are seeing moves between gains and losses on the S&P amid quarter-end positioning. Fed Chair Jay Powell also downplaying the odds of a recession while signaling the Fed could eventually hike for 2 straight meetings. 10-year yield 3.73%, with the 2-year at 4.72%. Spot gold lower now by $2.50 the ounce to $19.11, drop there of just about 0.2%. West Texas Intermediate crude up 2.7% right now at $69.55 a barrel. Traders, meanwhile, are awaiting the results of the Fed's stress test. Later on today, Fed Chair Jay Powell also says the American banking system is strong and resilient.
When it comes to the events we had earlier this year with 3 banks that had pretty idiosyncratic business models and funding models as well, I think we need to learn lessons, and we're not hiding from that at all. We understand there going to need to be regulatory strengthening of both regulatory and supervisory practices as it relates to institutions of that general size, I would say.
Powell was responding to a question at a central bank forum in Sintra, Portugal. And again, after the close of trading today, the Federal Reserve will be releasing the results of its latest bank stress tests. Recapping, stocks are trading mixed, with the S&P up now by 0.5 point. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. Madison Mills and Paul Sweeney here in our Bloomberg Interactive Broker studio. Pulling out the SPX, S&P 500, and the RSI function relative strength. And just a week or so ago, the S&P 500 was oversold above that number of that level of 70, which for many traders says it's kind of oversold. We've dipped back down below that line here, but still, for a lot of folks, this market feels pretty frothy here. Let's check in with Brian McCauley. He is a portfolio manager at Hennessy Focus Funds. So, Brian, how are you guys here? We're done with the first half of the year. What do you feel about these markets? How are you guys feeling about these markets here? Is there still opportunity there, or has this run kind of made this market maybe a little too rich?
Well, certainly a little bit less opportunity than we saw a few months ago, but do believe that there's a lot of opportunity in spots in the market. In particular, when we look at our portfolio at the Hennessy Focus Fund, we see opportunity in the businesses that are cyclical and are currently discounting a recession coming up. And so, are we going to have a recession? Not certain. It's possible, but we think that there are a number of stocks in our portfolio and more broadly that are discounting a recession into their price and therefore providing a pretty good opportunity at this moment.
And you're more interested in companies with a discounted valuation as well. Are you concerned at all that might force you to kind of miss out on some of the tech rallies that we've seen driven by some of that AI euphoria?
Yeah, it's certainly been an interesting market the last several months, but at the Hennessy Focus Fund, we take a long-term view. Our average holding period is typically 7 or 8 years in a position. And so these short-term fluctuations and sector strength are not terribly important to us. We're trying to pick winning businesses for the long term that can compound at a mid-teens rate for us, earnings per share or cash flow per share, pay a reasonable valuation for those businesses so that ultimately our investment returns ends up being at a mid-teens rate over the long term. And compared to the broader market and long-term market history, high single-digit returns in equity markets, if we do our job, that should position us well.
Brian, when you do that bottoms-up research, how important is the management team, and how do you get comfortable with management teams if you're going to be a long-term holder?
Yeah, management is a critical component, particularly over the long term, right? Because they can have a big impact over a 5 or 10 year period. And so management, we're also looking for businesses with a strong competitive position and defensible moat, that have some attractive growth opportunity to them. And again, are available at a reasonable valuation. And so management is one of our core criteria. And for the most part, we make an assessment about management by looking at their track record, judging how they've run the business in the past, how they think about and talk about capital allocation, and the type of culture that they built around them, and in trying to assess whether their past success can perpetuate into the future.
All right, I want to talk about some of your stock picks, starting with CarMax, which has had kind of a volatile journey, but at the current moment they're trading above their 100 and 200-day moving average there. What makes you certain that CarMax is not just benefiting from some of the market factors that we're experiencing right now that might start to go away as hopefully the Fed does start to achieve their goal of fighting inflation and we get our economy back on track here?
So if we zoom out a little bit, we'll see that CarMax stock is down from about $150 at its high to about $84 more recently. And so we also think that the business has about $6 to $7 of earnings power today. That should grow to close to $10 in earnings power as you look out 3, 4, 5 years. And so for a stock that still has a lot of growth remaining in it, a business with a lot of growth ahead of it, paying $84 for $9, $10 of future earnings seems like a pretty good deal to us. So, they've had a difficult time because there was a boom in auto sales in COVID, and now we're experiencing, a hangover, so to speak. Vehicle affordability, just like housing affordability, is challenged, and so we're seeing lower vehicle sales. If you look back over the last 40 years, interestingly, used vehicle sales are at about 40-year lows. So you could look back and see 4 or 5 other circumstances over that time period where we've had used vehicle sales at this low level. But there's strong evidence that, we'll return to trend in used vehicle sales, which is, a nice step up from where we are now. And, that is almost assured to happen in time. So we think that you can buy the company at discount valuation on normalized earnings at what we think is the trough in industry sales and sales for CarMax.
Hey, Brian, talk to us about Ashtead Group. I know it's listed on the London Exchange. Tell us what this company does and why you guys own this one.
Yeah, you may know their operating business, Sunbelt Rentals.
Yep.
Sunbelt is the number 2 equipment rental company in the United States, just a bit behind United Rentals. Sunbelt has about 12% market share of that industry today, up from about 6% market share 7 or 8 years ago. And we think that they're on a glide path to have nearly 25% or more market share as you look out over the next decade. The reason for that is there are important benefits of scale in this business. Number one, you get a discount on the equipment you purchase from the manufacturers. But more importantly, number two, if you have a lot of equipment in a market, you're better able to meet the needs of your customers, which tend to be construction contractors and industrial companies. So you've got more inventory, more availability, more breadth. You're more able to say yes to that customer. We have what you need, and we can get it to you next day or even same day, which is important to those customers. And so we see their market share growing significantly over time, and the business creating a lot of value in that process.
Interesting. Yeah, there's one right near me down the shore. I'm going to take a look at it maybe over this weekend.
There
All right,
go.
Brian McCauley, thank you so much for joining us. Brian's a portfolio manager at Hennessy Focus Funds, giving us some names to think about. Again, Ashtead Group was one of their names. Encore Capital is another we didn't get to chat about. And the third one you mentioned was CarMax, that we all know about. CarMax, it is a Richmond, Virginia-based company. I'll point that out. I haven't been a Richmond person myself down there. So good stuff. S&P 500, we are off 0.2%. Not much happening at the index level today. We'll have more coming up. This is Bloomberg. All right, let's get some company news right now with Steve Rappaport.
Paul, it was only a few weeks ago that NVIDIA stock reached a record high. So what sent investors pulling back this morning? More on that from Bloomberg's Rebecca Chung-Wilson in Hong Kong.
There's two main components to this. The first is that the US, as early as this month, may look to curb access of a sort of chips with lower capabilities, and that's a problem for NVIDIA in particular, because at the moment those chips just require a license from the Commerce Department, and NVIDIA has focused on trying to produce more of that this year. And the second component of these new restrictions would be limiting cloud services to Chinese AI companies.
Thanks, Rebecca. Shares right now of NVIDIA are currently down more than 2%. Boeing's largest supplier reaches a tentative deal with union workers to end a strike that halted production of key parts used by the aircraft maker. Spirit AeroSystems' new contract proposal sweetens previous offers on health insurance and increased wages. Workers will vote on the deal tomorrow. Shares of Boeing currently up less than 0.5%. And with less than 5 weeks to go before the expiration of UPS's labor contract, Teamsters President Sean O'Brien upped the ante yesterday, demanding a powerful tentative agreement in a week's time. UPS and the union are racing to prevent what would be the first strike for the company in more than a quarter century. Failure to reach a deal could clog supply chains because competitors like FedEx and the U.S. Postal Service won't have nearly enough capacity to absorb the 20 million or so packages that UPS handles daily. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Well, we started off the morning with a lot of Fed central banker speakers, you say, Bank of England, European Central Bank, Bank of Japan, the U.S. Federal Reserve. They're all over in Portugal for ECB conference. And they pretty much, the message was pretty consistent, maybe with the exception of the Bank of Japan, which has low inflation. But certainly the others were talking very tough on inflation and on their path to high interest rates, maybe even a little bit higher here. So Fed Chairman Jay Powell said he's not taking off the table the possibility of 2 additional rate hikes. You put all that together and look at the market, and it's kind of hanging in there. Okay, S&P is off about 0.3%. That's kind of towards the low for the day. But again, given some of the rhetoric we heard this morning, could have been worse, perhaps. Right now, let's head down to Washington, D.C. Nancy Lyons has world and national news.
Thanks, Paul. Skies in the Northeast are once again glowing orange, a byproduct of Canadian wildfires that continue to burn. Chicago yesterday had the 3rd worst air quality in the world, and severe weather is also making air travel dicey. As of this morning, there'd been more than 1,000 flight cancellations, nearly 600 delays. The future of travel looks brighter. High-speed rail in California and electric bike charging stations in New York City are about to receive a huge infusion of federal funding. We get details from Bloomberg's Amy Morris.
$25 million to help fund 173 electric charging stations for e-bikes and scooters in New York. Another $25 million going toward building 2 intercity passenger rail stations connecting Las Vegas and Southern California, part of $2.26 billion for more than 160 road, aviation, transit, and rail projects for all 50 states and 2 territories. The funds will be split between rural and urban areas. About 70% of projects are aimed at underserved communities. In Washington, I'm Amy Morris, Bloomberg Radio.
It's a not guilty plea from Daniel Penny, who was arrested last month for holding Jordan Neely in a deadly chokehold on a New York subway train. Penny appeared in court today. He was charged with criminally negligent homicide and second-degree murder. Thomas Kenneth is Penny's attorney.
All the evidence is that we've seen is that our client acted reasonably under the circumstances and that he was justified in the actions he took, however unfortunate the consequences.
Meanwhile, more Americans are believing the pandemic to be over, but fewer than half say their lives are back to business as usual. A new Gallup poll shows 64% of those asked said the COVID pandemic is over. In February, that number was only 49%, and just over 40% said they do not believe their lives will ever go back to what was normal pre-pandemic. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul.
All right, Nancy, thank you so much. We appreciate it. Madison Mills, Paul Sweeney here in the Bloomberg Interactive Broker Studio. A story that really got my attention from Bloomberg News, Olivia Raymonde, I guess, is Raymond. She is the reporter, and she cites some research from Stephen Flynn, a senior credit analyst at Bloomberg Intelligence. And how about this number? About $88 billion of junk-rated bonds are maturing through the end of next year, threatening to send interest costs for the riskiest corporations soaring as the U.S. economy flirts with recession. So there's still, it could be a lot of pain out there for those rising interest rates as companies need to refinance at much, much higher levels.
Yeah, and like you were telling me in the break, Paul, for a company like Ford, that may not be a huge issue, but a company like Dish that's already struggling, this could spell disaster, and those refinancing needs are going to pick up most meaningfully starting next March. If you look in the BI notes too, it looks like a lot of financials have their junk bonds due starting 2023, heading into 2024. So that's a sector that's already kind of not been doing so great.
And you mentioned Dish Network. This is a company that I know very well. I've followed for about 25 years as a publicly traded company, and they have about $22 billion of net debt on their balance sheet right now. But then you look down on I'm using the FA function on the Bloomberg terminal for financial analysis, and I see the street's only forecasting about $2 billion of EBITDA. So that's leverage, financial leverage of about 12 times. And for this industry, you want to see leverage at about 4 times, 5 times. Maybe I'll stretch it out to 6 times, but 12 times is just brutal. So it really calls into question what this company is going to do with its balance sheet. And there probably, and certainly are others that have that same issue coming up as interest costs are much, much higher. The cost of debt is much higher. All right, coming up, Sound On with Joe Matthew. That starts right now.
but has now come back up. So that gigantic trillion-dollar chip maker seeing a little bit of respite from concerns about Washington woes on chip sales to China. The 10-year yield is coming off a little bit, 372.52, the level as investors buy some of that. Maybe a little bit of recession concerns, although Fed Chair Jay Powell kind of pushed those out a little bit in Sintra this morning. The Bloomberg U.S. Dollar Index gaining to 1232, 1233 right now, and we heard a little bit about FX at Sintra as well, with Ueda complaining that all of the other central banks have currencies that are strong. It's not his fault that the yen is weak. And then NYMEX crude gaining today 187 a barrel, but still can't make it over $70 for West Texas Intermediate, trading at 69.58. Now, in terms of stocks, several of the world's top central bankers said they don't necessarily see a recession as the most likely outcome of their aggressive policy tightening. They spoke earlier at the ECB forum in Sintra, Portugal. Listen in.
We still have ground to cover.
Although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough.
We are data dependent. We will decide on a meeting-by-meeting basis.
We will be evidence-driven, so we will wait for the next set of evidence for our next meeting.
Underlying inflation is still a bit lower than 2%. That's why we are keeping policy unchanged at the moment.
If our baseline stands, then we also know that we will very likely hike again in July.
We're going to move the decisions a little bit, make them with a little bit more time in between them.
We will do what is necessary.
I wouldn't take, moving at consecutive meetings off the table at all.
Let's get more now on that really Fed speak and how it affects the markets with Bloomberg's cross-asset reporter, Katie Greifeld. Katie?
Matt, I want to focus on one thing Jerome Powell said. We know that the dot plot that we saw about 2 weeks ago penciled in 2 more hikes from this Federal Reserve. And Powell today over in Sintra said that could come at consecutive meetings. He said that this isn't necessarily a pace where they go every other meeting. So let's look at what markets actually expect here. Right now, we have about 29 basis points of tightening until we get to terminal. So that's not quite 2 hikes, but seems that traders have decided, okay, maybe we get another hike, more than 1 hike here. We'll see if we get to that full 50 basis point pricing. But what's interesting about that chart, this chart behind me, I think, is that it seems like we're all on the same page when it comes to rate cuts. You can see as recently as May, there were over 100 basis points of cuts priced into this market. Now we're looking at just 6 basis points. So not quite there when it comes to Fed hike pricing. But again, it seems like bond traders have gotten the message when it comes to cuts.
Definitely pushing that out. Katie, come over here and join me. Let's dig in a little bit more with former Fed Vice Chair Richard Clarida. He is now Global Economic Advisor over at PIMCO. And Rich, really great to get some time with you. Thanks so much for joining us. What was your take on Jay Powell at Sintra? Was he a little bit more hawkish than maybe the market had anticipated?
Just a touch, although market pricing, first of all, good to do your show, Matt. It's been a while. Maybe just a touch, although market pricing really did not move that much. It was really an excellent panel. I've seen a number of these over the years in different formats, but to get the big 4 all on the same stage with the new appearance by Ueda, Bank of Japan, who just joined, I thought it was a good session. Maybe Jay skewed a little bit more hawkish than he did at the press conference, but I don't think a big mover of markets today.
But markets still don't buy that the Fed is going to hike rates 2 more times, as the dot plot shows. And even though we've pushed out the cuts from this year in WIRP on the Bloomberg terminal, we still see cuts priced in 24 and into 25, even though Powell said at the last Fed meeting it was going to be years before we saw cuts. Why does he want to push that narrative, and why doesn't the market buy it?
Well, I think at the last press conference, Matt, he indicated it may be several years before they project inflation getting down all the way to 2%. But the SEP projections themselves actually do have rate cuts in for next year. The Fed's rationale is that if they succeed and inflation starts to fall, they can cut rates basically to keep real rates unchanged. And so I do think their baseline probably does have cuts for next year, certainly in the baseline. The question is, markets, I think, have priced in more than the Fed sees right now.
And in looking through the headlines of what we heard from Powell this morning, this caught my eye sort of on this topic, is that Powell sees U.S. getting 2% core inflation by 2025. And to your point that if you look at the dot plot, you actually see some cuts penciled in next year. Is there a situation where, okay, we're not at 2% yet, but the Fed sees something and is willing to cut even though we're not back to target?
Oh, yes. In fact, that's really our baseline view at PIMCO. It's what we sometimes call the 2-point-something destination. That is, we could see them under their outlook. We could see inflation next year falling below 3. That's obviously is not 2. But in that context, inflation will have fallen substantially, and we do think the Fed can ratchet down and would ratchet down rates in those circumstances. And so yes, obviously, the Fed will be like the ECB and other central banks will be especially data dependent. But yeah, we could see cuts next year, even if inflation remains somewhat above 2%.
Well, on the topic of data dependency, on June 15th, after the Fed meeting on Bloomberg Television, I believe it was, you made the point that I really think that for the first time in a long time that the Fed is data dependent. Does that imply that up until this point, perhaps they hadn't been? What has changed that now they are definitely data dependent?
Well, quite frankly, the Fed really risked falling behind the curve last year. They only began to hike rates at the March of 2022 meeting. And then under Powell's leadership, and I think he showed excellent leadership, he unified the committee to a very, very aggressive, steep liftoff path. And I actually thought, really for most of last year, the focus was on getting rates into restrictive territory, and they were going to do that for a pretty wide range of data. I think they now agree, and we would agree that rates are in restrictive territory. They have to keep them there for a while. And I really do think for the first time in this cycle, there is some data dependence. For example, they did skip or pause at the last meeting, and the chair did not want to rule out that they could pause at future meetings, but he also didn't want to rule out they could go at the next 2 meetings. So more optionality now for the Powell Fed than I think that we've seen in some time.
I wonder what you think about the impending recession. I mean, obviously, there's going to be a recession at some point. The question is when. On the one hand, we're seeing strong economic surprises to the upside. If you look at the Bloomberg Economic Surprise Indicator, it's really spiked over the past few weeks. And on the other hand, we're seeing things like delinquencies on car loans starting to ratchet higher, right? Savings and bank balances starting to come down. What's your take on a recession and when we're going to get it?
I think you phrased the question well, Matt. There will at some point be a recession. We've not banished the business cycle. Economists are not good at a lot of things, and one thing we're not good at is forecasting recessions. If we do get a recession, say later this year or early next year, it'll probably be one of the most anticipated or forecasted recessions in my professional career. Our baseline view is, monetary policy does operate with a lag. We've seen a tightening in lending standards by banks. The leading indicators are in negative territory. The curve is inverted. So all the classic signals are flashing a recession either later this year or next year. The labor market traditionally is a lagging indicator. It's certainly lagging in this cycle. It would be great if we could get a soft or softish landing. So we're not putting a 0 probability on that. But we do think that altogether that a recession is more likely than not.
I want to pivot here. I wasn't expecting to ask you about artificial intelligence, but the Fed brought it up. Powell brought it up himself. Some headlines there. Powell said that the Fed is trying to get smart about artificial intelligence and that the Fed is spending a lot of time on AI, but it's too early for a conclusion. I'd love to get your perspective on how a central bank goes about sort of factoring in technology like artificial intelligence into their economic models. How do you even go about that?
It's a great question, and actually at our recently completed PIMCO forum, we devoted some time what we call the aftershock economy, and one of the potential disruptors over the next 5 years is the rapid adoption of AI, and it's complex for the following reason. If you talk to experts, and I wouldn't pretend to be one, but we do talk to experts, you could see AI having a big impact on inflation. It could be disinflationary. You could also see AI having a big impact on growth. Faster growth tends to push up interest rates. So even if AI becomes a big deal, it's not at all clear whether or not the net effect would be to push up or push down, neutral policy rates. So I think the Fed is to be commended by trying to get ahead of this. I haven't had really any contact with my former colleagues, but I would imagine that they're looking at both sides of the AI coin, if you will, the potential for disinflation in terms of labor cost reduction, but faster growth. And I think they'll probably be looking at both those dimensions.
In terms of inflation, Rich, what do you see as the main drivers right now? We still see a very sticky core around 5%. Is that because we still have, supply constraints, or is it the demand side that's the problem?
Excellent. I think the supply constraints, which were a big deal, certainly in my last year as vice chair, 2021, and last year, I do think the supply story is in the rear view mirror. Quite frankly, there's more stickiness and inertia and inflation than I would hope or have expected a couple of years ago. I do think, however, that we are going to get some good news on core inflation because the way in which the statistical agencies calculate inflation is very much a lagged rearview mirror approach on housing and rental inflation. More high frequency measures, Zillow and the like, have turned, and that's a big part of the price indexes. I think goods disinflation may turn into goods deflation because of better supply conditions. And so I do think that we will begin to get some better news on inflation, but the Fed does have a ways to go, and I think the chair has mentioned that underlying inflation, so core or other measures, are probably at least a point, maybe 1.5 points higher than they want them to be, which is why they're trying to engineer the slowdown in growth. But I do think that the supplies, to your question specifically, Matt, the supply drivers of inflation, I think, are no longer really a factor.
Well, to the idea that, okay, inflation is coming down, maybe it's been a little bit stickier than expected, maybe we don't get back to target for about 2 years here. Should the conversation be less around how many more rate hikes we need versus how long should the Fed be on pause?
I think that's the way they're thinking about it, both from the chair's comments today and certainly from speeches and commentary from other Fed officials. For example, Dallas Fed President Lori Logan recently has indicated that's exactly where I think the center of gravity now is on the committee, which is they recognize they've done a lot. They also recognize that monetary policy operates with a lag, and so it does make sense, I think, for them to slow down the pace. But then the bargain is to convince markets that once they get to that restrictive level, wherever that is, 1 or 2 more hikes, that they definitely plan to keep rates there until they actually see demonstrable progress on underlying inflation. So I do think that the discussion becomes less about how many more hikes and more about how long they'll keep the policy rate in restrictive territory.
Rich, let me just finally ask a markets question where you want to be on the curve right now. Over the past few weeks, we've seen the 10-year kind of holding in a 370 to 380 range, while the 2-year's gone from 420 to 480. Do you think it's time to start moving out on the curve, or what do you think, and what's the view of PIMCO?
Well, broadly, really, since last fall, in terms of duration, so say at the 10-year yield on the 10-year, we've really thought of it as fluctuating in a range. We got up to 4 1/4, maybe north of that, and we've been down all the way down to 330, 340. So we're right in the middle of that range, which means we don't think we have a particularly strong view either way. We do think now that market pricing is broadly fair. there. The front end has moved around a lot. If you look at a chart, the volatility in the 2-year yield in the last 12 or 15 months is really eye-popping. But a lot of that reflected the very, very aggressive rate hike cycle last year, and also some increased volatility that appears to be narrowing. So right now we're really focused not so much on making a big bet on direction of rates, but making sure we have portfolios that are resilient and that offer right now in an environment where for the first time in really a long time, investors can have resilient portfolios with a nice, attractive yield. So it's a lot of good opportunities right now.
Excellent. All right, really appreciate your time. Richard, thanks so much for joining us. Former Fed Vice Chair Richard Clarida and Katie Greifeld, Bloomberg Cross Assets reporter and the anchor of Real Yield, which you can catch Fridays at 1 p.m. It's a relevant program, I think, to plug right now. Thanks so much for joining us. Now, President Biden is touting Bidenomics at a speech in Chicago. Here you see a live feed. For more on this, let's bring in Bloomberg's Laura Davison in Washington, D.C. Laura, doesn't really roll off the tongue like Reaganomics, but what actually is Bidenomics? It's also kind of a lot harder to encapsulate.
Yeah, well, it rolls off the tongue a lot better than the Infrastructure Act, the Inflation Reduction Act, and the CHIPS Act, which is what he is encompassing all in Bidenomics here. What Biden is doing is he realizes he has a messaging problem and sort of a packaging problem, in that he's done a bunch of different things to help the economy. 2 years ago, it was infrastructure. Last summer, it was the Inflation Reduction Act, which had all the investments in green energy, as well as the bill that also moved separately dealing with semiconductor investments. And he's seeing that these ideas are popular. The things he's done are popular. People, one, don't remember it, and two, don't really think of it and give Biden credit for it. So this is him getting out there at the start of the election season saying, look, here are all the things I've done. The other trick for Biden here is that a lot of these investments are multi-year investments, won't even see it until the end of the decade. So he's trying to preview a little bit of, hey, look, there's going to be more broadband. There's going to be these new clean energy jobs in the coming years. Wait for it and be sure to give me, Biden, credit for it.
What will he do, or what is he going to say about the possibility of a coming recession? Does he just, keep quiet on that and hope it doesn't happen until after the election? Or is it better, Laura, for a recession to come before that we can be getting out of at the time we go to the polls?
Biden has said this week that he thinks that the chances of a recession have decreased significantly and that we may avoid a recession entirely. For Biden, that is really the best case scenario. Going into a recession, even if we're starting to come out of it by the time the November 2024 election rolls around, that's a really risky proposition for him. There's a lot of times a lag in where the economic indicators are and what people are experiencing in their day-to-day life. So if there are job losses, if people are seeing the stock market down, if inflation continues to increase, Biden is much better off avoiding a recession versus, having a quick one and hoping to get out of it later.
All right, Laura, thanks very much. Bloomberg's Laura Davison covers Washington for us. If you want to watch Biden's comments, you can go on the Bloomberg terminal and type LIVE GO for more on his Bidenomics program and campaigning. Still ahead, banks are a bit lower ahead of the Fed's results for its annual bank stress tests, but the group is moving into a better area right now in terms of the markets. This is Bloomberg.
And money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
This is Bloomberg Markets. I'm Matt Miller. It's time now for the Wall Street Beat. We're about to get the Fed's annual banking stress test results this afternoon at 4:30 p.m. New York time. Let's bring back Katie Greifeld for a closer look at what to expect. Katie?
Let's talk about what is actually being modeled here. Behind me, we have basically the baseline scenario that the Fed has lined out. Unemployment rises to 5% by 2024. Home prices, CRE prices come up a little bit, and you do get a little bit of a detraction in real GDP, and also equities flat. So that's the baseline that these banks are being tested for. Let's talk about the adverse scenario, though, because it's pretty dramatic. So in that scenario, of course, it's much more dramatic. You get basically equities are going to fall much more, and you're also going to see unemployment rise much higher. But what's interesting is that this time around, for the first time in 2023, basically, there's going to be an exploratory measure of market shock that is sort of to try to address what we saw in March, that basically we had the financial system really come under pressure, and it seemed like these big banks weren't well equipped to handle it. So the stress test has become a little bit more of a lift. There's definitely been some measures added. We'll see how these big banks fare.
All right, Katie, stay with us as we bring in Ironside's macro risk advisor, Barry Knapp. Barry, thanks very much for coming to the program. Great to see you again in person. What's your take on these banking stress tests? As far as I've read, it seems like the big banks are going to sail right through them. So why do we care?
The missing in the adverse scenario, the missing scenario is a continued deep inversion of the yield curve that causes credit to contract and a broader economic credit crunch. So I think the banks have really a pretty toxic mix of policy coming at them right now. Treasury issuance is loaded or biased towards the front end, which is contributing to this yield curve, deep yield curve inversion. Fed policy, passive QT and active rate hikes is also exacerbating that curve inversion. And the potential to raise capital levels would also potentially impair bank profitability to the point where return on equity would fall back below 10%, where it was for much of the 2010s, or the 1950s for that matter, which is sort of my analog to a lot of this. And that would impair credit growth on a long-term basis, prevent banks from building capital and building equity. And so I think the banks are in a much more precarious spot than the Fed knows. This severe economic outcomes, unemployment going to 10%, there's very little credit risk in the banking system. This is about them owning high-quality assets at the wrong price, right? Mm-hmm. Buying 10-year or 5-year treasuries at 1% throughout 2021.
Duration mismatch.
And the duration mismatch. So that's the problem in the banking system, which is really acute for small community banks that don't hedge duration. They don't have interest rate swap books.
Or listen to Fed warnings, right?
Right.
31 in the case of SVB.
Right. But SVB is a different scenario. And SVB actually got their money because of flaws in bank regulatory policy, like the end of the exemption in the supplementary leverage ratio for cash and treasuries when JP Morgan, Bank of America, Citicorp were turning away deposits institutional deposits, and the money went to Silicon Valley Bank. Wells Fargo had an asset cap. The money went there. So there's a real duration mismatch problem that the Fed is going to have to resolve either through restructuring QT, changing Treasury could change it through issuance, or cutting front-end rates. So it's not an easy problem to solve, and this stress test, I suspect we may hear or see some evidence of regulators licking their wounds for having missed the Silicon Valley Bank problem, First Republic Bank problem, and try and be unduly harsh, right? So.
Well, when it comes to the duration mismatch, because I mean, if you think about the case of SVB, it was treasuries that brought them down. Right. And when you think about what's actually being modeled for and what these stress tests contain, I mean, would that have been captured, and is that going to be captured? No, and that's the exact point. If you looked at it, the severe scenario has the policy rate going back to zero. That's the real adverse scenario is the Fed can't get inflation under control, decides that they need to get to 2 right away, which, to be in fairness, Powell said today he doesn't think that's going to happen until 2025, which I view as a very positive development, because I don't think it's going there either. I think it's going to 3, and it's going to stay in the 3.5 range. But if the Fed becomes intent on trying to drive it to 2 right away, takes the front rate to 6, and the curve is 200 basis points inverted, there's no alternative for small community banks other than to shrink assets. And that's the lifeline of credit to the small business sector that we have the least information about, right?
So if I look at for example, if I look at a relative rotation graph, which we have on the Bloomberg, and it's fantastic, you can see that the rally in the broader markets has been driven by consumer discretionary, infotech, and telecoms, but financials are coming up. Do you think the market has that wrong? Just real quick, we only have 10 seconds.
I see net revisions on financials plunging right now, so we could have a very ugly earnings season, and yeah, that risk is not mitigated.
All right, Barry, great to have you in the studio. Thanks so much for joining us. Ironside's macro risk advisor, Barry Knapp, and Katie Greifeld, thanks to you too. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them